Right, Nana. Hello, friends. So, welcome back. Decision making revision, we are already done with it. Now, let's go with transfer pricing. Okay, we're gonna look into some concepts. Fatafat. We'll just brush it up, and after that, we'll do some problems as well. Okay. So, because it's a super rapid revision, so we're gonna do things at a very good space. So, this is purely for rapid revision. Okay. So, keep that in mind before we proceed with the session. Okay. Chalo. Now, coming on to transfer pricing. First of all, let's look into the history of it. Earlier, there used to be a centralized way of doing business, which means everything is basically decided by head office. Therefore, branches, departments, divisions, these guys, they just need to follow the orders, whatever the head office says. So because of this, what used to happen was there was no motivation for the managers because most of the managers were inefficient. Why? Because they just need to follow the orders and they can't take their own independent decisions. So they don't get anything extra, whether they do the work or they don't do the work. Anyway, in both the cases, they'll be getting the same salary. In that case, so whether you work efficiently or inefficiently, if you're going to get the same money, same pay, same salary, there will be motivation for you, obviously, right? Of course, there will be few people because of ethical concerns, they'll do it irrespective of the salary that you pay. But majority of the people aren't like that, so they don't have motivation, and this was hurting the profits of the company. Okay. And for this problem, the solution was decentralization, where head office says that, see, so okay, hereafter I'm not going to involve in your day-to-day activities, which means the technical word for that is I'm going to give you divisional autonomy. Divisional autonomy means giving them independent powers, almost like an individual company. Okay, so where I'm not going to involve in your day-to-day activities, rather you are given independence to take your own decisions. Are you able to understand? What head office will do is we will just measure your performance based on some parameters that can be profit, that parameter can be sales, that parameter can be cost. Like I'll give you standard cost and your actual cost will be compared with standard cost, and accordingly your performance will be measured. So the parameter can be anything. Are you able to understand? So we'll give you one parameter, whether it is profit or sales in this example which I've told you. Who will give that? Head office. And accordingly, if the performance is good, then bonus or incentives are given. This bonus or incentives or the motivation for the divisional managers to perform efficiently. Is that clear? This leads to a concept called transfer pricing. Now you can ask me, how can this lead to a concept called transfer pricing? Because the logic is very simple. If you have a supplying division over here, supplying division is not going to sell anything to the external market. It just buys from the supplier and transfers that to the receiving division. In that case, if you want to measure supplying division performance based on profit, now the question is, where is the question of profit for supplying division? Because receiving division sells to the outside market. So there will be sales for receiving division. There will be cost for receiving division. So you'll be able to calculate profit. But for supplying division, where is the question of calculating profit? Because there is no sales as such. It is just transferring its output to the receiving division, which is within the company. Therefore, now what you say, with the help of transfer pricing, which is nothing but kind of a selling price for supplying division, you're gonna transfer your output to the receiving division, not at cost, but at a selling price, which is nothing but TP. Now, because of the concept of TP, supplying division will get something called sales, and it will have its own cost, and you'll be able to calculate profit, which means you'll be able to measure the performance and everything holds good. Are you able to understand? So that's the whole concept. So there will be two divisions, supplying and receiving. Supplying division will sell its output to receiving division at a price called transfer price. This transfer price is revenue for the supplying division, and the same transfer price is cost for receiving division. You got the point? So the price at which intermediate product of supplying division will be sold to receiving or purchasing division is called transfer price. This division can be called as receiving, or it can also be called as purchasing division. You got the point? So that's the thing. So let's move on to the next one. Examples of interdivisional transfers. Normally we feel that when this so-called interdivisional transfer is happening between supplying division and receiving division, we always feel that only goods will be transferred internally. But you need to understand that it is not just goods. Okay, it is not just goods. It can be what, Nana? Services as well. Apart from services, it can be intangibles, which can be like patent, know-how, royalty. It can be interdivisional loans as well. But when it comes to our syllabus, we have only goods and services. We don't have intangibles as well as interdivisional loans. But you guys need to have an idea. Okay, these are all the possibilities of interdivisional transfer. So just keep that in mind. That should be fine. Right. After that, what else we have got? Utility of transfer pricing. Okay, utility of transfer pricing. So what do you mean by that, sir? Ultimately, what are the uses of transfer pricing? That's what we're gonna see. Now, the first utility of transfer pricing is performance evaluation. Of course, because of TP only, you're going to have something called selling price for supplying division. Because of that, it's gonna be possible to calculate profit for supplying division, and therefore you're able to evaluate the performance. So performance evaluation is obviously the first and most utility of transfer pricing, right? That's the main use of transfer pricing. Apart from that, because you're gonna pay bonus to your employees, they're gonna be engaged more because the compensation has got increased. Therefore, employee engagement will be better. Resource allocation also will be better because now there will be more cooperation between the supplying division and the receiving division. As a result, optimum allocation of resources will happen, which means they will use the resources in the best possible way with minimum wastage. And apart from that, of course, you've got taxation and profit remittance are also utilities of transfer pricing. What do you mean by that? See, very simple. Here. Let's say in US you have a head office. In UK you have one subsidiary. In India you have another subsidiary. In UK the tax rate is 40%. In India the tax rate is 30%. Let's say the UK subsidiary is supplying division and Indian subsidiary is purchasing division. Now, in the interest of the group as a whole, you would like your transfer price to be high or low? Well, the answer is, as a group, you want to pay less taxes. So if your UK subsidiary earns more, you have to pay 40% out of it. Whereas Indian subsidiary, if it earns profit, you'll pay only 30%. So from the group point of view, you would like to have Indian subsidiary earn more because eventually you will pay only 30%. Indian subsidiary is a purchasing division, which means purchasing division buys the intermediate product. So which means the buying cost has to be less in order to have more profit at Indian subsidiary. That buying cost has to be less means the TP has to be less. Therefore, eventually the TP should be low. So here what we are doing, we are utilizing transfer pricing for taxation issues as well. So that's why it is called one of the utility of transfer pricing. So basically what happens? As a group, you want your tax payment to be less. Tax rate in India is less. Therefore, Indian subsidiary should earn more profit. Because Indian subsidiary is a purchasing division, purchasing division always tries to buy the intermediate product. So the intermediate product price has to be less, which means TP has to be less. Therefore, TP has to be low, right? The last utility of transfer pricing is profit remittance. So what do you mean by profit remittance? You can call it as profit remittance or profit repatriation. Means, say for example, let's say you have KFC. We've got a lot of branches of KFC in India, right? All the profit that you're gonna earn, they want to send it back to their mother country, that is US in this case, right? So sending your profit back to your mother country is nothing but we call it as profit repatriation. Now, so how transfer pricing will help you when it comes to profit repatriation? Let's try to understand that. Now, let's say you've got US where the head office of KFC is there, and you've got two main branches of KFC. Let's say one is China, the other one is India. Whatever the profits that KFC earns from China, it's very easy, say for example, for them to transfer it back to US. Now don't find logics over here. I'm just trying to give you an example, okay? Whereas if at all the KFC earns a lot of profit in India, then it's very strict. I mean, the rules related to profit repatriation are very strict in India, so that it becomes relatively difficult for the KFC management to repatriate the profit from India to US. So they know that profit repatriation from China to US is easier when compared to profit repatriation of India to US. Therefore, they want the Chinese subsidiary to earn more. And let's presume that Chinese subsidiary is supplying division and Indian subsidiary is purchasing division. They want Chinese subsidiary to earn more profit because so that they can repatriate the profit easily to US, which means Chinese subsidiary is a supplying division. Therefore, they want TP to be high so that the revenue for supplying division, that is Chinese subsidiary division, will be high, and therefore they will earn more profit, and therefore from China they will easily repatriate the profit to US. Are you able to understand? So in this case, TP needs to be high or low? TP has to be high so that the revenue for Chinese subsidiary will be high, because TP is revenue for the supplying division and the profit of Chinese subsidiary will be high, and therefore once they have earned very good amount of profit, because the repatriation rules are not strict, easily from Chinese subsidiary it will be transferred to what? US, that is the mother country. Got it? So those are all the concepts of utility of transfer pricing. So that we are done with it. Now let's move on. Now, next one, what we're going to see is transfer pricing methods. There are basically three transfer pricing methods over here. One is market based, cost based. The other one is negotiation based. Under cost based, again, you have got marginal cost based, standard cost based, full cost, as well as cost plus markup. Okay, right. First, let's look into market based transfer price, which means if your transfer price is equal to the market price, what will happen? What are the pluses? What are the minuses? Okay. The plus point is, first of all, if your TP is equal to market price, then it is unbiased. Why? There's no biasedness. Why? Because this transfer price is determined by the market forces of demand and supply. Therefore, there is no question of biasedness. So you'll not be favoring somebody. You'll not be, unfair to somebody. Are you able to understand? So it will be equal. It will be fair to everybody because it is determined by market forces. This is the first advantage, right? If you fix your TP based on market price. Second, there is no ambiguity, no confusion because market price is visible to everybody. So there is no confusion whatsoever if you fix your TP based on market price, right? Third, market price is competitive. So performance of individual divisional managers can be improved. How? Well, the logic is very simple. Suppose you have got supply division and you have got receiving division. Supply division has fixed TP of 15 rupees for its intermediate product, which receiving division is buying right now. Whereas there is an external vendor who tries to sell the same product that supply division transfers to receiving division at a price of 12 itself. Then what will happen? Receiving division will stop buying from supply division and it will start buying from the external vendor at 12 rupees. Now, supply division cannot transfer at 15 rupees to receiving division. Neither it can sell outside as well because in outside the market price is 12. So nobody will buy from supply division at 15. So in that case, what is the only choice that is left for supply division? It has to increase its efficiency. Are you able to understand? Now supply division is made competitive. Now supply division has to compete with the external vendor and it has to eventually, presuming that the quality of the product is same, eventually transfer to R at a price of 12 only because there is no other way. So which means if you fix your TP based on market price, then performance of the individual division managers can be improved in case they are inefficient. In our example, you have supply division and receiving division. Because supply division is transferring at a price of 15, because in the market it is available at 12, therefore supply division is inefficient. Therefore, their performance will increase if you fix TP based on market price, which is 12. If you fix your TP based on market price, which is 12. In that case, eventually what will happen? Supply division has to transfer at 12 itself, but it wants 15, which means it will not earn sufficient profit. Therefore, ultimately, it will concentrate on its cost. It will try to reduce its cost, which means it becomes efficient. That's the logic. Anyways. Now, coming on to negative points. First of all, we said here in the positive point that market price is, if you fix your TP based on market price, it is completely unbiased. But that need not be the case. Sometimes it can be completely biased, even market price. How? When there is predatory pricing, where you try to price your product less than your total cost with an intention to kill your competition. That is predatory pricing. You try to price your total, you try to price your product less than the total cost with an intention to kill your competition. In that case, if you take that particular market price as a TP, it will be biased. Price discrimination. Sometimes for soldiers, you will try to sell it at a different price. For senior citizens, you will try to sell it at a different price. For women, sometimes you try to sell it at different price. You cannot consider those market prices because they are discriminated, right? That will not give you fair TP. You got the point? So you cannot fix your TP based on such kind of discriminated market price. Are you able to get me? Next, sometimes your market price can fluctuate widely and frequently. Morning 20, evening 22 rupees, next day 25, something like this. Now, which market price will you take? Now, that's again a confusion. So that can be a negative point sometimes. If your market price keeps on fluctuating widely and frequently, in that case, you'll be pretty much confused to take which TP, to fix which TP as your market price. Sorry, to fix which market price as your TP. Got the point? And finally, for some intermediate products, market price may not be available at all. You are manufacturing an intermediate product which is unique in the entire country itself, and there is no market for that intermediate product, but that intermediate product can be converted into a final product by the receiving division, and for that there is a market. Now, for the intermediate product which is very unique, which is manufactured by only your company, if it is unique, there is a question of finding a market price for that. So if there is no market price, how can you fix your TP? If the TP is based on market price, it doesn't work. So all these are negative points and all these are positive points if you fix your TP based on market price. Got the point? I hope this is clear. Right. Next, very important thing. Now many students are getting confused with respect to this particular concept because maximum and minimum TP, almost like 50 to 60% of the problems in your TP chapter is based on this only. And for your kind information, if you can learn this, you can fix maximum and minimum TP for any problem. Sir, is it that simple? Just half a page? Not even half a page, 1/4 of the page? Yes, it is that simple. Once I finish it off, you'll understand. How to fix minimum and maximum TP in any situation. This attempt, we are actually expecting minimum and maximum TP to come in the examination because last time the question was asked based on international transfer pricing. So we are expecting that to come. Anyways, well, the answer is very simple. If you want to fix your minimum TP, you should always think from supply and divisions point of view. Every sentence that I've written here is very important. You will not find these things in books. Therefore, try to understand this carefully. If you want to fix your minimum TP, you should always think from supply and divisions point of view. Why? Because supply and division is the one who has spent the money to manufacture that particular product. Therefore, you need to ensure that supply and division gets more than what it has spent. Suppose it has spent 10, your TP should be minimum more than 10. Suppose it has spent 20, your TP should be minimum more than 20. Are you able to understand? So therefore, minimum TP is nothing but whatever the money that supply and division has spent. Got the point? Maximum TP means you need to think from receiving division's point of view. Why? Because purchasing division or receiving division is the one who is going to buy. So we must ensure that the receiving division has got sufficient money to buy. For example, receiving division has got only 100 rupees in its pockets. You cannot fix TP as 120. Then it cannot buy because it does not have the capability to buy. Sometimes, let's say receiving division has got 120 rupees in its pockets and you have fixed TP as 120. But outside from an external vendor, it is available at 110. Then receiving division will pay maximum 110 only. Why? Because it can be bought at the same price from 110, from the external vendor. In that case, even if you fix TP at 120, it's not going to work, which means when it comes to maximum TP, it is the money that receiving division possesses or the external buying price, whichever is less will be your maximum TP. How much money that receiving division has got? Let's say it is 140 or outside from vendor, it is available at 120. In that case, 120 will be your maximum TP. Are you able to understand? Suppose the money that receiving division possesses is 160 and outside vendor, it is available at 180. Now, supply and division cannot say I can fix maximum TP as 180 because it can come out with a logic saying that outside it is available at 180 so that I'm also keeping TP as 180. Then receiving division will say, yes, outside it is available at 180. I can accept that, but I have got only 160 with me right now. Even if I want to, I don't have money. I have only 160 with me. What can I do? Maximum I can pay 160. Then maximum TP will be 160 only. Therefore, the money that receiving division possesses or the external buying price, whichever is less, is nothing but your maximum TP. Okay, so very simple. That's it. We are done with everything. If you can understand this logic clearly, you can solve any problem in this entire chapter. So always remember, this is very important. Every single sentence is important. You got to think like that only. In any problem, if you have been asked to fix minimum TP or maximum TP, what do you have to think? Okay, fine. Minimum TP means we should think from supply and division's point of view. Whatever the money that supply and division has spent, our TP should be more than that. There ends the matter. Done. That's it. Now coming on to maximum TP, okay, I need to think from receiving division's point of view. How much is the money that receiving division has got? Below that, I need to fix TP. Only then he will buy. Or how much is the money that receiving division has got or external buying price, whichever is less. Got it? So finally, this is the essence of the transfer pricing concept. Minimum TP is nothing but cost that has been spent by the supply and division. Maximum TP is nothing but money that receiving division possesses or external buying price, whichever is less. You got the point? Yeah. So the concept remains the same only. I'm just trying to improvise it a bit here. Minimum TP is equal to total relevant cost of the supply and division. I already told you minimum TP is nothing but cost spent by the supply and division. That cost can be relevant cost. Relevant cost means what? Sometimes it can be variable cost plus opportunity cost. Opportunity cost is also cost now. Opportunity cost is also cost. So ultimately, what is the concept I've told you? Minimum TP is nothing but total cost for the supply and division. Now, total cost for the supply and division can be either variable cost or marginal cost or variable cost plus opportunity cost. Plus, it can be fixed cost also. Marginal cost means that is the logic over here. When fixed cost is also changing, we'll call it as marginal cost. Are you able to understand? When fixed cost is not changing, only variable cost is changing, then also we can call it as marginal cost, but then marginal cost will be nothing but variable cost. Are you able to understand? Which means the logic that you have to understand here is any cost that changes will come under this. Normally variable cost will be changing. If fixed cost also changes, that also you have to add here, plus opportunity cost if there is any opportunity cost. I hope you guys know the concept of opportunity cost. The benefit that you're gonna foregone from a lost opportunity is nothing but opportunity cost. So minimum TP is nothing but total relevant cost of the supply division, which usually is either variable cost or variable cost plus opportunity cost. Are you able to understand? Pretty simple. Maximum TP, I hope I've explained you the concept already. NMR. NMR is nothing but the money that receiving division possesses. Net marginal revenue is nothing but the money that receiving division possesses. Now you can ask me, how is that, sir? Very simple, Nana. Suppose receiving division sells its product at 120 rupees in the outside market. It spends its own cost, that is the own cost of the receiving division is nothing but we call it as further processing cost as 80. Then how much is the money that receiving division possesses? 120 minus 80, 40. 40 is the money that it has got to buy from the supplying division. This 40 is nothing but NMR. Are you able to understand? Because the selling price of 120 is called as revenue, that is R. This is called as cost. Revenue minus cost is nothing but net revenue. Are you able to understand? Revenue minus cost is nothing but net revenue. You got the point? And incremental net revenue is nothing but net marginal revenue. Marginal revenue means incremental, additional. So that's why it is called as NMR. Simply what you have to understand, NMR is nothing but money that receiving division possesses. There ends the matter, right? Or external buying price, whichever is less. I hope I have explained you the concept already. So this is it, guys. If you can remember this, all the problems, you can fix your minimum TP as well as maximum TP. There ends the matter. Chalo. Now let's move on to the next one. Different types of centers. Okay. Normally, I think this will be covered in a different chapter, but this is the right time to cover this particular concept. What are the different types of centers? We have cost center, profit center, revenue center, and investment center. What do you mean by this, sir? If you have a division, a supplying division as well as a receiving division, how can you treat that particular division? For example, of course, we are going for decentralization, divisional autonomy only. There are different types of divisional autonomy. That's what I'm trying to say. I'm going to give powers to the individual departments. Yes, there is no doubt in that. In that, there are different types of powers. Extreme power like investment center, relatively less power like cost center. So what is that? Let's try to understand. If you treat a particular division as cost center, it means that that division has got power with respect to cost. Means it can take decisions with respect to cost and it is responsible to the extent of cost only. How will you measure the performance of such a kind of a division? I'll give it standard cost and I'll see what is the actual cost being incurred, and actual cost will be compared with standard cost, and accordingly variance will be calculated, and accordingly performance will be measured, accordingly bonus will be given. Can you give any examples for those divisions treated as cost center? Yes, the example is purchasing division, or you can also call it as procurement division. Purchasing division or procurement division. Got it? That's the example for cost center. Profit center means you are responsible to the extent of profit, which is nothing but indirectly you're responsible for sales as well as cost, because both of them will influence profit. And you have power with respect to sales as well as cost as well, because both of them will influence profit. Okay. And your performance will be measured based on target profits. Generally, most of the production departments will be profit centers. Most of the production departments will be profit centers. And finally, revenue center, same logic. Your power will be restricted to the extent of sales or revenue, and you're responsible to the extent of sales or revenue as well. And your performance will be measured based on sales targets. Like for example, I'll give you a target of 1 lakh sales per quarter or 1 lakh sales per month or whatever it is. If you achieve that, you'll get bonus. If you don't achieve that, you don't get bonus. As simple as that. Okay. Examples are sales department, marketing department. Generally, they will be treated as a revenue center, and their targets will be given based on sales turnover only. Okay. And finally, you have something called investment center, which is an extreme form of decentralization. Means maximum power will be given. Are you able to understand? You have power with respect to profit, some capital budgeting decisions as well, and your performance will be measured based on ROI. Now, the biggest question is when a particular division will be treated as an investment center. Well, the logic is very simple. Let's say in US, there is a holding company and they have a subsidiary in Hyderabad in India. they do not know about the realities of the substrate or the local challenges, the kind of market, the kind of people here in Hyderabad to do their business. Therefore, what the holding company in US does is that it feels that we need to give extreme power to the head or the manager or divisional head of the substrate, such that they'll be able to do business well in Hyderabad, because we are totally have no idea with respect to what the local challenges in Hyderabad are. In that case, I will treat this particular substrate as an investment center where I'll give him power to take some capital budgeting decisions as well. And I'll measure his performance based on return on investment. So this is a kind of typical example where a particular division or a substrate or a branch can be treated as an investment center. You got the point? So that's the concept, guys. This is very important. How the case studies can come is that, say for example, in a question, he can give you a particular department and he can say that this particular department is treated as a profit center and now it has been decided to convert that into cost center. These are all the reasons. Give your opinion. Like that, he can ask you a question and then you have to give your opinion whether the decision to convert that particular division from profit to cost center is justified or not with your reasons. Are you able to understand? Like this, he can ask you interpretation based kind of questions. That's why you need to know the logic. Are you able to understand? I hope this is clear. Yes. Right. Fantastic. Now let's look into the concept of relevant cost. Already I have discussed this relevant cost concept as part and parcel of decision making revision as well. But one more time we'll see. So based on decision making, we can classify cost into two: relevant, irrelevant. Relevant means you consider it while taking decision. Irrelevant means you ignore it while taking decision. For example, variable cost is always relevant because it changes. Explicit cost means where there will be real cash payment, like salary, electricity. That will be what? Relevant cost. Are you able to understand? What else? Yeah, let's get to opportunity cost. You know what is opportunity cost, right? Benefit foregone from a lost opportunity. That is relevant cost or irrelevant cost? Relevant cost. Okay. Then what else? Yeah, sunk cost. Where is it? Yeah, here it is. Sunk cost will be relevant cost or irrelevant cost? Irrelevant cost. I hope you guys know what is sunk cost. Historical cost, a cost which has already been incurred, is sunk cost, correct? So we are aware of that as well. Reminding you guys can just read these examples yourself. Once you have got my Power Notes hard copy, you can just read this examples yourself. Are you able to understand? Chalo. So sunk cost is nothing but historical cost or cost already incurred. Okay, now let's move on to the next concept, that is key factor or limiting factor or critical factor. I told you that when decision making revision was being done, I told you that I'll cover this as part and parcel of transfer pricing, and now we are covering it over here. So what is this key factor or limiting factor or critical factor? Okay, let's try to understand this first. Anything that has the ability to limit your production, we call it as key factor or limiting factor or critical factor. In other words, to put it very simple, scarce resources, that's it. Raw material availability is limited, machine's availability is limited, labor's availability is limited, is nothing but critical factor or limiting factor, which is nothing but we can also call that as bottleneck. Which is nothing but we can also call it as bottleneck. There is no doubt in that. Are you able to understand? How to apply this particular concept? Well, very simple. Let's take an example over here. A, B, C. Selling price is given, variable cost is given. If you look at the contribution per unit, and if you take your decision based on contribution per unit, you will prefer A first, followed by B, and followed by C. Correct? But let's presume that raw material is a limiting factor, and look at the situation over here. A consumes 2 kg of raw material, B consumes 1 kg of raw material, and C consumes 0.5 kg of raw material. In this case, let us see what happens. Now let's find out contribution per unit of raw material. 40 by 2, 30 by 1, 20 by 0.5, and you can see contribution per raw material is 20, 30 and 40, and the ranking has exactly become opposite. C has got the first rank, A has got the last rank. Why? Because even though A is giving you a contribution of 40, it is consuming 2 kgs, therefore per kg it is giving only 20. Even though C is giving you a contribution of 20, it is consuming only 0.5 kgs, which means for 2 kgs equivalent over here, it will earn how much? 4 times that of A, correct? Almost 80. That's why here contribution per raw material when compared to A, it is double over here. Are you able to understand? Can you see that? Yeah. So for 1 kg, it will be 40. For 2 kgs, you can say it will be 80. Are you able to understand? So double to that of what A earns. So therefore C has got the first rank. So what you guys need to understand here from this example is that whenever you have a limiting factor, in this case it is raw material, you should never ever take decision based on contribution per unit. Rather, you should take decision based on contribution per limiting factor. In this case, it is contribution per raw material. It can be contribution per labor hour, it can be contribution per machine hour. So that is the summary what I've given. If there is no limiting factor, no scarce resources, raw material, labor hours, machine hours, everything availability is very good, then you take decision based on contribution per unit. That will give you maximum profit. Because most of the times question will ask you, what should I do to earn maximum profit? That's what question will ask you. If there is limiting factor, then take decision based on contribution per limiting factor. This will give you maximum profit. Are you able to understand? If there is no limiting factor, take decision based on contribution per unit. That will give you maximum profit. If there is limiting factor, take decision based on contribution per limiting factor. That will give you maximum profit. That is the summary. That's it. If you remember these two sentences, it's done and dusted. Are you able to understand? Well done, all of you. Yes? Right, Nana? So I hope this is clear, right? Okay, only just these two sentences you got to remember. That's more than enough. Right, buddies? So we'll wind up the session over here. In the next session, hardly there are 1 or 2 concepts that is left over. We'll cover that and then we'll go for problems. Fatafat, within 1 hour 15 minutes, we'll finish off as many problems as possible for revision from this transfer pricing chapter. You got it? And then we'll go for next chapter revision. Right, guys? Thank you so much. Bye-bye. Stay tuned to our YouTube channel, guys. Revision classes are going to get uploaded. You better subscribe to it. And if you can share the videos and help the other students as well, that would be great from my side. Right, guys? Thank you so much. Bye-bye. Right, friends. So welcome back. I think this is where we have left in the last session, right? So the summary of the limiting factor concept. The summary of the limiting factor concept is where we have left in the last session, right? Now, let's move on to the next concept, that is make or buy decisions. Okay. So what we'll do now is that we'll finish off the remaining concepts and then we'll get into solving sums. Because it's a rapid revision, we need to solve as many sums as possible in a time span of 1 hour. Or you able to understand 1 hour 15 minutes. That's what we are going to plan. Anyways, so look at this make or buy decision. How to take a make or buy decision? Very simple. You always need to compare variable cost of manufacturing with external buying price to take a make or buy decision. Now always try to keep in mind that why am I comparing variable cost of manufacturing with external buying price? Why? Because it is based on the presumption that fixed cost is constant. It is based on the presumption that fixed cost is constant and fixed cost is irrelevant. When it is constant, it doesn't change. So whether you decide to manufacture or you decide to buy from outside, your fixed cost remains what? The same. Therefore, it is not relevant for decision making. Therefore, we will ignore it. Are you able to understand? So it's a simple logic, right? But suppose fixed cost changes, then variable cost of manufacturing plus the fixed cost that is changing should be compared with external buying price, and accordingly only decision should be taken. This keep it in mind. Okay, now coming on to product A, variable cost of manufacturing was 40, external buying price is 35. So your decision will be to buy. Coming on to B, variable cost of manufacturing is 50, external buying price is 65. So your decision will be to make. Why? Because making is cheaper. Here 80 and 90, so 80 is cheaper, which means it's better to make or manufacture. So 95% of the cases, your variable cost of manufacturing will be less than external buying price. Why? Because external buying price is a selling price for the external vendor. So his selling price means he'll have his own cost plus profit markup, right? So definitely your variable cost of manufacturing by using common sense should always be less than the selling price of your external vendor. The logic is very simple. But sometimes if your variable cost of manufacturing is greater than the selling price of the external vendor, which becomes cost for you, then it means that you are really pathetic. You are absolutely inefficient in manufacturing. In that case, it's better to buy rather than manufacturing. That's how the logic works. You got it? So here I've given you the start point. In about decision making, right, it is based on the presumption that fixed cost is constant. Therefore, it is irrelevant. So which means if fixed cost changes, then that should be added here in decision making process. And then you compare this with this. Are you able to get me? Right? Sure. So with that, we are done with the limiting factor and also make or buy. Now let's get into the concept of indifference point. Right. So what is this indifference point concept? This concept is very important for 2 chapters. One is transfer pricing as well as decision making. Decision making revision, we have already done it. We have brushed up all the concepts. So now, but as I told you, sometimes this will be covered as part and parcel of decision making chapter, but I've covered it as part and parcel of transfer pricing chapter, right? Anyways, now let's try to understand this particular concept. What is this concept of indifference point? So let's start with the definition first. It is a level of sales at which total cost of the two options will be same, and also as a result, total profit of two options will be same, and therefore the person taking decision will be indifferent between both the options. Will be indifferent between both the options means he will not show any difference. Like say for example, if there is option A and option B, he will look at these options in a similar way. Option A or option B, both are nothing but same for him. So that's how the logic works. Now the biggest question here is how the person is actually taking decision. Well, the person taking decision will be indifferent between both the options, which means he is basically taking decision based on profit. Say for example, there are two options. He is looking at the profit of two options and both the options gives him same profit. Therefore, he feels that either option A or option B, both are nothing but same for me. That's why it becomes indifference point. What becomes indifference point? That sales level becomes indifference point. The sales level at which profit is same. Please try to keep that in mind, right? Anyways, let's look into the definition one more time. What are the keywords in the definition? It's a sales level. That is the first thing you need to remember. Second, of which total cost of two options will be same. So it's specifically mentioned that it is two options, which means you can find indifference point between two options. Say for example, A and B. Suppose there are three options A, B and C. Can you find indifference point between all the three? Not possible, because specifically it is mentioned in the definition that you can find indifference point between two options. So if there are three options, eventually what happens is that you need to find indifference point between AB, BC and then AC. And accordingly, you need to take the decision. That's the way you need to find indifference point if it is for more than two options. And profit of two options will be same. So this is another keyword, because I told you that the person taking decision will take his decision based on profit. You got the point? Okay. Now let's try to go a little bit deeper. Let's dig deeper into the concept. So basically, this is how it looks like. Let's say there are two options, option A and option B. Okay. Option A sales will be equals to option B sales, because it is a level of sales at which total cost of two options will be same. So sales is same for both the options. Total cost is same for both the options. Naturally, profit also will be same. So if you dig this further deeper, and then you will understand that yes, sales is same, total cost is also same, but total cost is made up of two elements, that is variable cost and fixed cost, and they are not same. For example, if you see, variable cost of option A is not equals to variable cost of option B, and fixed cost of option A is not equals to fixed cost of option B. But once you total them up, the total cost is equal to both the options, which means what basically happens is, say for example, if variable cost is less for option A, then fixed cost will be high. If variable cost is high for option B, then fixed cost will be less. So the set off will happen, and thereby eventually the total cost will be same. Are you able to understand? That's how the logic works. So sales is same, total cost is same, so profit is also same, but variable cost and fixed cost are not equal. So how to understand this, sir? Let's try to understand the basics of it. See, say for example, sir, if variable cost is high, fixed cost will be less? Yes. If variable cost is less, then fixed cost will be high? Yes. Sir, variable cost and fixed cost both will be high? Not possible. Sir, variable cost and fixed cost both can be less? Not possible. Why, sir? Why? Because if you want to reduce your variable cost, you need to invest in fixed cost. Means, if you want to reduce your variable cost, say for example, there is something called capital intensive department. In capital intensive department, what happens? It will be full of machines. That's why it is called capital intensive. So you've invested a lot of capital. So there is a lot of fixed cost. And therefore, because machines are manufacturing, automatically your variable cost will be less, because machines will manufacture at a cheaper cost. So therefore, fixed cost is high and variable cost is less. So to reduce your fixed cost, you need to invest in, to reduce your variable cost, you need to invest in fixed cost. You need to buy machines, invest in fixed cost, and then only variable cost of manufacturing per unit will be less. Similarly, if suppose there is a labor intensive department, obviously there are no machines, so you haven't invested much, therefore your fixed cost will be less. But as the products are being made by labor, automatically the variable cost will be high. So therefore, what you need to understand here is that if you want to reduce your variable cost, you need to invest in fixed cost. So naturally, high fixed cost option will automatically be low variable cost option. Are you able to get my drift? High fixed cost option will automatically be low variable cost option, because only if you invest in fixed cost, your variable cost will be less reduced. That's how the logic works. You got the point? Anyways, so that's it. That's the concept. So we have seen the definition. We have understood the depth, that total cost is same, but individual elements of cost is not same. That is variable and fixed cost. And then we have understood the logics behind the relationship between variable and fixed cost as well. But now, how to use this particular concept, how to apply this particular concept in a sum, that we'll try to see. So application of IDP concept, that is indifference point. Okay, let's try to understand that. So I've given you stepwise procedure, so that it will be very easy for you to understand. So let's start with that. Step 1. First, you need to estimate your actual sales. Say, for example, you want to do a business. How much is the sales that you are expecting? For example, let's say you want to open up a hotel. There are two ways of opening up a hotel or a restaurant. Let's say it's a restaurant. Okay. One is like KFC or McD, you can go for high fixed cost, because as you can see in KFC and McD, most of the food is being made by the machines and less of labor. Or you can go for a traditional or local restaurant type, where there will be more of the labor and less of the machines. So obviously when you go for KFC type, what will happen? Fixed cost will be high, okay, and variable cost will be less. If you go for KFC kind of manufacturing the tiffin or food or whatever it is, if you go for our own Desi style, then fixed cost will be less and variable cost will be high. Now let's say you want to open up a restaurant and you are confused. You don't know which option to go for. Should I go for heavy machines option, or should I go for low machines options like the Desi style? You are confused. The solution for your confusion will be given by indifference point. How? Step 1, estimate your actual sales. Let's say you are thinking that 60 lakhs of turnover will happen this particular year. You are expecting that much of sales will happen for your restaurant. Now what you do? Calculate indifference point sales as second step. How to calculate indifference point sales? Change in fixed cost divided by change in variable cost. That's very simple logic, right? Because that's the basic purpose of the whole concept of indifference point. There are two options. What is the only difference between two options? Fixed cost is different, variable cost is different. Therefore, naturally, the formula to calculate indifference point will be change in fixed cost divided by change in variable cost. It's pretty simple. Now, what you do in the third step, you compare your actual sales with indifference point sales, which means the second step sales should be compared with first step sales. Once you do that, there are three possibilities for you. What are those three possibilities? Either your actual expected sales will be less than indifference point sales, or your actual expected sales will be equals to indifference point sales, or your actual expected sales is greater than indifference point sales. So there are three possibilities. Okay. Now, if your actual expected sales is less than indifference point sales, that means that your sales is less because you are selling less. That's why your actual expected sales is less than the indifference point sales. Your market is less. So when your market is less, when you're trying to sell less number of units and your market is really less, you would like to go for that particular option which has got low fixed cost. Why? Because already your sales is less. If you go for that option which has got high fixed cost, then eventually what will happen? Maybe you might end up in a situation where you may not recover your fixed cost as well. So therefore, because your sales is less, your market is less, therefore go for that option which has got low fixed cost so that you will earn more profit, or at least earn profit first of all. If you go for high fixed cost option in this kind of a scenario, you may not even reach break-even point. That is also possible. Are you getting the logic, right? Now, if your actual expected sales is equal to indifference point sales, that's fine. Then your sales level is nothing but indifference point level, which means your total cost will be same, sales will be same, profit will be same. So you can choose either of the options because both the options will give you same profit. Got the point? But if your actual expected sales is greater than indifference point sales, then it means that your sales is big, your market is big, right? So when your market is big, you will go for high fixed cost option. Why, sir? Well, the logic is very simple. Listen carefully. If your sales is big and greater than indifference point sales, it means that basically you would have crossed BEP. It means that basically you would have crossed BEP. So when you have crossed BEP, it means that already your fixed cost is recovered. Correct? When you have crossed BEP, it means that already your fixed cost is recovered, because then only it is BEP, right? All your cost has to be recovered, including fixed cost. So once your fixed cost is recovered, there are only two types of cost, fixed and variable. Fixed is already recovered. So what is left over? Variable. So you'll go for that option which has got low variable cost. Incidentally, low variable cost option is nothing but high fixed cost option. Therefore, go for high fixed cost option. That will give you maximum profit. That's how the logic works. You got this? Right. Okay, now let's move on to the next one. The next concept is transfer pricing methods to resolve performance evaluation conflicts. Sometimes what happens is that there will be a fight between individual divisions and neither of them will come to a common acceptable transfer price. They'll keep on fighting. In those kind of situations, head office will involve and they will resolve the transfer pricing conflict, which stops or abrupts the interdivisional transfers, which is beneficial from the company's point of view, but individual divisional managers are not accepting or are not making that happen because of their own selfish interest. Probably it is hurting their division's profit. Are you able to understand? So there are two solutions to solve this sort of a transfer pricing conflict. They are dual rate transfer pricing system. Other one is two-part transfer pricing system. What is that? Let's try to understand. Dual rate transfer pricing system means there will be two rates. In supplying division's book, there will be one rate. In receiving division's book, there will be another rate. How is that possible, sir? Very simple. See here. Supplying division in his books, he will put TP is equal to variable cost plus markup. Let's say variable cost is 10 rupees. He'll put markup of 2 and he will put in his books that he has sold at a price of 12 to purchasing division. But purchasing division in his books, he will write intermediate product purchase cost is nothing but transfer price, right? For purchasing division. He will write it as 10 rupees only. Sir, how is that possible, sir? How can you write 12? How can you write 10? For this, you need to understand the basics of transfer pricing. In majority of the cases, when it comes to interdivisional transfer, the real transfer will not happen. It is just a mere book entry or a system entry. Really, supply division will not receive money. Really, receiving division will not pay money. It's just an understanding. They'll just put an entry in their system. That's it. And therefore, this sort of a logic works only when there is real monetary transaction that is happening. Then this sort of a logic doesn't work. It seems stupid, right? How can this guy put 12 as revenue? How can this guy put 10 as cost? It doesn't work that way, right? You understand the point? So because the real transaction of money doesn't happen, this works. Are you able to understand? So now supply division is happy because he has got good revenue. Purchasing division is also very happy. Why? Because he has got it at a lesser cost. So both of them are happy. They'll agree for interdivisional transfers and the company also will be happy. Of course, there is a negative point in this kind of a dual rate transfer pricing system where if you do reconciliation tomorrow, there will be a headache. There will be a confusion that you need to sort it out because of this two different transfer pricing. Got the point? But ultimately, the transfer pricing conflict is resolved and interdivisional transfer will happen between supplying division and purchasing division. This is one point that you have to remember. The other solution to resolve the transfer pricing conflict is two-part transfer pricing system. Now, what is this two-part transfer pricing system? You've got two divisions. One is supplying division. The other one is receiving division. Let's say their total capacity is 50,000 units. Let's say, okay. And external sales is 40,000 units and internal transfer is 10,000 units, which means external and internal sales is happening in the ratio of 4:1. Let's say variable cost is 20 rupees per unit and fixed cost of the supplying division is 1 lakh. Just a second, Nana. Right, Nana. Let's continue. Okay. Now, so initially I gave you a small example with a little bit of data so that it will be easy for us to understand this two-part transfer pricing system. So there are two divisions, supplying and receiving. The total capacity of the supplying division is 50,000 units. In that, external sales will be 40, internal sales will be 10,000, which means it is in the ratio of 4:1. Variable cost of the supplying division is 20, fixed cost is 1 lakh. Let's put the data this way. Now, the logic behind two-part transfer pricing system, why it is named as two-part is one part will go for compensating the variable cost incurred by the supplying division. Who will compensate? Receiving division. The other part will go for compensating fixed cost. See, normally when you fix your TP as variable cost, supplying division will not accept. Why? Because it wants something more than variable cost. Variable cost is something that is incurring. That is being incurred by the supplying division. And if you say that I'll pay the same amount of money, then supplying division does not have any motivation to manufacture. Why? Because I incur a variable cost of 10, you pay me 10, then what's the ultimate use of doing all these things? Instead, I can just sit back and watch, So therefore, supply division says that give me something up and above the variable cost so that I can recover my fixed cost to some extent. Are you able to understand? So therefore, two-part transfer pricing system says that there will be two parts in the compensation that receiving division is going to pay to supplying division. One part will compensate variable cost The other part will compensate the fixed cost. Now the question is, variable cost part is very easy. Okay, 20 rupees is the variable cost incurred by the supplying division. You pay 20 rupees. So this part compensation is very easy. But fixed cost part compensation is not very easy. Why? Because the total fixed cost incurred by by the supplying division is 1 lakh. So will receiving division pay entire 1 lakh? It doesn't work that way. So what receiving division does is that it looks at, in this example, there is an external sales to internal sales ratio of 4:1, which means receiving division says you are selling 4 units outside and 1 unit inside. So out of the total fixed cost that you have incurred, recover 4 parts of your fixed cost from the outside sales and 1 part we will compensate. That's the fair way of doing calculation, right? So fixed cost is 1 lakh. Divide the fixed cost in the ratio of external sales and internal sales, which is 4:1, which means 80,000 should be recovered by the supply division from the external sales and 20,000 will be paid by the receiving division. Therefore, total transfer price is equal to variable cost part compensation plus compensation towards fixed part. How many units are being transferred internally? 10,000 units. Are you able to understand? That's it, right? 10,000 units. So which means 10,000 into 20 rupees per unit. So one part which compensates variable cost incurred by the supplying division, that will come to 2 lakhs. And the other part will be towards fixed cost compensation, which came around 20,000 over here. So 2 lakhs plus 20,000, your total compensation will be 2 lakh 20,000, which includes 2 parts. 2 lakhs, which is variable cost part, and 20,000, which is fixed cost part. And this can also be called as lump sum consideration method. Okay. Right, anyways, keep that in mind. This 2-part transfer pricing system can also be called as lump sum consideration method. Keep that in mind. Okay, so let's move on. And finally, we have come to the last concept, that is international transfer pricing. So with this, we'll be winding up all the concepts. Okay, there is nothing much in international transfer pricing. Okay, normally while solving sums only, you'll be able to understand. It's just about the interest in the group as a whole. Are you able to understand? So what is the purpose behind international transfer pricing? There has been a lot of MNCs and these multinational companies, they find resources in one country like raw material. They find cheap labor in one country like China, for example. They find ease of doing business. China is the example for that. Demand for finished goods or products, India is the reason. So which means they come and establish their business in India, not because of first 3 points, but because of the 4th point. Because in India, if you can manufacture something, you can sell in India itself. You need not look out for external market, but that's not the case in other countries. Okay. So when they try to establish a manufacturing sector, say for example, they need to again look for outside that particular country where they have established to sell their particular goods. But in India, you don't have that kind of an issue, So therefore, these are all the 4 reasons why MNCs will establish their business. Once MNCs have established their business, because they are in countries, they are in multiple countries. So there will be a situation called international transfer pricing. And the reason for transfer pricing is 2 things. One is taxation and profit remittance. I have already discussed about taxation and profit remittance when I was teaching you, or when I was revising you, utility of transfer pricing. So I won't be repeating that part over here because this is a rapid revision. We don't have time. But ultimately, this much is enough right now. Okay, because of this, MNCs are establishing their business in multiple countries, and this leads to something called international transfer pricing. That much is enough right now for you. Once we start solving sums in that, we'll try to revise that particular part as well. Are you able to get me? Right, guys. So that's it. We will stop the concepts over here. Its concept is done. Next is decision making. Okay. Decision making revision. I've already brushed up the concepts over here. Now next, we will go for problems. We'll finish up the problems in 1 hour 15 minutes. Are you able to understand? So which means how fast it will go, you can imagine, but that's the way it works. That's what we call it as rapid revision. Are you able to get me? Right, buddies. So let's go for problems now. Let's move on. Okay, guys. Now we're going to take the first problem that has been given in transfer pricing. Here it is. So division A produces goods at a cost of 10 per unit and transfers the goods to division B, which has additional cost of 5 per unit. Division B sells externally at 16 per unit. The company has a policy of setting transfer prices at cost plus 20%. You are required to calculate profit of each division and overall profit the company made and write a brief analysis of the results. Okay, now this problem is pretty simple. You just calculate profit for division A, which is given already. Its cost plus 20%, we get 12. minus cost, you get your profit. And for receiving division also, it's very simple. Already the sales is given in the question, which is 16, minus two types of cost. One is its own cost, which is 5, that is given in the question. Other one is intermediate product purchase cost, which is nothing but the revenue of the supplying division, which is 12, and you get your profit. So it's a very simple calculation. But what is more important for us is the analysis. Now, if you can see, the profit of supplying division is 2 and the profit of receiving division is 1 loss. Overall profit of the company is 1 profit, which is positive. Okay, 2 minus 1. Now, so coming on to this particular thing, we have lots of challenges over here, lots of analysis. First thing is, if this setup continues, always division A will earn profit and always division B will face loss. Why? Because you have fixed your TP based on cost plus markup of 20%, and therefore division A will always make profit no matter what its cost is, because cost plus 20%, whatever the cost, ultimately it will earn profit. And this cost plus markup will eventually increase the input cost or intermediate product purchase cost for the receiving division, and eventually it will always face losses. Now, because of this, there are two problems. One, division A manager will become careless, he will become lethargic, because no matter what his cost is, no matter how efficient he is, no matter whether he takes any steps to reduce the cost or control the cost of his particular division, which is division A, he'll be getting profit in all weather conditions. So therefore, he will become inefficient in that way. Coming on to division B also, division B's manager also may become inefficient. Why? Because he will lose his confidence because no matter what, whatever he do, always he'll be facing losses. Therefore, what will happen is that he will also stop, being efficient, and that will be a double blow for the company, and that will create goal congruence. This is problem number one. It will create goal conflict. Second thing is, if you look at the internal markup and external markup, if you look at the internal markup, it is 20%, which is 20% is what is allowed for division A to charge, right, from division B. Whereas if you look at the external markup on the finished good that this particular company is selling, it is only 6.67%. I hope you know the calculation. Total cost, which is 10 rupees for this division and 5 rupees for this division, total 15. And the profit that the company is charging is 1 rupee. So 1 by 15 into 100, which is 6.67%. So based on this analysis, we can come to two conclusions. One, either the internal markup is correct or the external markup is correct. If internal markup of 20% is justified, then you revise your external selling price, thereby increase your external markup to 20% as well, then it will be justified. Or if you say your external markup is correct, then revise your internal markup, bring it down to 6.67%. Are you able to understand? Next, also, we can also do one more analysis, that is, we can allow division B to buy from outside, okay, from an external vendor. Because of this, there are two advantages. If you buy from external vendor, right now division B is buying at a price of 12. So when it buys from external vendor, it can be more than 12 or less than 12. Say for example, it can be 14 or it can be 10. Are you able to understand? Suppose if it is less than 12, that is 10, it means that the division A is inefficient. Are you able to understand? Because in the external markup, the selling price of the external vendor is 10 rupees, whereas division A is charging 12 rupees. In that case, division B will continue to buy from outside at 10 rupees. Thereby, division A neither can transfer internally because division B will not buy, nor it can sell externally because externally it is available at 10 rupees. Thereby, division A has got no other option but to increase its efficiency, up the game, and that is in the interest of the company. So that's good. Second thing is, suppose the external buying price is 14, then that reflects that division A is highly efficient. The problem is with division B. Either division B is inefficient in managing its own cost, or division B's selling price is very less. These two should be the reasons. Are you able to understand? In that case, division B will either revise its selling price or it will increase its efficiency, thereby reduce its cost, and thereby it is again in the interest of the company. So in either of the cases, ultimately the company will get benefited. Are you able to understand? So whether it is 10 rupees where your external buying price is less than the internal transfer price, or 14 rupees where your external buying price is greater than the internal transfer price of 12. Got it? So that's the analysis for the first part of the question. Got it, guys? Chalo, let's move on to the next one. So this is done. All this analysis are also finished. Behavioral consequences also we have covered. Okay, now, so I hope you guys are aware of these transfer pricing methods. Okay, there are three: market-based, cost-based, and negotiation-based. Under cost-based, we have again 4: marginal cost, standard cost, full cost, and full cost plus markup. We'll see them one by one. Okay, now coming on to market-based transfer price, I hope these you guys can study. So it's not, it is nothing much over here. Okay, because you're trying to fix your TP based on market price, it will be unbiased because nobody can influence the same. Okay, that is one point. Second, there is no confusion because the transfer price is nothing but market price and it is clearly available in the market. And because the pricing is competitive, what will happen? Both the divisions will ultimately increase their efficiency, right? Which we have seen in the earlier problem as well. So if you try to fix your TP as market price, then your divisions has to compulsorily match with the efficiency of the external market, and that's good from company's perspective. So all these are positive points if you fix your TP based on market price. So one is there is no unbiasedness, there will be unbiasedness, and there will be less ambiguity, there is no confusion because market price is clearly available. And the third one is your individual divisions performance will increase and it has to compulsorily match with the performance or efficiency of the industry as a whole or market as a whole, and that's good for the company. Now coming on to the disadvantages, we have told that the market price is completely unbiased because it is determined by the market forces of supply and demand. But in all the cases, it need not be completely unbiased. For example, there is a distressed sale market. Okay, there is a predatory pricing situation where you try to reduce your selling price wantedly to kill your competition. That's what we call predatory pricing. In those kind of situations, obviously, your market price, if you fix as a TP, then it's absolutely wrong. Are you able to understand? So that's a negative point for TP. Also, sometimes market prices can fluctuate widely and quickly. It can fluctuate so much, it can fluctuate fast. In that case, which market price will you take to fix your TP? That's another confusion and that's a problematic scenario. Also, sometimes the kind of intermediate product or the goods that you manufacture will be so unique, will be so special that you are the only one who is manufacturing such a kind of intermediate product in the entire country. So thereby you will not find market at all. So when there is no market for your intermediate product, there is no question of having a market price, and thereby what will happen in that particular situation? You cannot fix your TP based on market price because there is no market price available. Why? Because you are the only one manufacturing such a kind of intermediate product. Is that clear? Right. So that's it, guys. Okay. Now let's have a look into this particular sum. A manufacturer of cornflakes has two divisions, one producing the cornflakes and another packaging division that manufactures cartons. The production division purchase all the cartons from the packaging division. Cost of cartons from outside vendors would be, so you've got number of cartons and the cost over here. Production cost incurred by the packaging division for similar volume of cartons, 5,000, and this value is also given. And as you can see, the volume, total cost excluding the cost of cartons means what? This is further processing cost. Okay, which means it is the cost of the receiving division. Okay, receiving division only. Sale value, that is the final sale value of the receiving division, is also given. An appropriate transfer pricing policy is being framed as the corporate management accountant. Transfer pricing based on first one, shared profit relative to cost method, second one, market price method, and also he has asked you to show profitability of each division under both the methods, and finally discuss the effect of both the methods on the profitability of those divisions. Okay, so let's do this. Right, Nana. So what is that he has asked you? You need to fix TP based on two different methods. Okay, one is shared profit related to cost method. So what do you mean by this? You need to share your profit in proportion to the cost. So from this, what you have to understand is that first I need to calculate total profit for the company as a whole. Once I calculate total profit for the company as a whole and total cost for the company as a whole as well as the individual divisions, then only I can share profit in relation to cost. So that will be your step one, where you want to calculate the profit of the company as a whole and the total cost of the company as a whole. So once you are done with it, you can fix your TP based on shared profit relative to cost method. And market price method, there is nothing much because this is a copy paste. That's it. You will take the market price, you will copy paste it. That will be your TP. And once you are done with fixation of TP, you need to calculate profitability under both the methods for both the divisions under two different levels of cartons. That is 5,000. Other one is 8,000. So if you can see, that's what we have done here. Calculation of total profit and total cost for the company. So first we started with 5,000 units. Revenue, there will be no revenue for the supplying division. So I have put dash over here. And receiving division has got the real revenue. That is nothing but total revenue for the company as well. And cost, both the divisions have got cost at 5,000 units level. Copy paste from the question. And I've got total cost because I need this for calculating TP based on shared profit relative to cost method. And I've got profit for the company as a whole. So similar stuff, I have to do it for 8,000 units as well. And I've done it for 8,000 units as well. You got it? Now, if you look at how do I fix TP based on shared profit relative to cost method for 5,000 units. TP is equal to variable cost plus share of profit, obviously. So you need something up and above variable cost for the supplying division to get motivated to manufacture and internally transfer. So variable cost is 75,000, that is there in the question. Share of profit is nothing but, as you can see, this is the cost of supplying division, which is 75,000 divided by total cost, that is 1,95,000. So that much of proportion. How much is your cost proportion? That much proportion of the profit you will get share, right? So 75,000 is the cost of the supplying division out of the total cost into total profit. This much of share of profit he will get. So total TP will be 76,923. Same logic applies for 8,000 units as well. Now calculation of TP based on market price is very simple. Okay, you just copy paste the numbers from the question. So once you are done with calculation of TP, now we need to calculate the profit at both 5,000 units level and 8,000 units level. First, we'll calculate profit based on shared profit related to cost method. So what are you going to do? You're going to take the revenue. You know that revenue is nothing but transfer price, correct? For supplying division and receiving division, it is there in the question, copy paste. Reduce cost. You'll have two types of cost for the receiving division, but only one cost for the supplying division. Okay, which is variable cost for the supplying division. But for receiving division, you'll have the TP, which is intermediate product purchase cost. Also, you'll have its own cost, which we call it as further processing cost. And you calculate the profit. Got it? Same stuff you follow for 8,000 units. And the same way you have calculated for shared profit related to cost method, you're going to calculate the same for market price method. Is that clear? For 5,000 units as well as 8,000 units. So the calculation will be pretty simple and straightforward. Okay. Now, what is most important in this particular question is the second part analysis, where you got to discuss the effect of both the methods on the profitability of the division. So this is very important for us. We'll focus on that right now. Okay. Now, so if you can observe all these numbers over here, right? Especially look at the profits. Based on shared profit related to cost method at 5,000 units level, the profit is 1923 and 3077, correct? Keep this in mind. Now, if you look at market price method also at 5,000 units level, okay, the profit is pretty much same. It is 2,000 and 3,000. Okay, here it was 1923 and 3077. So it's exactly the same, no problem whatsoever. But if you look at 8,000 units level, here the profit is 12,308 and 27,692 based on shared profit related to cost method. Whereas if you look at market price method, it is 15,000 and 25,000. So there is a lot of difference. Are you able to understand why such a difference has happened? So that we need to analyze. Well, if you analyze that, let us look at the analysis. What we have done at 5,000 units, we have calculated the cost of supplying division. Supplying division total cost was 75,000. That was for 5,000 units. Thereby, cost per unit is 15. Whereas at 8,000 units level, the supplying division cost is 80,000 and it was for 8,000 units. Therefore, the cost per unit is 10 only. So there was a drop in cost of 33.33% for the supplying division. Whereas when it comes to receiving division, its cost at 5,000 units level was 24 per unit and its cost at 8,000 units level was 22.50, which means it has got dropped by only 6.25%. So which means what is happening over here is my supplying division profit has got dropped by 1/3 and my receiving division's profit has got dropped by only 6.25%, which means at 8,000 units level, my proportion of cost of the receiving division is more when compared to supplying division. So therefore, when you try to fix TP based on proportion of cost, more the proportion of cost, more will be your profit share. Therefore, receiving division has got more share of profit when compared to the supplying division. So ultimately, supplying division has got punished for saving lot of cost. Are you able to understand? Chalo, have a look into this. You got the logic over here. So that is what has happened here. That is what the explanation this guy has given here. Okay, this whole paragraph. You understand the point? So the logic is very simple. What he tries to explain you is that when you try to share your profit based on shared profit related to cost method, so what will happen is that when supplying division has reduced its cost by 1/3, that is 33.33%, its cost has got reduced and therefore its proportion of the cost when compared to the total cost proportion has got further reduced. Therefore, it has received lesser share of profit. Therefore, its profit has got reduced, which has come to 12,308 as per 8,000 units. Are you able to understand? Whereas coming on to production division, because its cost has got reduced only by 6.25%, its share out of the total cost, its cost share out of the total cost is more. Therefore, it has received more share of profit. and thereby its profit has got increased, and that is the reason as per shared profit relative to cost method, it is 27,000 is the profit for production division and 12,000 is the profit for package division versus 15,000 and 25,000 as per market price method. So we will explain this and we will leave it like that. We are not going to pass any judgments because that has not been asked in the question. Now this is very important for you. Always try to understand when something has not been asked in the question, you guys should not give too much of answers, and that will irk the examiner, and thereby that will give you definitely few loss of marks. Is that clear? I hope that's clear. Okay, chalo. Let's move on to the next question. Let's move on to the next question, guys. So Division A transfers goods to Division B. Division A incurs a marginal cost of 10 per unit. Division B incurs marginal cost of 5 per unit. Division B sells finished product externally at 20 per unit. To promote goal congruence, what should be the minimum TP that Division A should charge? Assume there is no external market for this intermediate product. Now always understand something, Nana. I'll give you a simple trick. So you have two things. One is minimum transfer price. Other one is maximum transfer price. Minimum transfer price, always think from supply division's point of view. Okay. Maximum transfer price, always think from receiving division's point of view. Why? Because supply division is the one who is going to incur the cost. Therefore, minimum selling price, you should give the importance towards supply division, and you should fix your minimum TP more than the cost that has been incurred by the supply division. When it comes to maximum TP, always think from receiving division's point of view, because receiving division is the one who is going to buy the goods. Therefore, you need to see whether receiving division has got sufficient money to buy the goods. That is nothing but NMR, net marginal revenue, which is nothing but how much is the money that receiving division has got. Okay, generally the concept goes this way. Minimum TP is equal to relevant cost of the supplying division. Relevant cost can be anything. It can be variable cost or it can be variable cost plus opportunity cost. Maximum TP is equal to the money that receiving division has got, which is nothing but NMR, net marginal revenue, or external buying price, whichever is less will be your answer. Why? Because if you think from receiving division's point of view, what will be his thought process? I will purchase either, I'll give you maximum price, either with respect to the money that I've got or whatever the money that I pay to the external vendor. Suppose I'm trying to buy from external vendor at 50 rupees and internally supply division says that I will charge you 55. He will say, I'll not buy you from 55. I'll not buy at 55 from you. I'll buy from outside at 50. It's as simple as that. Are you able to understand? So the concept is very simple. When it comes to supply division, the minimum TP is the relevant cost, which can be either variable cost or marginal cost, or variable cost or marginal cost plus opportunity cost. Coming on to the maximum TP, which you need to think from receiving division's point of view, which will be either NMR. NMR is nothing but the money that receiving division possesses, net marginal revenue, or the external buying price, whichever is less. Got it? Chalo. Now, so to promote goal congruence, what should be the minimum transfer price that division A should charge? Assume there is no external market for the intermediate product. When there is no external market means there is no sacrificing of external sales. When you don't sacrifice external sales, there is no benefit lost. When there is no benefit lost or contribution lost, there is no opportunity cost. Therefore, your minimum TP, which you need to think from supply division's point of view, will be variable cost. In this case, the variable cost is how much, Nana? 10 rupees. So 10 rupees will be your answer. If division B can buy the intermediate part externally, in one case 14 per unit, division B means receiving division. 14 per unit in one case, 18 per unit in another case from the outside vendor, what should be the maximum TP that division A can charge to remain competitive with the external vendor? Are you able to get me? Now very simple here. Maximum TP. You need to think from whose point of view? Receiving division's point of view. I told you it is NMR, that is the money that receiving division possesses, or external buying price, whichever is less. Now let's take the first situation where external buying price is equal to how much? 14. Now let's calculate NMR, that is the money that receiving division possesses to buy from the supply division. Receiving division sells externally at 20 per unit and receiving division's own cost is 5 rupees. So it sells at 20 rupees externally minus it has its own cost, which is 5 rupees. So the money it has got in its pockets is 15 rupees. So 15 rupees, that is NMR, or 14 rupees, whichever is less. So the answer will be 14. Now in case if your external buying price is 18, that is this scenario. Anyway, its NMR will not change, which is 15. So whichever is less, the answer will be 15 in the second case. Okay. So the maximum TP will be 14 in the case of the first one. The maximum TP will be 15 in the case of the second one. Are you able to understand? I'm going at a very brisk pace. Why? Because we have to revise as early as possible. Are you able to understand? In the shortest time. That's why. So this is a rapid revision for people, okay, who wants to cover the entire chapter within 1.5 hours. approximately. Okay, right, chalo. Next, coming on to the next one. Assume that intermediate goods of division A can be sold externally, okay, at 12 per unit. How does this opportunity cost affect the transfer price range when division B can procure the part externally at 14 per unit? Okay, now the logic is pretty simple. Division A is selling the product externally at 12 per unit. Variable cost of division A is how much, Nana? 10 per unit, which means its contribution is 2 per unit. So minimum TP is nothing but relevant cost of the supply division, which is nothing but variable cost plus opportunity cost. That is equal to variable cost is 10 plus opportunity cost is 2, which is nothing but contribution lost. That is equal to 12. That will be your minimum TP. Maximum TP, you need to think from external divisions perspective. So when you think from external divisions perspective, it has got its own money, that is NMR, which is 15, which we have already calculated. And external buying price is how much? 14. So whichever is less means the answer will be 14. So maximum TP is 14 and minimum TP is 12. That will be your answer for third part of the question. Got it, guys? Right, guys, let's move on to the next example. That is this one. Okay. So all of you guys keep your study material with you. Okay. Everything I'm doing it from the new study material. Okay. Keep that with you so that it will be easy for you to follow. Right. So a company has two divisions, A and B, making products A and B respectively. One unit of A is an input for each unit of B. B has a production capacity of 45,000 units and a ready market. Other information available regarding division A are: you got capacity, which is 50,000, maximum external sales is 30, fixed cost up to 30,000 units. Okay, beyond 30,000 it increases by 50,000 for every 10,000, that is given. Variable manufacturing cost per unit 55, variable selling cost for external sales is 10, variable selling cost for special order or transfer to B is 5. So this is a point that you have to note. Always external sales, whatever the selling expenses that you incur on external sales will be high when compared to the selling expense on internal transfer. Selling price for the external market is 80. For special sales it is 70. So B can buy the input A from outside at a slightly incomplete stage at 45 per unit and will incur subcontracting charges of 30 per unit to match it to the stage at which it receives the goods from division B. It receives the goods from division A. Division B is willing to pay a maximum of 75 per unit. Division A supplies its entire demand of 45,000 units. Okay, in case if the entire demand of 45,000 is met, then division B is willing to pay 75. Otherwise, it will pay only 70. Division A has also received a special order of 15,000 units. Either you can accept that in full or reject. Division A may choose to avoid variable selling cost of 5 per unit on transfer to B or special order, that is internal transfer or special order, by incurring a fixed cost of 50,000 instead, right? So you have two options. What is the best strategy of division A? Show the profitability of that option. What will be the range of TP B under if the best strategy is chosen? Okay. Now, very simple logic. If you want to choose best strategy, it is that strategy which gives you maximum profit or maximum contribution, right? Now, because there is no limiting factor in this particular question, we can easily say that we need to find contribution per unit to give this particular answer. That is the best strategy, because that option which has got highest contribution per unit will be the best strategy. As simple as that. Now, how to find contribution per unit? Very simple. Now, let's calculate contribution per unit for various options of division A. One is external sales is one option. Special order is another option. Coming on to internal transfer, you have two options. Less than 45,000, because he will be paying only 70, is equal to 45,000. He'll be paying what? 75. And then we need to calculate contribution. So it's very simple and straightforward. Manufacturing variable cost, copy paste from the question. Coming on to selling and distribution, on external sales, you'll incur 10. Whereas on internal transfer or special order, you have two choices which is given in the question. Either you can incur 5 rupees or you can incur what? 50,000. Now, how to decide which one to go for? Here, you need to apply the concept of indifference point. So that's where your concept has to click in your mind. Now, see here. So decision regarding 5,000 or 5 rupees per unit, which is nothing but 50,000 or 5 rupees per unit. Selling and distribution cost with respect to internal transfer or special order. For this, you need to apply the concept of indifference point. Okay, how? Why? Because in one option, you need to incur a high fixed cost and variable cost will be nil, which is low. In another option, your fixed cost will be nil, but your variable cost will be high. So when you have this sort of a situation, it is an ideal situation where we need to apply indifference point, where in one option, fixed cost is high and variable cost is low, and in another option, fixed cost is less and variable cost is high. Now, if you can see indifference point, the formula is pretty simple. Change in fixed cost divided by change in variable cost per unit. That is obviously the concept. Two options having different fixed cost and different variable cost. So naturally, the formula will be change in fixed cost divided by change in variable cost per unit. So in one option, so what is change in fixed cost? 50,000 minus 0, and change in variable cost 0 minus 5 rupees per unit. And you got your indifference point as how much? 10,000. So if it is less than 10,000, if it is less than indifference point, go for that option which has got low variable cost. Are you able to understand? Go for that option which has got low fixed cost. Is equal to indifference point, go for that option which has got either of the options should be fine for you. And greater than indifference point, go for that option which has got high fixed cost. This is generally the concept. So you should know the indifference point concept. Is that clear? So less than indifference point, always you'll go for that option which has got low fixed cost. Because your sales is less, you cannot take risk by going for that option which has got high fixed cost, because you may not recover that high fixed cost. Okay, therefore you will go for that option which has got low fixed cost. Is equal to indifference point, because that is the point at which either of the options will give you same profit. So whichever option is okay for me. Greater than indifference point, because my sales is so huge, my fixed cost would have been recovered completely. Therefore I'll go for that option which has got low variable cost. Incidentally, low variable cost option is nothing but high fixed cost option, because if you want to reduce your variable cost, you have to invest in fixed cost. That is a relationship. Anyways, so finally here, this is the situation. Now we need to analyze the situation over here. Your external sales is how much? 30,000. Your total capacity is 50,000. So there is a balance in capacity of 20,000. In this 20,000, what you will do? Either you will go for a special order of 15,000, or you will go for an internal transfer of 20,000. Are you able to understand? In the balance 20,000 capacity, presuming that you will do an external sales of 30,000. So which means in both the cases, it is greater than the indifference point of 10,000. Therefore, I'll go for 50,000 fixed cost option instead of going for 5 rupees variable selling cost option on my internal transfer as well as special order. Therefore, 50,000 option is chosen. And therefore, here when you are calculating your variable cost, you did not take 5 rupees here and you have left it blank. And finally, we have calculated our contribution per unit, which came 15, 15, 15 and 20. And therefore, this is the highest option. Which one? Internal transfer of complete 45,000 units to the receiving division. So therefore, finally, the best strategy will be internal transfer of 45,000 plus what you will do with the balance 5,000 units. These two options are mutually exclusive. Either you will do internal transfer which is equal to 45,000, or you will do internal transfer which is less than 45,000. So once you have selected an option to do internal transfer of 45,000, automatically this gets eliminated. Then only two options are available for you. One is external sales, other one is special order. Special order is like either you accept in full for 15,000 or you reject completely. Here I've got only 5,000 unit capacity left, because 45,000 I'm going for internal transfer. Therefore this option is also not possible. That's why I go for external sales. So finally, the best strategy is go for internal transfer of 45,000 units and external sales of 5,000 units. Got it? Chalo. And then you can just calculate profitability of that best strategy option. So 45,000 units into 20 rupees we have calculated here. Multiply with, you'll get the total contribution. And 5,000 units of external sales, you got the contribution over here, which is 15. You multiply that, you get your total contribution. Reduce your normal fixed cost, which is 4,30,000. Plus every 10,000 units increase in capacity, it will increase by 50,000. So earlier your capacity were 30,000, now it is 50,000. So 30,000 plus 10,000 units incremental for that 50,000, another 10,000 units incremental for that another 50,000. So totally 1 lakh will be the additional fixed cost in addition to 4,30,000. Total fixed cost will be 5,30,000 plus you have chosen based on indifference point that you are going to incur a fixed selling cost of 50,000 instead of variable selling cost of 5 rupees per unit, and therefore that 50,000 also you need to include over here, and finally you get a profit of 3,95,000. So that is the answer for the first part of the question. Coming on to the second part of the question, what will be the range of transfer price be under if the best strategy is chosen? Very simple. How to fix your TP? You need to have minimum TP as well as maximum TP. Now coming on to minimum TP, pretty simple. See here. Minimum TP is nothing but I told you so many times, variable cost plus opportunity cost. Now what is the opportunity cost over here that we need to understand? Now see Anna. What is the option that you have chosen? Internal transfer of 45,000 and external sales of 5,000. This is what you have chosen. What are the alternatives that is available? If you have not chosen this particular option, you could have gone for external sales of 30,000 units, special order of 15,000 units and internal transfer of 5,000. That is one option available. Or you could have gone for external sales of 30,000, And instead of special order, you could have gone for internal transfer, which is less than 45,000. That option is also available. In this case, it will be 20,000. So these are all two alternatives available apart from the best alternative which you have chosen. Now, why did you go for best alternative? Because it is giving you 20 rupees contribution for 45,000 units and 15 rupees contribution for 5,000 units. Whereas the alternative options are giving you only 15 rupees for the entire 50,000 units. Therefore, you went for this particular option, which means by going for this particular option, you have lost a contribution of how much? 15, and that becomes your opportunity cost. Are you able to get me? Right. Which means next best alternative. Opportunity cost concept is that only, na? Whatever the contribution or the benefit that you have lost from next best alternative. When compared to this particular alternative, there are two alternatives which is going to give you the same contribution of 15. Are you able to get me? So therefore, minimum TP is nothing but variable cost plus opportunity cost, and you add the opportunity cost 15 and your minimum TP will be 70. Okay, coming on to maximum TP, it is nothing but external buying price in this case. If you look at the question, he can buy from outside at 45 plus he has to incur 30 rupees. So total cost will be 75. If you keep anything more than 75, he'll buy from outside. He will not buy from you. Therefore, the maximum TP has to be 75. And some of you might have got a doubt, sir, what about the incremental fixed cost? Here you have calculated, na, incremental fixed cost of 1 lakh. Because it is additional, na, why didn't you add it when you are calculating what? Minimum TP. Now, we did not add it. Why? Because in all the options, your fixed cost is going to be 5,30,000. So it is not incremental. It is normal for all the options. This option it is 5,30,000 because you are using the entire 50,000 capacity. This option also it is 5,30,000. This option also it is 5,30,000. So when in all the options it is 5,30,000, there is no such thing called incremental. So in one option, suppose it is 4,30,000 and in another option, it suppose it is 5,30,000, then you'll be adding it as incremental. Whichever option that you choose, anyway, you're operating in all the options at 50,000 capacity only. So there is no such thing called incremental over here. So I've written here, see, division A will work on full capacity irrespective of the options. Therefore, manufacturing fixed cost outlay will be the same, which is 5,30,000, right? Therefore, the impact of additional outlay of fixed cost, which is 1 lakh on minimum TP will be nil. That's the reason I did not consider that. You got the point, right? Chalo. So we are done with this particular problem. Let's move on. Next one is proposals for resolving transfer pricing conflict. What do you mean by this? See, sometimes you will have a transfer pricing conflict where the divisional managers will not accept or agree for any transfer price whatsoever. They'll keep on fighting because the logic is very simple. Every individual divisional managers wants his profit to be more. So therefore, he will not accept any decision which will reduce his profit even though it is in the interest of the company. So this sort of a situation where individual divisional managers are not agreeing for a decision which is in the interest of the company, we call it as goal conflict situation. So to solve this sort of a situation, we have two solutions with us to resolve transfer pricing conflicts which affects the goal congruence. One is dual rate transfer pricing system, other one is two-part transfer pricing system. Now when compared to what has been explained over here, I'll try to explain you in a very simpler way. Thereby you can answer this case scenario also. This case scenario also, the solution for this case scenario is dual rate transfer pricing system as well as two-part transfer pricing system. So we'll cover that as well. Okay. Chalo, now see here. So what do you mean by this dual rate transfer pricing system? You'll have two rates, two different TPs. What are they? Supply and division in its books, it will write TP is equal to variable cost per markup. Let's take an example that variable cost is 10 rupees. And let's say markup is 2 rupees. It will write in its books as 12. Which one? Supply and division. Receiving division in its books, it will write TP as 10 rupees only. So there will be two TPs. That's why it is called dual rate. 12 rupees is one rate, 10 rupees is another rate. So now supply and division is happy. Why? Because it has got markup. So its profit will look healthy. So it is happy. It will get incentives. Receiving division is also happy because its cost is less, thereby its profit also will get increased. So it will also get incentives. So he is also happy. So therefore the transfer pricing conflict is resolved, and this sort of resolving transfer pricing conflict, we call it as dual rate TP system. Coming on to two-part TP system, what will happen is that here, if you look at the title, it is two parts. As a receiving division, I will give compensation to the supplying division, and my compensation will be of two parts. One part I'll compensate for the variable cost that is incurred by the supplying division. Another part I'll compensate for the fixed cost that is incurred by the supplying division. Normally, supply and division will not accept the transfer price which is equivalent to the variable cost. Why? Because it wants something up and above its variable cost, because there is something called fixed cost which has to be recovered. Are you able to get me? And that particular problem will be covered in two-part transfer pricing system, and that will be one of the reasons for conflict. Okay. So let's say supply and division's total capacity is 50,000. I just gave you example to make you understand this concept easily. So let's say total capacity of your supply and division is 50,000. And let's say external sales versus internal transfer is in the ratio of 4:1. So you are selling 40,000 units externally and 10,000 units internally. Let's say your variable cost per unit is 20. Whose variable cost? Supply and division's variable cost. And fixed cost is 1 lakh. Okay. Now look at the situation. Your fixed cost is 1 lakh, right? Your external sales is to internal transfer is 4:1, which means 4 parts of your fixed cost you recover from outside, from your external sales. And 1 part of your fixed cost you can recover from inside, that is internal transfer, which is 20,000. Therefore, finally TP is equal to 2 parts. One is compensation towards variable cost, other one is compensation towards fixed cost. Variable cost is nothing but 20 per unit into 10,000 units. Fixed cost compensation is 20,000, which you have calculated here. Okay. And finally, 2,20,000 will be your lump sum consideration. This two-part transfer pricing method can also be called as lump sum consideration. Are you able to understand? Where one part which compensates variable cost incurred by the supply division, another part which compensates the fixed cost. Are you able to understand? So this we call it as two-part transfer pricing system. Okay. Got it, guys? Right, guys, let's move on to the next concept, that is international transfer pricing. Chalo, see here. Why there is something called international transfer pricing? That is due to MNCs. Are you able to get me? Pretty simple. Now, why there is a concept called multinational companies? Why the companies have got their establishment in multiple countries? It is either because of availability of resources. For example, raw material is available in a particular country, thereby I'll have an establishment over there. Or cheap labor is available, for example, China. Or ease of doing business, that is also China. Okay, in India it got improved recently. Demand for finished goods, this is one of the reasons why India is attracting FDIs. Okay, please try to understand, we are not getting foreign direct investments just because we have ease of doing business or cheap labor. Our labor is not as cheap as China, to be very honest, not even as cheap as Philippines. But why are we getting a lot of investments? Why are we getting it attracted? Because if a particular company makes an establishment in India and it manufactures cars or bikes, for example, it can sell in India itself because there is that much of sufficient domestic demand in India itself. That is one of the major reasons why we are attracting a lot of foreign investment. Anyways, so now why do we need TP here when it comes to international transfer pricing? There are two reasons. One is taxation, other one is profit remittance. Taxation means you guys already have an idea. So when there are group companies where you have a holding company in US and subsidiary in India and China, they want to set up the international transfer in such a way that the overall tax payment for the group as a whole should be at its minimum. Profit remittance rules means, for example, you have KFC over in India and it has got a lot of establishments. Ultimately, its parent company is in US, and whatever the profit that it has earned in India, it wants to remit it back to its source, right? Which is nothing but in the US. So that we call it as profit repatriation or profit remittance. Are you able to understand? So whichever country where the profit remittance or repatriation rules is easier, in that country, they will ensure that the profit is high. Accordingly, they'll fix the TP. That is the whole concept over here. Same logic applies to taxation as well. Whichever country where the taxation is less, in that particular country, they will ensure that either whether there is a supplying division or receiving division doesn't matter. In which country where they have less taxes, in that particular country, whatever the division they have got, they would like that particular division to earn more profit such that they will pay less taxes. Coming on to profit remittance rules, whichever country where they have easy rules with respect to profit remittance, they would like that particular country's division to earn more profit such that they can transfer the profit to their source company, which is in US, in an easier way. Are you able to understand? That's how the whole logic of international transfer pricing goes. Chalo. Now let's try to solve the first example. A car manufacturing company has two manufacturing divisions in different countries. Division A in India manufactures engines for the cars. It has the capacity to manufacture 10,000 units in each year. The variable cost of production is 8,000. It can sell 8,000 engines externally to customers within India. at 11,000 per unit. The other division, Division B, is in Italy that requires 5,000 engines every year to assemble them further into cars. It purchases these engines from a vendor in Italy at a price that is equivalent to 9,000 per unit. If Division B were to purchase these units from Division A, the transfer price would be 10,000 per unit. Since no selling expense need to be incurred on internal sales, variable cost on such transfers would be 7,000 per unit. If Division A accepts the internal order from Division B, it will have to curtail some of its external sales. Given that the tax rate is 30% in India and 40% in Italy, determine if the company will benefit overall if Division B purchase from Division A. That is the question. Obviously, it will benefit easily, you can say. Why? Because if you can see, Division A is not losing anything. Anyway, we'll see the calculation, you'll understand. See here. First of all, let's calculate benefit to Division A, then we'll calculate benefit or cost to Division B, then we'll set up both of them and we'll see what is the overall benefit from the company's point of view. Existing external sales of Division A is 8,000 units, it is selling to outside. Okay. So if the internal transfer of Division B is accepted, then Division A has to sacrifice 3,000 units of external sales. So thereby the sales mix will be external sales of 5,000. Earlier it used to be 8,000, but 3,000 has to be sacrificed because only then you will be able to transfer internally 5,000 units. So after the sacrifice of 3,000 units of external sales is done, the sales mix of the supplying division, that is Division A, will be external sales of 5,000, internal transfer of 5,000. Now contribution that it is getting from external sales, it is selling at 11,000 and its variable cost is 8,000, which is 3,000. On internal transfer also it will be 3,000. Why? Because even though you are selling at 1,000 less, your cost also will get reduced by 1,000. Thereby your contribution remains same. So from this, what you guys need to understand is, even though Division B has sacrificed 3,000 units of external sales, it has got compensated in the same way from internal transfer of not only 3,000 but 2,000 units extra. So therefore, gross benefit for Division A is equal to 5,000 into 3,000, 5,000 into 3,000. Whether it is external sales or internal transfer, its contribution is same. Earlier, it used to get only 8,000 units, which is external sales, and it used to get 3,000 as contribution per unit. But now it is getting 10,000 into 3,000. Therefore, additional 2,000 units contribution as a what into 3,000. So there is a gross benefit of 60 lakhs. Whenever there is a gross benefit, that is inflow, you need to pay taxes at 30%. Thereby, your net benefit will be 42 lakhs. Okay. So ultimately, for supplying division or Division A, there is a net positive benefit of 42 lakhs. Now coming on to the receiving division, if you can see, additional cost for receiving division because it is buying from Division B will be 1,000 rupees extra. Because earlier it was paying only 9,000, but now it has to pay 10,000. Therefore, for every unit it has to pay 1,000 extra for 5,000 units. So therefore, it has to pay 50 lakh extra. So we cannot say there is a total loss of 50 lakhs. Why? Because when there is loss, you'll be having tax benefit because that loss will reduce your taxable profit. To that extent, you'll pay less taxes. So the tax benefit is 40% in that particular country. Therefore, the net loss is only 30 lakhs. So for Division A, there is a net benefit of 42 lakhs. For Division B, there is a net loss of 30 lakhs. So overall benefit for the company will be 12 lakhs positive. Since there is a positive net benefit of 12 lakhs, Division B should purchase engines internally from Division A will be your final answer. Got the point, guys? All of you, I hope this is clear. Right, guys, let's move on to the next question. So this is question number 1 over here in test your knowledge. G is transferring division and R, the receiving division of the company. R has a demand for 20% of G's production capacity, which has to be first met as per the company's policy. See, 20% is of the 100% capacity, okay, because the capacity is 100%. State with reason which division G or R enjoys more advantage in each of the following independent situations, assuming that there is no inventory buildup. First one, G transfers to R at a transfer price equal to full cost. There is no markup. This will be your TP. G's production level is 60%. Always remember, fixed cost will be related to the level of the production that you are operating right now. So even though your capacity is 100%, you are operating at a production level of 60%. So fixed cost will be equivalent to that particular capacity, which is 60%. External demand is 40% of the total capacity. All these percentages are percentage of the total capacity. Okay. So total capacity is 100%. Out of that, he is operating at 60%. Okay. Out of the total capacity, 40% is the external demand. And out of the total capacity, 20% is what the internal transfer they are planning to happen. So which division will have more advantage? Is it the supply division or the receiving division? Now, here you are transferring at TP, which is equal to full cost. Thereby, supply division, that is G, will be at more advantage. Why? Because G is recovering its full cost, full fixed cost because of additional internal transfer of 20%. Chalo, see here. G is at advantage because even though the current production level of G is 60%, to which fixed cost is related, okay, because that's the production level that it is operating right now. It is selling only 40% to the external market. Therefore, only that portion of its own fixed cost is getting recovered due to external sales, and the balance fixed portion is not getting recovered. So by transferring 20% of its own production capacity, of its total production capacity to division R on full cost plus basis, what is the advantage? G will be able to recover all of its fixed cost. Are you able to understand? So ultimately, the division that will be at its advantage is G. Now, coming on to the next one. Market price. If G is transferring to R at a market price and G's current production level is 80% and its external demand is only 60%, you can easily guess again G will be at its advantage. So what is the reason behind that? G is operating at production level of 80% but only able to sell only 60% to the external market. By internal transfer of 20% of its production capacity to R, that too at market price, it is not only recovering its fixed cost, but also it is getting some markup. So ultimately G is having absolute advantage. Next, marginal cost. If you transfer internally at marginal cost, when your production level is 100% and your external demand is what, Nana? 80%. So who is at advantage? Obviously in this case, obviously R is at advantage. Why? Because R is getting at the least cost possible. Always the least cost possible is marginal cost. And with respect to G, it is transferring 20% capacity to R, but it is recovering only marginal cost. So it is not recovering fixed cost. It is not getting any sort of markup. So whether it transfers the 20% at marginal cost or it doesn't transfer, it doesn't make any difference for G. So G will remain the same. Therefore, G is not getting any sort of advantage. R is getting advantage. Have a look at this. G is operating at current production level of 100%. External sales demand is only 80%, which implies that only 80% of its fixed cost is getting recovered. By internal transfer of 20% of production capacity at marginal cost, division G is not able to recover its total fixed cost. On the other hand, division R is able to get its intermediate product from division G at marginal cost itself, which is the lowest possible price, which I have told you. So from this whole setup, ultimately division R is getting the advantage, not division G, because division G is neither recovering its fixed cost nor it is getting any sort of profit markup. Coming on to the last setup, that is market price. Okay, if you transfer your internal product at market price, when you are operating at 100% production level, okay, and your external demand is 90%, who will be at advantage? Again G, not R. Why? You can say, sir, 20% it has to transfer internally. So the capacity that is left over is only 10%, which means it has to sacrifice external sales of 10%. Yes, but really it is not sacrificing anything. Why? Because it is transferring at market price only, na? So even if external sales is sacrificed at 10%, internally also it is transferring at market price only. So ultimately division G will not lose anything. Instead, it will gain because of that sacrifice. It is able to utilize the additional 10% of its capacity. Now what will happen? 80% will be your external sales and 20% will be your internal transfer at market price only. So in fact, virtually it is using 100% of its capacity at market price. Earlier only 90% of its capacity is being sold at a market price. Therefore, G will be at its advantage. So G is currently operating at production level of 100%. External sales is 90%. Internal transfer is 20%. So for that, G has to sacrifice 10% of its external sales. But since internal transfer price is also market price, G does not lose anything. Instead, G is able to sell additional 10% of its capacity at market price. Therefore, from this whole setup, who is at advantage? G is at advantage. Got the point? Right, guys, let's move on to the next problem. So B Limited makes 3 products X, Y and Z in divisions X, Y and Z respectively. The following information is given. So you have direct material excluding material X for divisions Y and Z, which means this is further processing cost of Y, this is further processing cost of Z. Okay, direct labor, variable overhead per unit, selling price to outside customers, existing capacity, maximum market demand, additional fixed cost that would be incurred to install additional capacity, and maximum additional units that can be produced by additional capacity. Right, Nana. So maximum external market demand of units is 5,000, 5,500 and 5,000. Okay, additional fixed capacity that would be incurred to install additional capacity is given. How much additional capacity is also given. Y and Z need material X as their input. Material X is available in the market at 23 per unit. Defectives can be returned to suppliers at their cost. Division X supplies the material fee free from defects and hence is able to sell at 25 per unit. Okay, so it is able to sell at a premium. Each unit of Y and Z requires 1 unit of X with slight modification. If Y purchased from outside at 23 per unit, it has to incur 3 rupees per unit. So the total modification cost, total cost inclusive of modification is 26. If Y purchased from division X, it has to incur in addition to the transfer price 2 rupees per unit to modify it. If Z gets the material from division X, it can use it after incurring a modification cost of 1 rupee per unit. If Z buys material X from outside, it has to either inspect and modify it at its own shop floor at rupees 5 per unit or use idle labor from division X at 3 per unit. Division X will lend its idle labor as per Z's requirement even if Z purchases the material from outside. The transfer price are at the discretion of the divisional managers and will remain confidential. Assume no restriction on quantities of interdivisional transfers or purchases. You are required to discuss with relevant figures the best strategy for each division and the company as a whole. That is the question. See, understand one thing. So, best strategy means obviously there is no limiting factor over here. Obviously, we can say capacity is a limiting factor, but obviously we're going to find out contribution per limiting factor, which is nothing but contribution per unit. So ultimately, our first step is calculation of contribution per unit. How many columns are we going to get? Now that will be a challenge. So particulars, X, Y and Z, 3 broad columns. Below that, X will be making external sales, X will be making internal transfer. Under internal transfer, you'll have internal transfer to Y, internal transfer to Z. Are you able to understand? So X, Y, Z. Under X, external sales, then internal transfer to Y to Z. Are you able to understand? Under Y, it will buy from X, it will buy from outside. So for that, 2 columns. Under Z, it can also buy from X, it can also buy from outside. Are you able to understand? Like this, you need to frame the columns first of all. Once you are able to frame the columns, rest is all about having your mindset and then solving the sum. Okay, once you have read the sum clearly, your answer will be, I think it should be quite simple. Anyways, now. So now see here guys, so that's what I've written. The division X, Y and Z. Under division X, you have got external sales and internal transfer. Under the internal transfer, you have got internal transfer to Y, internal transfer to Z. When it comes to division Y, it can buy from outside, that is external vendor. It can also buy from inside. So 2 columns. Coming on to division Z, I have written only buying from inside, although there is a possibility to buy from outside. What is the reason behind that? I'll explain you later. Because obviously it's better to buy from inside than to buy from outside. That I have visualized it the moment I've read the question. That's why I've written 1 column. If you are not able to visualize it that way, you can write 1 more column also. It's okay. It's fine. Chalta hai. Now obviously your target is to calculate contribution per unit. So obviously what you will do, selling price minus all variable cost will give you contribution per unit. Simple. Let's start with selling price. Division X is making external sales. So obviously it is 25 given in the question. When it comes to internal transfer, it is 24. Why it is 24? The logic is very simple. Division Y can buy from outside vendor at 26. How? 23 it can pay plus 3 rupees will be the modification cost. So the total cost that will be incurred for division Y is 26. Which implies that for internal transfer or for internal buying from division Y, it will not pay anything more than 26. Correct? Right? Logic is very simple. It can buy from outside. So external buying price is 26. Which is 23 plus 3 rupees of modification cost, which means from internally also it will not pay anything more than 26. That's obvious. So if it buys at a price of 25 and it requires a modification cost of 2 rupees, even from internal transfer also, then its total cost will become 27. So it will not accept 27 when it can buy at 26 from outside. Therefore, to keep the total cost at 26, the transfer price cannot be more than what? 24. That is the reason we have written the selling price or the transfer price as 24, then only it is 24 plus 2 rupees modification cost, it will be 26 because from outside it can buy at 26, which is 23 plus 3. Are you able to get me? Right, that's the thing. So as you can see, the intermediate product purchase cost from outside it is 23 plus 3, 26. From inside 24 plus 2, 26. Are you able to get me? Now coming on to division Z, you can transfer internally at division Z for 25. How, sir? Very simple. See here. Coming on to division Z, it has got three options. Option 1, 2 and 3. First option is it can buy from outside at 23. It can incur a modification cost of 5 rupees, and thereby its total cost will be 28. That is one option. Straight away this option is gone because it is very costly. Second option is it can buy internally from division X at a price of 25 plus incur a modification cost of 1 rupee. Thereby its total cost will be 26. Third option is it can buy from outside at 23 plus use direct labor from division X at 3 rupees per unit. Thereby its total cost can be 26 itself, which is similar to the internal transfer. But to make this option work, that is option 3. First of all, division X should have some sort of idle labor. But there is no idle labor in division X. That you can easily understand from the nature of the question. In that case, this option is also not available. So therefore, only option 2 is available. That is the reason it can buy only from division X. Therefore, here I have written only one column for division Z, that is buying from division X only. I did not write another column where it can buy from outside. I hope you have understood this particular logic. And that's why you have got 25 over here. Apart from that, remaining everything is normal. Direct material copy paste from the question, labor copy paste from the question, variable overheads copy paste from the question. With respect to intermediate product purchase cost, these three figures are nothing but these two figures. Are you able to understand? Because your internal transfer price is nothing but your, transfer price is nothing but your intermediate product purchase cost. So division Y buys from division X at 24 plus it spends 2 rupees for modification cost. So 26. If it buys from outside, it is 23 plus 3 rupees modification cost. Division Z buys from division X at 25. Okay, division Z buys from division X at 25 plus incurs a modification cost of 1 rupee. Therefore, its cost is 26. Apart from that, no other thing is required. No other thing requires your attention because everything is copy paste from the question. You got it, guys? Chalo. Finally, what is your best strategy? Obviously, for division X, first it will go for external sales because there is a lot of contribution, which is 11. Then it will go for internal transfer to division Z because it is getting maximum contribution, which is 11 again. At last, it will go for internal transfer to division Y. That is what division X will do. Division Y and Z, there is no much of a strategy over here because all its production is being sold outside only. So all its sales will be sold externally. So there is nothing much to think here when it comes to division Y and division Z because everything that they manufacture will be sold externally. There ends the matter. So best strategy for division X, right now you cannot answer. You can ask me, why, sir? Why? Because we haven't made any decision with respect to the additional capacity. Unless you have taken a decision with respect to additional capacity, whether you are going to invest in additional capacity or not, you cannot say what is your best strategy, because best strategy includes the number of units that you are going to sell outside or transfer inside. That you cannot answer without taking a decision with respect to additional capacity. Are you able to get me? So now we need to take decision with respect to additional capacity. How are we going to take that decision? Now see here. Existing capacity is 6,000, 3,000 and 3,000. Additional capacity that you can add is 6,000, 2,000 and 2,250. It is there from the question, copy paste. So total capacity after you have added additional capacity will be 12,000, 5,000 and 5,250 for the respective divisions. Okay. Now, so for division X, what will happen? What it will do with this 12,000 capacity after the additional capacity has been added? The first preference will be external sales because it has got 11 rupees as contribution. To the extent of 5,000 units, it can sell externally because that is a demand which is available outside. Second preference will be internal transfer. Are you able to understand? To division Z because it gets 11 rupees again here as well. And how much it will transfer to division Z? How much is the external demand of division Z? That much I will transfer internally because division Z will buy only to the extent of its external demand, right? Division Z can sell 5,000 units externally, which means it will buy 5,000 units internally. And last preference will go for division Y because it gives only 10 rupees. How much is left over out of 12,000? 5,000 is gone here, 5,000 is gone here, 2,000 will be going for internal transfer to division Y. Is that clear? Now, coming on to these three, how it is going to happen? Now listen carefully. This is the existing capacity, correct? 6,000. From this 6,000, from this existing capacity of 6,000, okay, external sales will go first. Just imagine first in, first out basis, okay, FIFO method. So first capacity is your existing capacity, not the additional capacity. From this existing capacity of 6,000, 5,000 external sales will go. Are you able to understand? Still, how much is left over in your existing capacity of 6,000? 1,000 is left over. That 1,000 will be utilized for internal transfer to division Z, plus remaining 4,000 will go from this 6,000, correct? Your total transfer internally to division Z is how much? 5,000. Are you able to understand? How are you going to work out this 5,000? From this 6,000, 1,000 is left over, right? Plus, from this additional 6,000, you will be utilizing 4,000. That's what I've written here. 1,000 from existing capacity, EC. 4,000 from additional capacity, AC. And then from additional capacity, 2,000 is left over. That will be utilized for internal transfer of 2,000. This is very important. This is the only challenging part in this entire question. How this 12,000 will be utilized. From this first 6,000 existing capacity, 5,000 external sales will happen and 1,000 will go for internal transfer. And from this 6,000, 4,000 will go for internal transfer to division Z. So 4,000 plus 1,000 from existing capacity. You got the point? That's what I've written here. And from this 6,000, the balance 2,000 will go for internal transfer to division Y. Last preference. Because you get only 10 rupees contribution from this. When it comes to division Y and division Z, nothing much to think. Everything they will do, it will go for external sales only. So entire capacity will be utilized for external sales, nothing much to think over here. Okay. Now once we know this, we need to take a decision whether we should invest in additional capacity or not. How to take that decision? Very simple. If I invest in additional capacity, I need to invest in additional fixed cost. That is cost for me. How much is the additional contribution that I'm getting because of additional sales, because of additional capacity? Compare both of them. Additional contribution that I get from additional sales because of additional capacity minus additional fixed cost that you have incurred. Are you able to get me? So that's what we are doing here. See here. Additional contribution that you are getting from additional capacity. This is the most challenging part. How did I calculate the 64,000? This is my additional capacity 6,000. Reverse working. How are you utilizing the 6,000? Last 2,000 you are using for internal transfer to division Y. So 2,000 into 10. 10 rupees is the contribution if you transfer to division Y. Plus in this 5,000, only 4,000 you are utilizing from additional capacity. So 4,000 into 11 plus 2,000 into 10. You got the point? That's how I got the calculation over here. Got it? And you have got this additional capacity. Coming on to Y and Z, it's pretty simple. Okay. Your additional capacity is 2,000, which means 2,000 extra sales you are making. So 2,000 extra sales into the contribution that we have calculated already here, which is 9. Are you able to get me? So pretty simple. And even when it comes to division Z also, it is pretty simple. His external sales is 3,000 from his existing capacity. And because of additional capacity, even though 2,250 additional capacity is added, he can sell only 2,000 extra because his market itself is 5,000. So therefore 2,000 he will sell extra. His contribution we already know, which is 14. So multiply with 14, there ends the matter. Okay. Now this much additional contribution you are receiving from additional capacity minus additional cost is this much. Copy paste from the question. We have got positive net benefit in all the three cases. Therefore, your decision is to go for expansion, expansion, expansion. If it is negative, we'll say stick with your existing capacity. Do not go for expansion. Are you able to get me? So finally, the best strategy is for division X, sell 5,000 units externally, internal transfer of 5,000 units to division Z, then internal transfer of 2,000 units to division Y. And division Y will buy this 2,000 units from X, and the balance 3,000 will be bought from outside. And ultimately everything will be sold externally. Division Z will directly buy all the 5,000 units, all its requirement from division X, and all the requirement, whatever that it has manufactured will be sold externally. Finally, accordingly, you can calculate profitability for your best strategy. Very simple. Just multiply with contribution, which we have calculated in the first step, reduce the fixed cost, you get your answer. Fixed cost is given in the question. Okay, fixed cost for additional capacity is given. For existing capacity, fixed cost is not given. Therefore, we are not reducing it. As simple as that. You got this, guys? All of you? Right now, I hope this one is clear. Chalo, let's move on to the next one. Take this question. Centurion Company operates a pulp division that manufactures wood pulp for use in production of various paper goods. The following information are available. Selling price is 210. Variable expenses 126, contribution is 84, less fixed expenses based on a capacity of 1 lakh is 54, net income is given, which is 30. Okay. Centurion company has just acquired a small company that manufactures paper cartons. This company will be treated as a division of Centurion with full profit responsibility, which means they're operating at full capacity, okay, and they're selling all these units to the external market. That's the logic generally when you use the word full profit responsibility. The newly formed carton division is currently purchasing 10,000 kgs of pulp per year from a supplier at a cost of 210 less 10% quantity discount, which means 189. Yeah. Centurion's president is anxious that the carton division begins purchasing its pulp from the pulp division if an acceptable transfer price can be worked out. So 3 situations are given. First one, if the pulp division is in a position to sell all of its pulp to the external customers at a normal price of 210, will the managers of carton and pulp division agree to transfer 10,000 kgs of pulp next year at a determined price? Explain with reasons. Situation 2, assuming that the pulp division is currently selling only 60,000 kgs of pulp each year to outside customers at a stated price of 210 per kg, will the managers agree to mutually transfer, mutually at an acceptable transfer price for 10,000 kgs of pulp next year? Explain with reasons. Situation 3, if the outside supplier of carton division reduces its price to 177 per kg, will the pulp division meet this price? Explain, if the pulp division does not meet the price of 177 per kg, what will be the effect of profits on the company as a whole? That is the question. Okay. Right. Let's start answering this. Pretty simple. See, Nana. First of all, let's take situation 1. Minimum TP, I told you. You need to think from supply division's point of view. It is nothing but total relevant cost of the supply division. What is relevant cost of the supply division? Right now, it is operating at full profit responsibility, which means entire capacity is being utilized to sell externally. So anything that it has to transfer internally can happen only by sacrificing the external sales. Therefore, when you sacrifice the external sales, you will be losing a selling price. At the same time, you will be saving the cost. So therefore, what you ultimately lose is the contribution. So selling price minus variable cost, this much you will lose. That becomes opportunity cost, right? So variable cost plus opportunity cost will be your minimum TP, which comes to 210. Coming on to maximum TP, you need to think from receiving division's point of view. It is the money that receiving division possesses, which is NMR, or the external buying price, whichever is less. External buying price right now is 210 minus 10%, which is 189. Therefore, minimum TP is 120, maximum TP is 189, which means internal transfer will not happen. Got the point? Pretty clear. Right. Moving on to situation 2. So what is happening in situation 2? Assuming that pulp division is currently selling only 60,000 kgs of pulp each year to the outside customers. Okay. And at the stated price of 210. Will the managers agree for a mutually acceptable transfer price for 10,000 kgs of pulp in the next year? Explain with reasons. Pretty simple. So in situation 2, minimum TP is equal to variable cost only. Why? Because you are selling only 60,000 kgs to outside, which means the balance capacity is left over. You can utilize the balance capacity and transfer internally, which means what you will be incurring only is variable cost. Therefore, minimum TP will be variable cost, which is 126 from supply and division's point of view. Now from receiving division's point of view, obviously it is external buying price, which is 189. So therefore, this will be your TP range, minimum, maximum range. So therefore, there will be internal transfer possible in situation 2. So any TP within the above range is a good TP, is an agreeable TP, and internal transfer will eventually happen. Right. Coming on to situation 3. If the outside supplier of the carton division reduces its price to 177 per kg, will the pulp division meet this price? Explain, if the pulp division does not meet the price of 177, what will be the effects on the profits? What will be the effect on profits of the company as a whole? But in situation 3, he did not explain you whether the supply division is operating at full capacity or 60,000 capacity, like in situation 1 or situation 2. That he did not say. So we will answer from both the perspectives. Okay. Chalo. Assumption number 1. It is assumed that pulp division is selling 60% of its capacity externally. In that case, obviously your minimum TP is 126, which is variable cost, because there is no external sales sacrifice. So therefore, there is no opportunity cost. Maximum TP will be the external buying price, which is nothing but 177 as given in the question in situation 3. Therefore, this will be the TP range. Okay. So, you got the point? Right. So, if there is no internal transfer, then there will be loss. Right. If pulp division does not meet the price of 177, then carton division will buy from outside vendor. And because of this, the supply division will lose this much. Because supply division, it will cost only 126 to manufacture. And If at all it would have agreed the TP of 177, it would have gained 51 rupees per unit for all the units that it has internally transferred. Because instead of keeping your capacity idle, you could have transferred internally and you could have earned a profit of 51. Are you able to understand? Therefore, loss also for the company will be 51. How it will be loss for the company? Because from company's perspective, the receiving division is buying from outside at 177 when company can manufacture at 126. So company also will lose 51 rupees. So therefore, 5,10,000 will be lost. So which is pretty bad. Assumption 2. Let's presume that pulp division is operating at 100% capacity and all of its capacity is being sold to the external market. In that case, the minimum TP will be 210. Variable cost plus opportunity cost, just like in the first situation. Is that clear? You got this? External buying price maximum TP will be 177 because receiving division will not pay more than 177 when it can buy from outside at 177, which means no internal transfer will happen. Are you able to understand? That's obvious. Because if internal transfer happens, company will lose 210 minus 126. That is the loss of sacrifice of external sales, which is 84. And what you are gaining because of internal transfer, your receiving division will not buy at 177. Instead, you will manufacture internally at 126. So you will gain only 51. Ultimately, you will lose 33. So total loss for the company will be 3,30,000. Therefore, internal transfer should not happen if it goes by assumption 2, where supply division is selling its entire sales to the external market and it is operating at full capacity. You got the point, guys? Yes. So with this, we are done with this particular problem. Right, guys, let's move on to the next question. This one, sixth one. G Limited is a multi-product manufacturing concern functioning with 4 divisions. The electrical division of the company is producing many electrical products, including electrical switches. This division, functioning at its maximum capacity, sells its switches in the open market at 25 each. The variable cost per switch to the division is 16. The household division, another division of GL Limited, functioning at 70% capacity, asked the electrical division to supply 5,000 switches per month at a rate of 18 each to fit in night lamps produced by it. The total cost per night lamp is being estimated as detailed below. Components purchased from outside suppliers 50, switch if purchased internally 18, other variable cost 40, fixed overheads 21, total cost per night lamp is 129. The household division is marketing night lamps at a price of 130 each with a very small margin as it is doing business in a very competitive environment. Any increase in price made by the division will push out the division from the market. Therefore, the division cannot pay anything more to switches if they, that is from electrical division. Anyways, further, the manager of the division informed that it is very much essential to keep on the market share for night lamps by the household division to retain the experienced workers of the division. The company is using return on investments as a scale to measure the divisional performance and also marginal costing approach for decision making. So this has come in your examination. First one, would you recommend the supply of switches to household division by electrical division at a price of 18 each? Substantiate your recommendation with suitable reasons. Analyze whether it would be beneficial to the company as a whole the supply of switches to household divisions at a unit price of 18 by electrical division. Do you feel the divisional managers should accept the interdivisional transfers in principle? If yes, what should be the range of TP? Fourth one, suggest the steps to be taken by the chief executive of the company to change the attitude of the divisional heads if they are against interdivisional transfers. Got the point? That is a question. Chalo, let's start answering the first one. Would you recommend the supply of switches to household divisions by electrical division at a price of 18 each? Now see here, again we need to calculate minimum TP from supply division's point of view. Okay. So, total relevant cost of the supply division is nothing but your TP. So many times I've told you. Variable cost plus opportunity cost, because it is selling all its units to the external market at a price of 25 where the variable cost is 16, which means your contribution will be 9, which you will be losing if you want to sacrifice your external sales for the sake of internal transfer, which means your opportunity cost will be 9 and your variable cost is 16. Therefore, your minimum TP will be 25. Whereas the price quoted by the household division is only 18. So since 18 is less than 25, electrical division will not accept that particular TP. Also, the company is measuring the performance based on return on investment. So if the electrical division accepts 18 as its TP, thinking that its variable cost is 16, suppose, then its ROI will be adversely affected. Why? Because its profit will drop. Ultimately, return on investment will drop, which will hurt its incentives. Therefore, supply division will never accept. Are you able to get me? So electrical division will never ever accept. Got it? So that's the answer for first part of the question. So We have also substantiated our recommendation with suitable reasons. Next, analyze whether it would be beneficial for the company as a whole if the supply of switches to household division at a unit price of 18 by electrical division. So in first case, we have straight away said that it is not in the benefit of electrical division to transfer at 18 rupees. Why? Because its cost itself is what? 25. Therefore, it will not transfer, and that too it will affect its divisional performance evaluation as well, because it is being evaluated based on ROI. Now in the second question, we are asking not from electrical division's perspective, not from supply division's perspective, but from the perspective of the company as a whole. Let us see whether the answer will change or not. Okay, now see here. Calculation of the benefit from the company's point of view. So company ultimately has got two choices. It can sell switches externally. That is, it can ask the electrical division to sell it outside directly. If that happens, the selling price is 25 and the variable cost is 16. The company will get 9 rupees. Whereas the other option for the company is not to sell switches externally. Instead, it can ask the electrical division to transfer the switches internally to household division and convert them into lamps and sell lamps externally. If this happens, then the selling price of the lamps will be 130. The incremental cost, the further processing cost of converting the switches into lamps is component cost, which is 50. Other variable cost, which is 40, that is relevant. Fixed cost is not relevant. Are you able to understand? Yes. Apart from that, variable cost of electrical division is also important, which is supply division, which will be 16. So this is cost of receiving division, these two. Okay, and these two is the cost of supply division. That is the total cost for the company as a whole, total relevant cost. So from 130, if you reduce the total relevant cost, company can earn 24 rupees for every unit if it converts the switches into lamps and sells it as lamps. Now tell me, company would like to earn 24 or 15, or 9. It would like to earn 24, which means there is an additional benefit of 15. Therefore, from company's point of view, internal transfer is more profitable because the company earns 15 rupees extra. So if you sell externally the switches, company will earn only 9 rupees. If you convert that by transferring it internally into lamps and then sell it as lamps, the company is earning 24. So therefore, from company's point of view, it's beneficial to transfer internally and then convert that into lamps and then sell it as lamps. Got it? Chalo, next. Coming on to third part of the question. Do you feel that divisional managers should accept the interdivisional transfers in principle? If yes, what should be the TP? Let's try to fix the TP now. So you know that minimum TP is nothing but VC plus OC, which is 25. This we have already calculated as first part of the question. Maximum TP, you need to think from receiving division's perspective, and there are only two options. The money that receiving division possesses, which is nothing but NMR, or the external buying price, whichever is less. Now NMR is nothing but net marginal revenue, final sales revenue minus further processing cost. What is the final sales revenue? Here we have calculated 130 minus further processing cost is nothing but cost of the receiving division, which is 50 plus 40, which is 90. So 130 minus 90, receiving division has got 40 in its pockets to pay to the supply division. Are you able to understand? For buying the intermediate product. You got it? External buying price, there is no information in the question, so let's forget about it. So 40 it has got in its pockets. Are you able to understand? So which means the maximum TP can be 40 and the minimum TP can be 25. So there is a possibility of internal transfer. Are you able to get me? Right. So this can be your TP range. And finally, suggest the steps to be taken by chief executive of the company to change the attitude of the divisional heads if they are against the interdivisional transfers. That we have already seen. So this is a goal conflict scenario where these individual divisional managers, they are fighting with each other. They are not agreeing for a good transfer price. Then the solution can be two. Either it can be dual rate transfer pricing system, or it can be two-part transfer pricing system, and which we have told you already. So there are two solutions: dual rate, two-part. You got the point, right? So that's it. We are done with this particular sum. Okay, guys, let's look at the final question, which is 7th one of our current session, because I wanted to get this under 1.5 hours. That's why I'm going very fast. Even my throat is also paining. It's okay, right? So this will be the last one. It's a good one. It's a big one as well. Okay, with this we'll wind up the session. Right, chalo, now see here. Great Vision manufactures a wide range of optical products, including lenses and surveillance cameras. Division A manufactures the lenses, while Division B manufactures surveillance cameras. Okay. The lenses that Division A manufactures is of standard quality that has a number of applications. Due to huge demand in the market for its products, Division A is operating at full capacity. Okay, it sells its lenses in the open market for 140 per lens. The variable cost of the production for each lens is 110, while the total production cost is 125 per lens. Okay. The total production cost of the camera by Division B is 400 each. Currently, Division B procures lens from foreign vendors. The cost per lens would be 170. The management of the Great Vision has proposed to take advantage of the in-house production capabilities, and consequently, the procurement cost of lens would reduce. It is proposed that Division B should buy an average of 5,000 lenses each month from Division A at 120 per lens. The estimate cost of the surveillance camera is as below. Other components purchased from external vendors 150, cost of lens purchased from Division A 120, other variable cost 30, fixed overheads 50, total cost of the camera 350. Each surveillance camera is sold for 410. The margin for each camera is low since competition in the market is high. Any increase in price of the camera would reduce the market share. Therefore, Division B cannot pay Division A beyond 120 per lens procured. Great Vision's management uses return on investment as a scale to measure the divisional performance and marginal costing approach for decision making. So first one, analyze the behavioral consequences of each division when Division A supplies lenses to Division B at 120 per lens. Substantiate your answer based on the information given in the problem. Okay. So let's have a look into that. So behavioral consequences of Division A. Division A is currently operating at full capacity, that is given in the question, which means its entire production is being sold to the external market. So when you have to transfer internally, obviously what will be your minimum TP? Variable cost plus opportunity cost. We have seen this already. So minimum TP is nothing but total relevant cost of Division A, which is variable cost plus opportunity cost. So 110 plus 30, how much it comes, Nana? 140. Is that clear? Right. So from the above calculation, it is clear that Division A will never accept a TP less than 140 because 140 is the cost for Division A. Okay, right? Which is variable cost plus opportunity cost. So if Division A accepts TP of 120, then for every unit, it will have a loss of 5 rupees because its total cost itself is 125. Are you able to understand? And also the contribution will be reduced from 30 per unit to 10 per unit because it will be losing 20 rupees. Are you able to understand? 140, 120. Ultimately, it will be losing 20. So this will adversely affect the Division A's return on investment. Current return on investment is profit is this much, total cost. So profit divided by total cost, investment is nothing but total cost, right? So profit divided by total cost into 100. Right now, its ROI is 12%. If TP of 120 is accepted, then this 12% ROI will be reduced and Division A may not be eligible for incentives or bonus based on ROI, and that may lead to demotivation for the manager of Division A, which will not be in the interest of the company if he gets demotivated, because that will reduce his efficiency and that is not good for the company. Are you able to get me? Right. What about behavioral consequence of Division B? Right now, total cost of Division B is 400. Right now, the selling price of Division B is 410. That is there in the question. Right now, Division B is earning a profit of 10 rupees. So what is the return on investment right now for Division B? Okay, it is 10 rupees divided by its total cost is 400. That is the investment into 100, 2.5% only right now. Division B is buying from outside. Okay, if the intermediate product is purchased internally at a price of 120, then what happens? Earlier it is buying from outside at 170 given in the question from the external vendor. Right now you are buying internally at 120, which means straight away you will save what? 50 rupees. Your cost will get reduced by 50. So which means your profit will get increased by 50. So which means earlier your profit is 10, but now your profit is going to be 60. Your cost will get reduced by 50, which means now your cost is only 350. So revised profit divided by revised cost. Now your revised ROI is 17.14% from what? 2.5%. Are you able to get me? So therefore, ROI of Division B has got substantially increased from 2.5% to 17.14%. Therefore, Division B will accept the TP of 120. So the behavioral concept of Division A is it will not accept. The behavioral concept of Division B is it will accept because of so and so reasons which we have explained. Like this, you have to explain in the examination. Otherwise, you will not get marks. Everything has to be explained. You see the way I have written like that, you have to explain it. Got it? Chalo. Moving on to the second question. Analyze if it would be beneficial for the company as a whole for Division A to supply the lenses to Division B at 120 per lens. Let us see whether it will be beneficial for the company as a whole. Right now, it is not beneficial for the supplying division, but it is beneficial for the receiving division. Let's see whether it is beneficial for the company as a whole. Now, analysis of benefit for the company as a whole. Loss to the company due to internal transfer of 5,000 units is, how much will be the loss? 30 rupees per unit, because the supply division has to sacrifice the external sales, which means for every external sales that it sacrifices for the sake of internal transfer, it will lose 30, and 30 is real profit. So company also will lose 30. So 5,000 units into 30, how much you will be losing? 1,50,000. This is because internal transfer can happen only by sacrificing external sales. And this sacrifice of 30 is not only the sacrifice for the supply division, it is a sacrifice for the company as well, because it is real money. It is real money. Okay. Now what about, so this is what the company will lose because of sacrificing external sales for the sake of internal transfer. But how much it will gain, let us see. Benefit to the company as a whole because of internal transfer is, earlier your receiving division is buying from outside at 170. But now if you sacrifice buying from outside at 170 and buy internally, from company's perspective, earlier company through receiving division is paying 170 to the external vendor. Now company can manufacture through supply division at 110 itself, which means company will save 60 rupees for every unit that the receiving division stops buying from outside and starts buying from inside. Company will save 60, which means ultimately the company will save for 5,000 units how much? 3 lakhs. So here company will lose 1,50,000 through supply division, but company will gain 3 lakhs through receiving division. Therefore, ultimately company will be benefiting 1,50,000. So the conclusion is, since the net benefit is positive from company's point of view, there should be internal transfer. Earlier, division B used to buy intermediate product from external vendor at 170. Now instead, it can be manufactured from inside at 110, thereby savings of 60 per unit manufactured internally for the company. Got the point? So from company's point of view, it's good. Internal transfer should happen. Third one. Do you feel that divisional managers should accept the interdivisional transfers in principle? If yes, calculate the range of TP. Let's calculate the range of TP. First, minimum TP from supply division's point of view, maximum TP from receiving division's point of view. Minimum TP means what? Total relevant cost of the supply division, which is nothing but in this case, because it has to sacrifice external sales for the sake of internal transfer, it will be variable cost plus opportunity cost. Opportunity cost is nothing but contribution lost, that is benefit lost, which is nothing but selling price minus variable cost, which is 140 minus 110, which comes around 30 from the question. And your minimum TP will be VC plus OC, which is 140. Maximum TP will be what, Nana? NMR, that is the money that receiving division possesses, or external buying price, whichever is less. NMR is nothing but external selling price of the receiving division minus further processing cost of the receiving division. External selling price of the receiving division is 410. Further processing cost of the receiving division, that is own cost of the receiving division, is 180. You can see it from the question. Okay. I don't have time to show the question and answer simultaneously. Okay. Because we are doing rapid revision. Okay. External buying price, of course, it is 170 from the external vendor. So whichever is less is what receiving division will pay. Even though it has got 230 in its pockets, it can buy from outside at 170. So maximum it will pay you 170 only. Are you able to get me? So therefore minimum TP is 140 and maximum TP is 170. So internal transfer is possible, making both the divisional managers happy. You see, anything within the range is possible. Normally it will be average 140 plus 170 divided by 2. You got the point? Chalo, finally, next. Advise alternative transfer pricing models that the chief executive of the company can consider in order to change the attitude of the divisional. The moment you see this, you know the answer. Dual rate transfer pricing system as well as two-part transfer pricing system. Okay. Let's move on to the last one. Calculate the range of TP if division A has excess capacity and can accommodate the internal requirement of 5,000. If there is excess capacity, what will be your minimum TP? Total relevant cost of supply division, which is nothing but variable cost only, because when there is excess capacity, there is no need to sacrifice. So no opportunity cost due to excess capacity, because no sacrifice, no contribution lost. Therefore, total relevant cost will be variable cost, which is 110, and maximum TP will be NMR or EBP. That will not change. NMR is nothing but the money that I possess, which is 410 minus 180, okay, or external buying price, whichever is less. So the answer is 170. Therefore, 110 is less than TP is less than 170 will be your answer. Got the point? Right, guys. So that's it. We have solved as many problems as possible, which I feel, little bit, important and conceptually learning questions from your examination perspective. Now the time is 1 hour 34 minutes. I hope I have not wasted your 1.5 hours. My target was to cover at least 70% of this particular chapter in this 1.5 hours. I hope I have tried it to the best possible. So if you have liked this particular video and the effort, definitely hit that like button, because our competitors are very busy hitting the dislike button, and comment it what you feel, because the moment I see your comments, I'll try to put more efforts like this, and I'll try to help you guys as much as possible from my perspective as a teacher. Thank you so much, guys. Love you all. All the best for your exam, guys. Be confident, and I'll come out with 1 or 2 videos with 2 or 3 minutes. What are the tricks that I've followed when I've written my examination? I hope that will help you guys. So stay tuned to our YouTube channel. Thank you so much. All the best, guys. You will rock Scmpe. Right, guys. Hello. Welcome to PK Sir classes. This is your CA Prasanna Kumar, PK Sir. So we're gonna start with revision lecture of decision making chapter. Now, so many of you guys have messaged me that, especially with respect to concepts, you wanted full in-depth revision classes with respect to decision making chapter. So here it is, and let's start. Chalo. Now coming on to decision making. Okay, what is decision making first of all? So it's on an average every attempt it comes for 10 marks, and I can say if at all out of generally I prioritize chapters when I teach my classes based on this. So out of 10, decision making will be 7. So which means it's neither too important nor it is unimportant chapter. Which means you can say it comes under B category. Let's put it that way. B and A category in between. Are you able to understand? So anyways, so let's keep that aside. Let's get into the revision classes now. Decision making is all about taking decisions. Means what? To take decisions, let's say we'll classify our cost based on variability in relation to base quantity. Means what? You take a cost, base quantity normally will be units. I've given in brackets that it is units, and you see if the units or output changes, what is happening to the cost. Okay, if cost also changes proportionately along with the output, we call it as variable cost. If cost remains constant and only the output changes, then we call it as what? Fixed cost. And if both of them change, but they change disproportionately, then we call it as semi-variable cost. So like that, we classify cost into these 3 categories and then use that information to take decisions, because you know that when you're trying to take decision, fixed cost is irrelevant. Why? Because whether you take the decision or you do not take the decision, fixed cost remains constant. Therefore, it is irrelevant for taking a particular decision. Therefore, to take a decision, definitely you need to classify cost into these 3 categories. And in other words, this is nothing but decision making in a simple way, right? Also, we need to classify cost into relevant cost and irrelevant cost to take decisions. So what are relevant cost? Those costs which you consider while you are taking decision, we call it as relevant cost. Irrelevant cost means those costs which you do not consider or which you ignore when you are taking decisions, we call it as irrelevant cost. Examples of relevant cost or opportunity cost, variable cost, incremental fixed cost or specific fixed cost or additional fixed cost. Okay, irrelevant cost means fixed cost, sunk cost. Fixed cost means here we are talking about normal fixed cost, or we can also call it as absorbed fixed cost, or we can also call it as general fixed cost, or we can also call it as allocated fixed cost. Allocated, general, absorbed, all these things comes under irrelevant cost. Incremental, additional, okay, specific, they will come under relevant cost. So this is very important for you. Keep that in mind. Okay. Now, let's have a bird's eye view of the entire chapter. What are all the concepts that we're going to see? Break-even point, PV ratio, shutdown point, indifference point, further process or not decision-making scenario, break-even chart, financial and non-financial and ethical considerations when you're trying to take a decision, margin of safety, limiting factor, make or buy. These are all the concepts that we're going to cover in this particular chapter. So this is just a rough idea, okay, a bird's eye view. Now, coming on to PV ratio. I hope you guys are aware of PV ratio. It is also called as profit volume ratio or contribution sales ratio. What is PV ratio? Basically, it is a basic indicator of profitability of any business. Now, you might say that, why would PV ratio indicate profitability? Why? Because PV ratio talks about contribution percentage. This is the most important point that you have to remember. A small change in thought process really makes a huge difference when you are solving sums. Many a times people do not understand this, that PV ratio is nothing but contribution percentage. Suddenly, when you know that PV ratio is contribution percentage, all of a sudden when you start solving sums, this simple change in thought process will make wonders for you to solve the problems. Okay. So hereafter, whenever I talk about PV ratio, you just remember that, okay, PV ratio is nothing but contribution percentage. There ends the matter. Okay. It is a basic indicator of profitability of any business. And these are all the formulas that we're going to use to calculate PV ratio. Okay. What are they? Contribution per unit by selling price per unit into 100, or total contribution by total sales into 100, or 100 minus variable cost ratio. Are you able to understand? Variable cost ratio is nothing but percentage of variable cost. Now, you know that suppose variable cost is 50 and selling price is 100, then your contribution is 50, right? Because contribution is nothing but selling price minus variable cost. Are you able to understand? So selling price always represents 100%. So therefore, from 100%, if you reduce variable cost percentage, in this example, I call it as 50, which means 50%. Then what you resultantly get is nothing but PV ratio, correct? It's a simple logic, right? Why? Because variable cost plus contribution is nothing but selling price. So when selling price is taken equivalent as 100%, then obviously from that, if you reduce variable cost, you get contribution. If you reduce contribution, you get variable cost. Either way, are you able to get me? So that is also one formula. So variable cost ratio is nothing but variable cost percentage, which is nothing but variable cost by sales into 100. Pretty simple. And so these are all the formulas for PV ratio. Contribution per unit by selling price per unit into 100. Contribution by sales into 100. 100 minus variable cost ratio or 1 minus variable cost ratio, depending upon what kind of formula you have got. If your variable cost ratio is like 60%, then 100 minus 60%, your PV ratio will be 40%. If your variable cost ratio is 0.6, then 1 minus 0.6, your PV ratio will be 0.4, which is nothing but 40%. So depending upon the necessity, you can use whichever the formula you want. Then change in contribution divided by change in sales into 100. That formula also you can use to calculate what PV ratio. At last, you have this one, change in profit by change in sales into 100. I called it as residual one, means you should use this formula as a last resort. Last resort means in any question, if it has asked you to calculate PV ratio, try to use this formula, this one, and this one. Still, if you're not able to get the answer, then as a last resort, you try to use this particular formula. Are you able to get me? Right. Anyways. So let's say selling price is 100, variable cost is 60, then your contribution is 40. Then PV ratio will be contribution by selling price into 100, which is 40%. Or 100 minus variable cost ratio, variable cost is 60. So if you reduce 60% from 100, you get 40%, which is nothing but PV ratio. Pretty simple, right? Chalo. Now let's move on to the next one. Next one is BEP, break-even point. So what is break-even point? The first thing that you have to understand is it's a sales level at which a firm ends up in no profit, no loss situation. That particular sales level, we call it as break-even point. Very important. So this is an equation that all of you are aware of. From sales, if you reduce variable cost, you get contribution. From that, if you reduce fixed cost, you get your profit. Everybody is aware of this. But at BEP, we know that profit will be 0. When profit is 0, it means that your contribution should be equals to fixed cost, correct? That's why I've put equals to over here, right? So if profit is nil, then your contribution must be equals to fixed cost, which means at break-even point, your contribution must be equals to fixed cost. This, keep it in mind. This is very important for us, especially when we are solving sums. Okay, keep this in mind. Okay, now we have a formula for break-even point. Let's try to understand how this formula has come. Suppose selling price is 10 rupees. Okay, variable cost is 8 rupees. Then your contribution is 2 rupees, right? Let's say fixed cost is 1000. If you sell 1 unit, you'll be getting 2 rupees into your pockets, correct? So which means you need to recover a cost of 1000. But if you sell 1 unit, you'll be getting a contribution of 2 rupees. To recover the cost of 1000, how many units you need to sell? For every unit, it is 2, which means how many units I need to sell? 1000 by 2, which means 500 units I need to sell. When I sell 500 units, okay, then only my fixed cost will be completely recovered. Then what about variable cost, sir? The moment you are talking about contribution, already your variable cost is recovered. That's what you mean by contribution. When I say I'm talking about contribution, already variable cost is recovered. So my only worry is fixed cost. And now fixed cost is also recovered at 500 units, which means your total cost is recovered, which means this is your break-even point. So at this level, fixed cost is recovered fully and variable cost is already recovered the moment you are talking about contribution. Therefore, total cost is recovered, and this we call it as break-even point. Now, how did you get your break-even point? 1000 by 2. Now, what is 1000? Fixed cost. What is 2? Contribution. Therefore, your formula for break-even point is what? Fixed cost divided by contribution per unit. If you want your answer in terms of units. If you want your answer in terms of rupees, very simple. Instead of contribution, you divide it with contribution percentage. Now, contribution percentage is nothing but PV ratio. Therefore, fixed cost divided by PV ratio will give you same break-even point, but in terms of rupees instead of units. Are you able to get me? Pretty simple. Chalo, let's move on. Once your total cost is recovered, we call it as break-even point. Till here, it's fine. But at final level, you need to learn some important points. What is that? There are certain presumptions behind the BEP formula. Now, what are those presumptions behind the BEP formula? You need to presume that selling price is constant, variable cost is constant, fixed cost in total is constant. The relationship between cost and revenue line is linear, which means it goes like this. Okay, that's what you call it as linear relationship. Anyways, that's not that important. That's why I put an into over here. These 3 points are very important. What do you mean by that? It means if at all in a question you have been asked to calculate BEP, you should not blindly jump into question and then try to calculate break-even point by using the formula that is fixed cost divided by contribution per unit blindly. Are you able to understand? You need to check whether these conditions are satisfied. Only if they are satisfied cumulatively, then only you can apply BEP formula to find BEP. Now, please try to understand that break-even point is not a formula. It's a sales level at which your total cost of both the options, it's a sales level at which your total cost is completely recovered. Are you able to understand? So, break-even point is a sales level. It is not a formula. For our convenience, we converted that into a formula. Are you able to understand? So, if you want to use BP formula, then all these conditions must be satisfied. Say, for example, if there is a question in which selling price per unit is not constant, it means can I apply BP formula in that particular question? You can't. Suppose variable cost per unit is changing. Can you apply BP formula to calculate BP? No. Suppose fixed cost in total is changing. So, can you apply BP formula to calculate BP in that particular question? The answer is no. But still you need to calculate break-even point. Now, how to calculate is a different thing altogether. Are you able to understand? But what you guys need to understand is that if these conditions are not satisfied, I cannot blindly apply BP formula to calculate BP. That is a point that you have to remember. Okay, this will really come in handy for you when you are solving what? Sums. Okay, coming on to the next thing. Here you have something called loss, and I have written it as unrecovered fixed cost. This is very important. I told you, small changes in your thought process makes wonders in solving sums. So here also I told you that you should be thinking of PV ratio as contribution percentage. And here I'm again telling you that loss should be seen as fixed cost that has not been recovered. Are you able to understand? Hereafter, always remember, whenever you solve problems, you should always feel that loss is nothing but unrecovered fixed cost. You got the point? Very important. Chalo, moving on to the next one. Break-even chart. You can have a look at this chart. So this is your fixed cost. Okay. And this is your total cost. Why this is total cost? Why? Because it starts from here. So it is inclusive of fixed cost. So it starts from here. Therefore, it is total cost. And your revenue line starts from here, obviously, right? And this is the area where your revenue line cuts the cost line from the below. And therefore, we call this as break-even point. Okay. And before break-even point, this entire area is loss. And this is profit area. Okay. And this is your actual sales level. So therefore, difference between your actual sales level and this is your BEP level. So difference between your actual sales level and BEP level, we call it as margin of safety. Okay. On y-axis, we take revenue and cost. On x-axis, we take units. So this theta, we call it as angle of incidence. So this angle of incidence is influenced by which one? Selling price and variable cost, which means this is the total cost. So if variable cost is less, what will happen? This angle will go like this. So which means your theta will become more. So therefore, this angle of incidence is influenced by variable cost. Also, this revenue line inclination is influenced by selling price. So which means if your selling price increases, then what will happen? Assuming that your number of units remains constant, then this will go like this, which means again your theta increases. So your angle of incidence is influenced by selling price as well as variable cost. So this talks about profit earning ability of your company. So greater the theta, better it is for the company. And this fixed cost influences your break-even point. So right now, because the fixed cost is here, your break-even point is here. Suppose if your fixed cost increases and if it is here, then your break-even point also will increase. This will be your new break-even point. Are you able to understand? So the break-even point is influenced by fixed cost. Okay, keep that in mind. Chalo. Next, we're going to look into a concept called margin of safety. What do you mean by margin of safety? Name itself, you have got how much safe your company is. How much safe your means I'm talking about company. Okay. So obviously safety is linked with profits. The more profits you earn, the more safer you are. The less the profits that you earn, the less safer you are. It's pretty simple, right? The greater the profits you have, the safer you are, isn't it? Okay. Now what is this margin of safety? To put it very simple, this is what is margin of safety. What is that? Sales beyond BEP sales. Okay. If somebody has asked you what is margin of safety, what will be your answer? Sales beyond BEP sales, up and above BEP sales. Therefore, margin of safety is equal to actual expected sales minus break-even point sales, which means sales up and above BEP sales is nothing but margin of safety sales. So therefore, actual expected sales minus break-even point sales is nothing but margin of safety. Are you able to understand? Now, there is a formula for margin of safety as well. That is this one. Margin of safety in rupees is equal to profit by PV ratio. Margin of safety in units is equal to profit divided by contribution per unit. Now, let's try to understand the logic behind this particular formula. So what is that? First, let us look into classical way of calculating profit. What is that? Profit is equal to, we will take total sales. We multiply that with PV ratio. PV ratio is nothing but contribution percentage, I told you. So sales into contribution percentage will give you contribution. minus fixed cost will give you profit. This is a classical way of finding profit, correct? Now what I'm going to do is that I'm going to change this particular equation a little bit differently. How? In the place of total sales, I'm going to take margin of safety sales. So profit is equal to margin of safety sales into PV ratio. I will multiply, minus fixed cost will not come. It will be nil. Why? Because fixed cost is fully recovered. How? Because I'm talking about margin of safety. So when I talk about margin of safety, I'm talking about sales beyond BEP sales. So when I talk about sales beyond BEP sales, your BEP has already been crossed. Once your BEP has already been crossed, your fixed cost and all the total cost has been recovered, which means after crossing your BEP, fixed cost is zero. Therefore, your fixed cost is zero. So when this is zero, then obviously now you try to rewrite this formula. Fixed cost is zero. Margin of safety, send PV ratio this side, which means margin of safety is nothing but profit by PV ratio. That's how we have got this particular formula. Okay. Now, if you want margin of safety in units, then profit divided by PV ratio is nothing but contribution percentage. Instead of contribution percentage, you divide it with contribution per unit. You get your answer in terms of units. Pretty simple. Okay. Next, we have something called income statement, beyond BEP. What is that? When you take margin of safety sales over here, you reduce variable cost to get contribution. But because you have taken margin of safety sales, your fixed cost will be nil, which means your contribution itself will be profit. So this is another important understanding. So when you take sales as margin of safety sales, your contribution itself will be profit. Why? Because your fixed cost will be zero. Your fixed cost will be zero. Very, very, very important. Right? So contribution itself will be your profit. This is another understanding of the concept. Right? Got this? Okay, chalo, let's move on. Now let's get to the next point, next concept, and that is shutdown point. Let's try to understand this shutdown point concept now. So let's move on with shutdown point now. Okay. Now, what is shutdown point first of all? Okay. So try to understand that it's a sales level again. See, everything is a sales level. Even break-even point is a sales level. So shutdown point is sales level below which you are not recommended to continue your operations, or in other words, you are recommended to shut down. Sir, what do you mean by that? Which means shutdown point is a particular sales level. If your actual sales is below the shutdown point sales, you are not recommended to continue your operations. Are you able to understand? Which means you are recommended to shut down when your actual sales is less than shutdown point sales. Now, to take this sort of a decision where your actual expected sales are being compared with shutdown point sales, and accordingly you are taking a decision. To do that, first you should know what is your shutdown point sales. Now the biggest question is how to calculate shutdown point sales. To do that, first we need to start with this fixed cost analysis over here. For the purpose of calculating shutdown point, we're gonna classify fixed cost into two. One is avoidable fixed cost, the other one is unavoidable fixed cost. Avoidable fixed cost means you can avoid it, you can save it. So therefore it is relevant for decision making. Unavoidable fixed cost means you cannot avoid it, therefore it is irrelevant for decision making. Means what, sir? What kind of decision are you trying to take here? Whether to shut down your factory or not, or whether to shut down your operations or not. Unavoidable fixed cost means whether you shut down your factory operations or you continue your factory operations, either way it's gonna be incurred. So why should I think about it? Therefore I will ignore it, because whether my decision is yes or no, anyway in both the cases it will be incurred, therefore it is irrelevant. Avoidable fixed cost means if I take a decision to shut down my factory operations, it will not be incurred. You can avoid it, you can save it. Whereas if you take a decision to continue your operations, then you have to incur it. Therefore, this is relevant for my decision whether to shut down my factory or not. Why? Because it changes. If I shut down, this will be avoided. If I run my factory, then this will be incurred. Examples are depreciation because of wear and tear. So only if you run your factory, it will be incurred. If you shut down your factory, it will not be incurred. But depreciation due to effects of time, irrespective of whether you shut down the factory or not, time will pass, therefore depreciation will happen. Now rent, it depends upon the agreement that you have with your so-called, the guy who gave you that particular building or the campus on rent. Okay, it depends upon the understanding you have got. It can be avoidable, it can be unavoidable. It depends. Right, anyways. So this is clear. So fixed cost has been classified into two: avoidable fixed cost and avoidable fixed cost. This is not relevant for decision making. This is relevant for decision making. There ends the matter. Now, let's continue from here. Let's say avoidable fixed cost is 50,000. Just imagine that avoidable fixed cost is 50,000. Right guys, so let's presume that your avoidable fixed cost is 50,000. Okay. Now, which means that in case if you shut down your factory, you will save 50,000, correct? So 50,000 will be your savings. In other words, in CA Inter in financial management, you would have learned that saved outflow is deemed inflow. So when saved outflow is deemed inflow, it means when you're saving 50,000, it's as if you have earned 50,000. Able to understand? So when you're earning something, I can compare that to contribution. It is not actually contribution, but we will call it as equivalent contribution. That's why we will not actually call it as contribution. We will call it as equivalent contribution. So actually what's happening? We are talking about avoidable fixed cost. And if you shut down your factory, you're going to save this much. Okay. And saved outflow is nothing but deemed inflow, which means you're going to earn 50,000. Saving 50,000 is as if you have earned 50,000. So which means we can say it is equivalent to as if you have earned a contribution of 50,000. Did I really earn a contribution of 50,000? No, but it's equal to as if you have earned a contribution of 50,000. These are all very important, Nana, because never ever by heart anything. Always try to understand the logics behind the concepts. Okay. So therefore, I will consider this equivalent to contribution of 50,000. So which means saving 50,000, avoiding a fixed cost of 50,000, it's as if you have earned a contribution of 50,000. Now the next question is, if I have to earn a contribution of 50,000, how much sales I should have done? It is imaginary sales only, because once you shut down, there is a question of making sales because you have shut down your factory. So obviously we are talking about imaginary sales. So I'm going to avoid a fixed cost of 50,000, which means as if I'm earned 50,000, which means as if I've earned a contribution of 50,000. If at all I need to earn a 50,000 contribution normally, then I should have made sales. I should have made sales of how much? Divide contribution by contribution percentage. Let's say PV ratio is 40% in your company, which means you should have made sales of 1,25,000 to earn a contribution of 50,000. Are you able to understand? Which means saving 50,000, avoiding 50,000 worth of fixed cost is as if equivalent to making sales of 1,25,000. That 1,25,000 is nothing but shutdown point sales. So from the concept, you can easily say that shutdown point sales is nothing but imaginary sales. Are you able to understand? Now suppose if you continue your operations, let's look at that data. If you continue your operations, your expected actual sales is 1 lakh. You are expecting that you will make a sales of 1 lakh. And you know that your PV ratio is 40%. We have presumed that it has 40% for example purpose, which means you will earn 40,000 contribution in case if you run your factory. But if you shut down your factory, you will earn 50,000. Would you like to earn 40,000 or 50,000? 50,000. Therefore, I'll shut down my factory. In other words, if you run your factory, you will be expecting to sell 1 lakh. Whereas if you shut down your factory, you are making a sales of 1,25,000. Now, don't ask me, sir, if you shut down my factory, where is the question of sales? It's imaginary sales. If you shut down your factory, you are going to save a fixed cost worth 50,000, which means as if you have earned a contribution worth 50,000, which means as if you have made sales of how much? 1,25,000. In reality, you did not do it, but that is what you have done. Imaginary. Are you able to understand? Therefore, this expected actual sales will be compared with shutdown sales, and your expected actual sales is less than shutdown sales. Therefore, it is recommended to shut down. That's what is the definition here. Shutdown point is a level of sales, which is 1,25,000. Below which you are not recommended to continue your operations. Your expected actual sales is below that. Therefore, you are not recommended to continue your operations. You shut it down. So conclusion, it is recommended to shut down based on financial considerations. Again, very important at final level, especially in new syllabus. Based on numbers. However, before taking any final decision, the company should consider the following non-financial factors. What are they? You should consider your goodwill. If you shut down your factory temporarily only, you are not winding up your company. You're going to shut it down temporarily with an intention to reopen it up. In the meanwhile, whether it is 6 months or 1 year, your goodwill will be lost. You will lose your market share to your competitor. You will lose your skilled employees. Skilled employees means they are skilled, therefore they are very difficult to recruit back once you have lost them. Your machines may get deteriorated due to idleness, if at all there are any machines like that. And if at all you have any perishable raw metals, they will be lost. They will be gone. So these things also you have to consider. This is very important for us, especially in new syllabus at final level. Got the point? Non-financial factors in decision making. You got that? All right. Let's move on to the next concept. So the next concept is limiting factor. Then you can ask me, sir, you have written constraints and bottleneck also here. I have written that is because many a times students are getting confused between these three, almost similar terms. They're not exactly the same, but they are almost similar. Therefore, people are getting confused. Therefore, I thought that this is the right, moment in decision making chapter where you can really get a clarity with respect to these three particular concepts, that is constraints, limiting factor, as well as bottleneck. Okay, right. So first of all, let's start with what is a constraint. Anything that makes achieving your objective difficult than it would otherwise be is a constraint. For example, it's a very broad term, means what? It includes everything. That's what I've written over here. Sir, what do you mean by that, sir? Let's say you want to reach your destination. You start from your office, you want to reach your home, which is around 10 kilometers away. So your objective is to reach your destination. That is your objective. Now, what is a constraint? Anything that makes achieving your objective difficult than it would otherwise be, which means anything that makes achieving your 10-kilometer destination difficult than it would otherwise be will be a constraint, which means speed breaker is a constraint, because if there is no speed breaker, your destination reaching would have been smoother. Your journey would have been a lot more smoother and comfortable. If there is a narrow lane, and because of that, if there is traffic, it's making your journey, achieving your objective difficult than it would otherwise be. If there is no narrow lane, things would have been a lot more comfortable. Same goes with traffic signals, same goes with potholes. So which means constraint can be anything that makes achieving your objective difficult than it would otherwise be. Okay. Sir, which means limiting factor is a constraint? Yes. Bottleneck is a constraint? Yes. Constraint is a big thing. It's a broad term. It includes everything. So all limiting factors are constraints. All bottlenecks are constraints. But all constraints are not limiting factors. So limiting factor and bottleneck is a narrow term when compared to constraint. Clear? Now, what is a limiting factor? Limiting factor is a constraint, first of all. Bottleneck is also a constraint. Then what is limiting factor? Basically, limiting factor means scarce resources. Anything whose availability is limited, whose resource availability is limited, that is a limiting factor. For example, machine hours availability is limited. Labor hours availability is limited. Material availability is limited. That's why it is called limiting factor, because it has got the ability to limit your production. If machine hours availability is limited, you cannot produce even though you have a demand. If raw material availability is limited, you cannot produce even though you have a demand, which means these resources which are limited has got the ability to limit your production. That's why it is called limiting factor. You got the point? What is bottleneck? It is also a constraint. It is same as limiting factor. We will see this in theory of constraints chapter. So what is bottleneck? Anything that makes achieving your objective slow or limited is a bottleneck for manufacturing your product. Say for example, there are 3 machines. Machine 1 has got a capacity of 1000 units. Machine 2 has got a capacity of 500 units. Machine 3 has got a capacity of 800 units. And you need all the 3 machines to manufacture product A or B, suppose. Then because of machine 2, you're restricting your production to 500, which means machine 2 is a bottleneck. In other words, bottleneck and limiting factor both are nothing but the same. So, you got this? I hope now this particular confusion is clear. We will see this concept of limiting factor later in depth. In depth in the sense, almost, you do have an idea right now, but how to use limiting factor to take decisions is what we'll see later. Right now, just the difference between these three is enough. Are you able to get me? Chalo. Now let's move on to the next concept. What is the next concept? Calculation of break-even point under activity-based CVP method. What do you mean by that? Very important concept. So listen carefully. Normally, the formula for break-even point is fixed cost divided by contribution per unit. So everybody is aware of this, right? Break-even point formula is equal to fixed cost divided by contribution per unit. That is your usual formula. What is the logic behind this formula? Total cost can be divided into fixed cost and variable cost based on the variability of the cost with the output. So you take output on one hand, you take cost on other hand. Whichever varies along with the output, proportionately, that is variable cost. Whichever varies along with the output disproportionately, that is semi-variable cost. Whichever does not vary along with the output, that is fixed cost. So we know that. So the logic behind this formula is you have classified your total cost into variable and fixed cost based on whether your cost varies along with the output or not. Correct? But any cost that does not vary along with the output need not be fixed cost, as it can vary with something other than the output. Logical, right? That cost, we will call it as non-unit based fixed cost. Non-unit based means these fixed costs vary with something other than units. That's why it is called non-unit based fixed cost. Non-unit based means these fixed costs will vary with something other than units. Non-units, which means something other than units. So the logic that we are trying to say here is that just because a particular cost does not vary with respect to output, straight away, why are you classifying it as fixed cost? It is not varying with the output, fine. That doesn't make it a fixed cost. It could vary with something other than output, other than units. That's why it is called as non-unit based fixed cost, which means those fixed costs can vary with something called number of setups. These fixed costs can vary with something called number of engineering hours. These fixed costs can vary with something called number of equations. Are you able to understand? Other than units, they can vary with something other than units. So I've taken some examples over here. Setup cost, which can vary with number of setups. Engineering cost, which can vary with number of engineering hours. Material requisition cost, which can vary with number of requisitions. Inspection cost, which can vary with number of inspections. So all these are activities basically. Setup cost means it is backed up by setup activity. Engineering cost, engineering activity. Material requisition cost, material requisition activity over here. Inspection cost, inspection activity. Are you able to understand? So after considering this logic, we will revise our BEP formula like this. What is that? Original fixed cost plus, this is also fixed cost only, but this is that fixed cost which will vary with something other than output. All these are fixed cost only, but they are varying with something other than output. Now, this fixed cost is varying with number of setups. This fixed cost is varying with number of engineering hours. This fixed cost is varying with number of requisitions. This fixed cost is varying with number of inspections. Therefore, number of setups into cost per setup, number of engineering hours into cost per engineering hour, number of inspections into cost per inspection, number of material requisitions into cost per requisition divided by contribution per unit plus original fixed cost. What do you mean by this original fixed cost? That portion of fixed cost which remains constant irrespective of anything that changes, means this fixed cost is that fixed cost which will not change. Even if the unit changes, this will remain constant. Number of setups changes, this will remain constant. Number of material requisition changes, this will remain constant. Number of inspections also, it will not change with anything. That's why it is referred as original fixed cost. Okay. Although original fixed cost is not an official term, it should be called as fixed cost only. But for your understanding, I have called it as original fixed cost so that it will be easy for you to understand. That's it. Nothing more than that. Are you able to understand? So original fixed cost means that portion of fixed cost which remains constant irrespective of anything that changes. Even if units changes, it will not change. Even if anything other than units also changes, it will not change. It will remain exactly the same. Got the point? Right? Chalo. I hope it's clear over here. So with this, we'll wind up this particular session. Okay, part 1 of the revision of decision making. In the next session, okay, we will go with part 2 of decision making. Are you able to understand? Too much if we go at a moment, then it will be very difficult for you. So this is the entire concepts I'm going to teach from PowerNotes 2.0. So if you want to buy this PowerNotes 2.0 hard copy color, you can buy it from our PKSir classes app. I'll put the link of the app in the description. If you are using Android phone, you can just go to your Google Play Store and search with the name PKSir classes. You will find our app. In our app, you go to store column. Under store column, you'll find PowerNotes hard copy. You can buy it and you'll get it normally within 5 to 6 days. And you can have that hard copy and you can follow our revision lectures. So stay subscribed to our channel. You can share this link to your friends as well, because like this, so many revision videos based on PowerNotes 2.0 is gonna be uploaded. And I'm going to help you in attacking your December 2021 exams in a very good way. Whatever the help that I can do from my side, I'm going to do it. As you can see, now the time is 4:11 a.m. I think I've started doing this from 3:20 a.m. in the morning. So whatever the time that is available with me, I'll create time and then I'll try to do this revision videos for you guys. So I'm with you. Don't worry. Okay. So if you want to get best out of this revision videos, I will rather advise you to purchase this PowerNotes 2.0. It is around 299 pages. It's very handy. It will be very useful for you to revise the day before the exams. It contains concepts of all the chapters, okay, at one single area, so that you can revise it very fast and go and attack the exams in a very positive way, right? Okay, so with this, we'll wind up the session over here. In the next session, we'll go with the remaining concepts of decision making chapter, right, guys? Thank you so much. Bye-bye. Meet you in part 2. Right, Nana. Hello, friends. Welcome back. So we are done with the first part of the revision of decision making. Okay, I think till here we are done. We are finished, right? So now we're gonna continue with this one. Okay, let's go to the next concept. Ready, guys? So this is a very important concept, Nana, right? Marginal costing versus absorption costing. In what way it is important, sir? In your inter itself, this particular topic is important, but at final level, it is important from the perspective of decision making chapter, as well as it is important for standard costing as well as it is important when you're trying to club ABC activity based costing with either standard costing or decision making. You will understand what I'm trying to say only if you solve problems. But what I'm trying to tell you, one thing is for sure, that this is a very important concept even at final level. Okay, it's not like directly there will be a question where he'll ask you, explain the differences between marginal costing or versus absorption costing, or there will be a 16 mark or 20 mark question from this particular area. It's not like that. So what I'm trying to tell you is that the understanding of this concept is must for you to understand a lot of other concepts. For example, there is something called reconciliation of profits in standard costing. You know that it's a very important topic at new syllabus final level in CA final Scmpe, because I think reconciliation sums has been asked thrice so far, that model. But that model you will not be able to understand with logics unless you have clarity with respect to marginal costing versus absorption costing. Are you able to understand? So in that way it is really important. Otherwise you just need to by heart the reconciliation in standard costing without understanding any logics. If you want to understand the logics, then this is it. Like this, knowing this concept is very important. I hope you guys are able to understand what I'm trying to tell you. Anyways, so we'll go a lot deeper. I'll try to dig deeper. We'll try to connect a lot of concepts. There will be a lot of interconnecting being done, as well as we'll try to understand the logic of it. Okay, so that we'll be able to remember that easily. So what is this concept of marginal costing versus absorption costing? First one, marginal costing is used for decision making. Absorption costing is used for external reporting. Like in cost records, what we do, we basically follow absorption costing methodology and then we try to present our cost records. So it is for external reporting. Marginal costing is a technique. Absorption costing is a method. So I hope in Inter you guys have already seen. I'll just try to brush up the chapters that you have studied in your CA Inter or CMA Inter. Marginal costing, standard costing, budgeting, all these are examples of techniques. Unit costing, process costing, joint and byproduct, job costing, batch costing, all these are examples of methods. Okay, right. Coming on to the major difference now. Now we're going to look into the income statement, how income statement looks like as per marginal costing and absorption costing without stock. Without stock. There is a reason why I've written without stock here. We'll try to understand that. Right now, just focus on the concepts. One more important thing, many students are asking me, sir, you are teaching from this particular Power Notes 2.0. Where can we get it? You can buy the color hard copy, okay, of Power Notes 2.0 from PK Sir Classes app. The name of the app itself is PK Sir Classes, okay. So if you are an Android user, listen carefully, Nana. I'm again repeating because many students have been messaging us. If you're an Android user, just go to Google Play Store. I hope everybody knows what is Google Play Store, okay, and search for the name PK Sir Classes. Just like this, PK Gap Sir and Classes. You'll find our app. Go to the app, in that you'll have store. Go to the store, in that you'll find a product, that is Power Notes 2.0 hard copy, color hard copy. Product will be there. You can purchase it directly by making payment through any of the means. Okay, if you are an iOS user, that is if you are using Apple iPhone and stuff like that, then you have to go to Apple App Store. From that App Store, you need to search with the name My Institute. This is the app, My Institute. Once you download My Institute app, then you have to use the code YCWR. That is our classes code. Then automatically the app gets converted into PK Sir Classes app. And again, same procedure. From that, you can go to the store, and from that store, you can buy. Okay, right? You can get the hard copy. Is that clear? So you can keep that hard copy with you and follow these revision classes. That will really come in handy for you, especially for your exams. And again, I'm telling you, almost 70% of the stock is done. It's been I think 1 month since we have launched the hard copy. So 70% of the stock is done. So only 30% is left over. So you guys try to place the order as early as possible. Otherwise, after that, once it is out of stock, it will at least take another 2 months at least for us to get it back, to replenish that. Therefore, whoever is trying to follow my revision lectures and you are going to write exam in December, I would rather ask you guys to place the order ASAP. Meanwhile, you just follow these revision lectures, which I'm going to upload in the YouTube, and in few days you'll get the Power Notes. I hope it will really come in handy because all the concepts has been kept in 299 pages. Okay, So 299 pages is something that will come in really handy for you the day before the exam. All concepts of all chapters. You will see it when I'm going through the revision sessions. You will be able to understand what I'm trying to say. Anyways, now, so that power notes is what I'm using over here. And then I'm trying to take you revision sessions over here. Right. Anyways, now moving on to the next one, income statement. So if you can see, when it comes to marginal costing, this is the way the income statement looks like. First, you'll have sales. From that, you'll reduce variable cost. You get your contribution. From that, you reduce fixed cost. You get your profit. All of you guys are aware of this kind of presentation of income statement as per marginal costing. As per absorption costing also, the income statement is presented this way. First, from sales, you'll reduce factory cost. You get your gross profit. Then you reduce administration and selling and distribution overheads. Now, normally in regular class, I'll take a lot of time to teach this, because obviously regular class is beyond 240 hours, even in crash also for that matter. But when it comes to revision session, since we don't have time, but I'll just tell you one thing. Always when it comes to manufacturing company, you guys imagine that there are 3 buildings. Okay, imagine that there are 3 buildings. It will be easy for you to understand the concepts. One is factory, administration building, and sales and distribution. Just imagine that as a showroom. Are you able to understand? Whenever you are trying to prepare an income statement as per absorption costing, you just need to reduce these 3 buildings cost. The first building is factory. Whatever the cost that is incurred inside the factory building, we call it as factory cost. Second building, third building, so that it will be very easy for you to recollect. Okay. So when it comes to marginal costing, it's pretty simple. Sales minus variable cost, you get your contribution, minus fixed cost, you get your profit. We know this pro forma. When it comes to absorption costing, this is the way. Sales minus first building, gross profit minus remaining 2 buildings. There ends the matter. Now, if you look at the way the income statement has been presented, it has been unique, right? The reason is, when it comes to marginal costing, when you're trying to prepare this income statement, you consider variability of a particular cost and you ignore functionality of a particular cost. Functionality means there are 3 types of functions. One is factory function, administration function, and selling and distribution function inside a factory. So if you try to classify your cost based on functions, there are only 3 types of cost. Factory cost based on that factory function or manufacturing function, administration function, so administration cost, and selling and distribution function, so selling and distribution cost. So when you are trying to prepare your income statement as per marginal costing, what is there in your mind? You always try to find out whether a particular cost is variable or not. If a cost is variable, it will come here. If a cost is not variable, it will come here. You're not worried about to what function does it belong to. You're not worried about whether it belongs to manufacturing function or administration function or selling and distribution function. I hope you're getting my drift, right? Now, coming on to absorption costing, the thought process is exactly opposite. I consider functionality, I ignore what? Variability, which means here if you come and tell me, sir, there is a variable cost, my answer should be, don't tell me whether it is variable or not, just tell me to what function does it belong to. Does it belong to manufacturing function? Then it will come here. That is, factory is nothing but manufacturing, right? Irrespective of whether it is variable cost or fixed cost, because I'm not worried about whether it is variable or fixed. I'm only worried about to what function does it belong. That's my mindset when I'm preparing income statement as per absorption costing system. So therefore, because of your mindset change, the way you're preparing an income statement, their pro forma is different. Even though the pro forma is different over here, the presentation is different, still you reduce the same number of costs. Therefore, profit under marginal costing is equal to profit under absorption costing. These 2 profits are same. Now you can ask me, how is that, sir? We can just verify. Here, if you see, variable cost means inside that variable cost, what is present? Direct material, variable, direct labor, variable, variable factory overheads, variable administration overheads, variable selling and distribution overheads, 3 buildings. Okay. Similarly, when it comes to fixed cost, we have 3 buildings. Each building will have its own fixed cost. So fixed factory overheads, fixed administration overheads, and fixed selling and distribution overheads. There ends the matter. Now, if you look at this, inside factory cost also, what do we have? Inside factory, we have got direct material, direct labor, and because it is factory cost, you'll have factory overheads, which is variable and fixed, right? Administration overheads, variable and fixed. Selling and distribution overheads, variable and fixed. If you see, in both the cases, we have reduced exactly the same items of cost, the same 8 in number. Are you able to understand? So that's the proof, which means profit under marginal costing is exactly equals to profit under absorption costing. Are you able to understand? Now let's look at the summary. Profit under marginal costing is equal to profit under absorption costing, provided when there is no stock. This is very important. Provided, can you see that? When there is no stock. Very, very, very important. That's the reason when I've prepared income statement, I've specifically written without stock. This is the reason for that. Which means, what is the contrary statement? Profit under marginal costing is not equals to profit under absorption costing if there is stock. So when there is no stock, both the profits are same, which means when there is stock, both the profits should not be same. That's how the statement works, right? Now we're gonna focus on the second statement now hereafter. What is that? Why profit under marginal costing is not equals to profit under absorption costing if there is stock. To understand this particular statement, we need to imagine certain scenarios. Okay, before that, this is some of your basics. Okay, factory cost means inside factory you'll have direct cost as well as indirect cost, which is overheads. In direct cost, you'll have three elements: direct material, labor, and expenses. In indirect cost, you'll have three elements: material, labor, and expenses. Direct expense is a pretty rare item, so we presume that it does not incur. Therefore, you are left with direct material and direct labor. Okay. Indirect cost can also be called as overheads. So, therefore, factory cost is nothing but direct cost plus indirect cost. Direct cost is nothing but direct material plus direct labor, because we have presumed that direct expense does not exist. And the indirect cost is nothing but overheads. Because they are inside the factory, we call it as factory overheads. FOH here means factory overheads, okay, not fixed overheads. Keep that in mind. So this is your factory cost. All the cost inside the administration building or indirect only, therefore it is called overheads. Why? Because your output or units are manufactured inside the factory, and the cost that is being incurred here is indirectly related to the units which are manufactured inside the factory. Therefore, all the costs are indirect here. Here also all the costs are indirect. These are all basics of your inter. Are you able to get me? Anyways, I hope this is clear. So this should help you to understand this better. Okay. So anyways, now we're gonna focus on this particular sentence now. Profit under marginal costing is not equals to profit under absorption costing if there is stock. Let's try to understand what it is. To understand that, we're gonna imagine three scenarios. How many scenarios? Three scenarios. So we'll go through these three scenarios one by one. Okay. So let's start with the first one. The first one is your sales will be equals to production. The second one, sales is less than production. And the third one is sales is greater than production. So if your sales is equal to production, basically it means that there is no stock. Therefore, we already know that if there is no stock, then both the profits are going to be what? Same, that we have already seen. So that's what I've written here. Both the profits will be same. But if sales is less than production, then it means that there is a net closing stock. Listen carefully. Okay, net closing stock. Net closing stock means you can understand that from two possibilities. Possibility one is your opening stock will be completely zero and closing stock will be some 100 units, and thereby there is a net closing stock of 100. Possibility number two is both opening stock and closing stock are present in some numbers, but closing stock in number is greater than opening stock in number. Thereby you have a net closing stock. In both these cases, your production will be greater than sales. In other words, sales is less than production. Okay. The third scenario is exactly opposite, where your sales is greater than production, means you can sell more than what you have produced. When is that possible? When there is opening stock from the previous year. So therefore there is net opening stock. Again, there are two possibilities. Either your closing stock is completely zero, therefore you have opening stock, and therefore there is a net opening stock of 100 in this example. Or both opening stock and closing stock are present, but opening stock in number is greater than closing stock in number. Thereby there is net opening stock. In both these cases, ultimately your sales will be greater than production. Done? So now we have understood these three scenarios. Now let's try to understand the logic behind this particular sentence. How is this possible? Profit under marginal costing is not equals to profit under absorption costing if there is stock. Right. So we'll start with scenario 2, which means where there is net closing stock. So why profits are different is the first question. Because of presence of stocks, obviously profits are different. Because if there is no stock, both the profits are same. That we have seen already. Why presence of stock is affecting your profit? Why? Because they are valued differently as per absorption costing and marginal costing. So when they are valued differently, you know that stocks will influence the profit. So when the valuation is different, automatically they will either increase or decrease the profit in a different way. Therefore, the profits vary, right? So valuing them differently is the main reason. Obviously, next you will have two continuous questions. Why stocks are valued differently and how stocks are valued differently. So let's try to answer the first one, how stocks are valued differently. Then we'll answer why stocks are valued differently. Now, if you look at how stocks are valued differently, first of all, try to imagine where stocks are physically present. They are present inside the factory or the godown. When they are present inside the factory, they will be naturally made up of factory cost. We know what is factory cost. Already I taught you the concept over here. So factory cost means direct material, direct labor, and factory overheads. So come back over here, which means you'll be having direct material, direct labor, and factory overheads. In factory overheads, you'll have variable and fixed. Same logic applies here as well. Now, what is the difference basically? When it comes to marginal costing, you will not have this fixed factory overheads. Are you able to understand? This will not be there. which means as per marginal costing, it is made up of three elements: direct material, direct labor, and variable factory overheads. As per absorption costing, it is made up of four elements. Therefore, stock under absorption costing, the stock valuation will be greater than stock valuation as per marginal costing. As you can see, here it is 140 and here it is 110, right? Now, in scenario 2, basically what happens, you have net closing stock. So, you know the tendency of closing stock is to increase your profit. So, which means more the closing stock, more will be the profit. Less the closing stock, less will be the profit. So, as per marginal costing, your closing stock value is 110 over here, which means your profit would have got increased by 110. Whereas as per absorption costing, your closing stock valuation is 140, which we have seen already here, which means your profit would have got increased by 140. Therefore, the conclusion is absorption costing profit is greater than marginal costing profit by 30. Are you able to understand? Right? And that 30 is because of this culprit, fixed factory overheads. Now let's go to scenario 3. Scenario 3, the only difference is in scenario 2, you will have closing stock. In scenario 3, you'll have opening stock. So there is net opening stock, which means tendency of opening stock is to reduce your profit. More opening stock, less profit, and less opening stock, more profit. Therefore, as per marginal costing, if there is opening stock value of 110, it means the profit will be reduced by 110 as per marginal costing. Whereas as per absorption costing, because the stock value is 140, the profit will be reduced by 140. Here 140 has got reduced, here 110 only has got reduced, which means marginal costing profit will be greater than absorption costing profit by that 30 rupees. Okay, so we have answered this part of the question. What is that? How stocks are valued differently. Now the next part of the question is why stocks are valued differently. Well, the reason is because fixed factory overheads are treated as period cost. Period cost means expired cost as per marginal costing system. So expired means that's why they get expired by getting debited in costing P&L account. Whereas the same fixed factory overheads are treated as product cost as per absorption costing system. So product cost means unexpired. They stay inside the product. So that's why here this is the product. Your fixed factory overheads is inside the product because it is treated as product cost. Whereas in marginal costing, it is not inside the product. Why? Because it is treated as period cost and it goes and gets debited in costing P&L account. Got the point? Anyways. So that is what we try to explain over here. Now, so here I just gave explanation. When you debit something in costing P&L account, it is said to be expired. You got the point? Right. Now, next question is, okay, fine. So why fixed factory overheads is treated as product cost as per absorption costing system, and why the same fixed factory overheads is treated as period cost as per marginal costing system? So you said that fixed factory overheads is treated as product cost as per absorption costing system. Therefore, it goes into the product valuation. This is the product closing stock. It goes into the product valuation. Whereas as per marginal costing, it does not go into the product valuation. Instead, it gets expired in the form of period cost by getting debited in costing P&L account. What is the logic behind that? So that is what we have asked here. Why fixed factory overheads is treated as product cost as per absorption costing system? Why the same fixed factory overheads is treated as period cost as per marginal costing system? Well, absorption costing, the purpose is external reporting. Marginal costing, the purpose is decision making. So when you want to take decisions, fixed cost is not relevant. So which means you need to consider it or ignore it. You got to ignore it. You ignore it by treating it as period cost. That is the logic behind why fixed factory overheads is treated as period cost as per marginal costing system. So when you ignore it, you have to ignore it when you're trying to take decision. So obviously when you treat it as a period cost, it goes and gets debited in costing P&L account and it gets ignored, and that's what I want because it is irrelevant for me to take a decision. Whereas when it comes to absorption costing, you are not taking any decision. So therefore no cost is irrelevant, which means all costs are relevant, and therefore all the costs are reported and nothing is ignored. Simple logic. You got this? Chalo. Right. Now let's move on to the next one. The next one is concept of absorption. Now coming on to concept of absorption, this is also very important, Anna, so listen carefully. First of all, we need to understand the logic behind why there is a requirement of something called concept of absorption. So unlike your financial accounts, which is prepared at the end of the year, costing is a continuous process which starts from day one itself. Okay. So from day one, you need to know you need to manufacture your goods and you need to fix your selling price to sell your goods, which means you need selling price per unit from day one. Normally, presuming that you are a price setter, how will you fix your selling price? Your total cost per unit plus profit markup based on your overall cost of capital. That varies from company to company. But ultimately, you need to know total cost per unit to fix your selling price if you are a price setter. But how to find total cost per unit? Total cost will have two elements: direct cost or per unit or prime cost per unit, indirect cost per unit, in other words, overheads. When it comes to direct cost per unit, to calculate it, there is no problem whatsoever. It is easy to calculate, no complications, no issue. But when it comes to calculating indirect cost per unit, you have two problems. Problem number one is you do not know what is your overhead cost per unit or indirect cost per unit. That is the reason in CA Inter, you read a separate chapter called overheads, where the ultimate utility of overheads chapter is to find overhead cost per unit, where you do those three steps: primary distribution of overheads, secondary distribution of overheads, and absorption of overheads, where after the third step, you eventually ultimately find overhead cost per unit, which is indirect cost per unit. You add it to direct cost per unit, you get total cost per unit, and eventually you fix your selling price. So this is first problem, and that we eventually solve with the help of overheads chapter. We have already learned that in your Inter. There is second problem as well. What is that second problem? You do not know what your actual overheads are until you reach the end of the year. You will know it only at the end of the year. So at the beginning of the year, you don't know what's your actual overheads are. But we need to fix our selling price from day one itself. To do that, you need to know total cost per unit from day one itself. But you don't know what's your actual overheads are from the day one itself. You will know it only at the end of the year. You understand the problem? So which means basically you do not know what your actual overheads are at the beginning of the year, obviously. So which means no actual overhead cost per unit, which means no total cost per unit, no selling price per unit, you can't do business. So what is the solution for this particular problem? Go with expected overheads. When you don't know what's your actual overheads are, you go with expected overheads. Something you'll expect, right? That this much will be my expense. Go with that, which is nothing but budgeted overheads. Expected overheads is nothing but budgeted overheads, right? Isn't it? Yes. So calculate budgeted overheads. Okay. Find out budgeted overhead cost per unit, right? Which is nothing but indirect cost per unit, which is not actual, but it is budgeted. You add direct cost per unit to that, which is already ready with us. Total cost you'll get, add profit margin based on your return that you want to earn. You get your selling price per unit. Problem solved. You got this? Chalo. Now the next thing is, okay, this is fine. Now let us see how this whole concept of absorption works. Sorry. We're going to divide overheads into three parts: budgeted overheads, absorbed overheads, which can also be called as standard overheads, and actual overheads. Okay. Before your financial year starts, you will expect your overheads. You will budget your overheads, which comes around, let's say, 1,20,000. How you have budgeted your overheads? Like that, you will budget output as well, which is units. Let's say it is 12,000. In that case, if you divide both of them, you'll get budgeted rate per unit, which is 10 per unit, which can also be called as standard rate per unit or absorption rate per unit or predetermined rate or recovery rate, nothing but the same. Here I have divided this overheads, budgeted overheads, with units. Why? Because I presumed that units is the predominant influencing factor in that particular production department. Other than units, there can be 5 other predominant influencing factors. So it purely depends upon the question. But most frequently, it will be either of these three. Either machine hours will be the predominant influencing factor, or labor hours, or units. Suppose it's a capital intensive department, machine hours will be the predominant influencing factor because it is full of machines. Labor intensive department, labor hours. Here it is units. So like that, it depends upon that particular production department. Depending upon that, you need to choose one of these three and divide them. You will get your absorption rate, to put it very simple. All this will happen before your financial year starts. So once your financial year starts, on April 1st, let's say you have manufactured 40 units. Already you have your absorption rate, which is 10 rupees. So you absorb 10 rupees per unit. So you have absorbed 400 on day 1. Same logic applies to day 2, day 3, so long it goes for 365 days. After 365 days, let's say you have actually manufactured 13,000 units. This is your actual output. Actually, you have manufactured 13,000 units and you have absorbed 10 rupees per unit, which means you have absorbed 1,30,000. Absorbed means what? What you have debited in costing P&L account. Once 365 days is done, you have come to year end. So obviously, when you have come to year end, you know what's your actual rates are. Let's say it is 1,40,000. Whereas how much you have debited in costing P&L account or absorbed? 1,30,000, which means you have debited less. So under absorption, which is 10,000, which is the difference between absorbed overheads and actual overheads. Clear? So this is nothing but concept of absorption. You got the point? Chalo. Finished, Nana? Let's move on to the next one. Next one is activity-based CVP analysis. You might say, sir, already we have seen this, right? Yeah, we have seen. But now I took activity-based costing concept also here itself. And then we're going to finish the concept of ABC also. Because both are connected. Normally, activity-based costing concept should be taught as part and parcel of SAOI, that is strategic analysis of operating income. But now we're gonna see it here itself as part and parcel of decision making chapter itself. You got the point? That's why I've put this heading one more time. You'll understand. Okay, what we have seen already, what we are going to see now is quite a bit different. We're gonna see so many different perspectives. Right, now see here. Activity based CVP analysis. We know that break-even point formula is fixed cost divided by contribution per unit. How did you decide that this much is the fixed cost? Based on variability with output. You classify your fixed cost into variable cost and fixed cost, right? This classification of fixed cost is wrong. Why? Because we have seen this concept already. Anyway, one more time I'm saying, just because a particular cost does not vary with the output doesn't make it a fixed cost. In reality, what happens is there are so many fixed costs which vary with something else other than output. For example, there is a setup fixed cost which varies with number of setups, but it doesn't vary with number of units. Engineering cost which varies with number of engineering hours, but it doesn't vary with number of units. Material requisition fixed cost which varies with number of material requisitions but does not vary with number of units. Similarly, inspection fixed cost which varies with number of inspections but does not vary with units. Are you able to understand? So these are officially called as non-unit based fixed costs because these fixed costs, they vary with something other than units. That's why it is called non-unit, because they vary with something other than units. All these are other than units only, na? And these fixed costs vary to something other than units. Therefore, we call it as non-unit based fixed cost. And we have seen this formula as well. So this is nothing new. Already we have seen it over here, correct? We have seen this concept. Where is it? Here. Already we have seen it. So we have brushed it up one more time. Okay, till here it's clear. We know it. Now we're going to look into the concept of activity-based costing. Very important concept. That's why I gave so many stars over here. And as I told you, it actually comes under SAOI chapter, Strategic Analysis of Operating Income, but we're going to finish it off here itself. Now, before we get to this particular concept, activity-based costing, the first thing that you guys need to understand is that what is the purpose of activity-based costing concept? The purpose is to find overhead cost per unit. Now, you might be surprised because already we know how to calculate overhead cost per unit. How do we know that? We have learned that in our CA Inter, right? Or CMA Inter. There's a chapter called overheads where we do 3 steps. That is primary distribution of overheads, secondary distribution of overheads, and absorption of overheads, where ultimately you try to find overhead cost per unit. So when you already know how to find overhead cost per unit, why do you need a separate concept again to calculate the same? Well, to know that, you need to wait. Okay. But right now, you should know one thing, that the purpose of activity-based costing is to calculate overhead cost per unit. Done. Okay. To understand the logic behind this, because already we know how to calculate overhead cost per unit, then why are we trying to learn another concept where again the purpose is to calculate the same overhead cost per unit, which we already know how to calculate? Let's try to understand that logic. For that, first you should know the modern business environment. From 1960s to 1990s, it was a seller's market. Seller was the dominating guy. So there are no multinational companies. Say for example, the cost structure was in most of the companies, manufacturing companies I mean, if total cost is 100 rupees per unit, direct cost will normally be greater than or equals to 90% and indirect cost will be normally less than or equals to 10%, which is overheads. So therefore overheads are not that important at that particular point of time, at this time, okay. So even ad hoc absorption overheads was sufficient. Ad hoc means blind way of absorbing overheads was sufficient. This is what you are doing in your IPCC overhead chapter when you are trying to calculate overhead cost per unit. You are going with ad hoc method of absorption. It is not perfect method of absorbing overheads. But whatever the way it is, ultimately you will calculate total cost per unit and you fix your selling price based on the presumption that you are a price setter, which I told you already. But after 1990, this was fine at that particular point of time when overheads was less than 10%. Even that ad hoc method was running fine. Otherwise, why would companies be follow? And they have been successful as well. So it worked at that particular point of time. It worked, but not after 1990, because after 1990, it has been what do you call bias market? So which means selling price is fixed by market forces, and seller has become a price taker, which means he has to accept the price that has been fixed by the market, because he doesn't decide selling price per unit unless his total cost per unit of the product is precise. He will end up taking wrong decision, which will adversely affect the business. What do you mean by that? Suppose if your total cost is not exact, it is approximate, it is not precise. 40 rupees per unit, you are saying the total cost of a particular product, and it is not correct. It is wrong. In that case, either it will be over costed or it will be under costed. So if it is undercosted, it means that the product gives more profit. So you may decide to increase your production, which is wrong. Why? Because you feel that it gives you more profit because of your wrong calculation of total cost. Same logic applies to overcosted situation as well. You feel that the product is giving you less profit and you may decide to stop production. So both the decision will damage the company and its business. You got the point, isn't it? Right. So, and in the other case, the other reason is that earlier you are a price setter. Therefore, you were setting your selling price and this was working. But now, because it's a buyer's market domination, this is happening, which we have already explained you. Apart from that, suppose if total cost is 100 per unit, now indirect cost is almost like 40%. Earlier, when we have studied this, it was only less than 10%, right? When you are following that blind method of absorbing overheads or ad hoc absorption method. But that was working fine at that particular point of time. Why? Because overheads are not significant. It was less than 10%. But now you cannot follow the same blind method of absorbing overheads when your overheads is as high as 40% due to MNCs and due to change in the way you're doing business once the buyer's market situation have come into picture. That is one thing. Second thing is, now you're a price taker, which we have already seen. So you don't have control over your selling price. Are you able to understand? So, therefore, the only way to solve all these problems, what problems? To solve the problem of undercosting or overcosting your product, to solve the problem of managing a significant overhead cost, which is almost like 40%, the only solution for you is ABC, which is activity-based costing. How? Because activity-based costing helps you to find exact overhead cost per unit. That's what we have told here. So you were wondering that already we know how to calculate overhead cost per unit. Then why do we need another concept again to calculate overhead cost per unit? Means the difference is, once upon a time, whatever the overhead cost that you were calculating in your intermediate based on overhead chapter was not precise. Because you were observing your overheads based on ad hoc absorption methodology. But ABC helps you to find out the same overhead cost per unit only. But the difference is it will help you to find out exact overhead cost per unit. Precise overhead cost per unit. Therefore, once you know exact overhead cost per unit, then your total cost per unit also will be precise, which means your selling price will be perfect. There will be no question of undercosting or overcosting. Right? You will do your business in a perfect way. Now let's try to understand what is ABC. Try to recollect your IPCC or CMA Inter overheads chapter or CA Inter, whatever it is. Overhead cost per unit, how do you calculate if it is units method? Total overhead cost divided by total number of units. Correct? If it is Mishnah's method, because I told you now, depending upon predominant influencing factor, this can keep on changing. Concept of absorption, I told you just now. Depending upon the different types of methods. Okay, it keeps on changing. So, overhead cost per unit is total overhead cost divided by number of units, or overhead cost per Mishnah is total overhead cost divided by total Mishnahs. Let's say your total overhead cost is 1,20,000. Let's say your Mishnahs is 10,000. So what you were doing in CA Inter is what we are trying to see here. So Mishnah rate will be 12 rupees per Mishnah, correct? Let's say there are three products A, B and C. Mishnahs, A takes 2 hours, B takes 3 hours, C takes 1 hour. Per hour the rate is 12. So obviously into 12 into 12 into 12, your overhead cost per unit is 24, 36 and 12. You will readily have direct cost per unit. You add that, you get your total cost per unit. This is what you were doing. Correct? And as per ABC, what you were doing is wrong. You can ask me, how is it wrong, sir? We'll try to understand the same. Now see here. This Mishnah rate, what you have calculated here, 12 rupees per Mishnah, ABC activity-based costing says that it is wrong. What is that? Dividing total overhead cost divided by total Mishnahs, which is 1,20,000 divided by 10,000 Mishnahs, is wrong. So how can you say it is wrong? What is the logic behind this? The logic is, see, when you are dividing 1,20,000 divided by 10,000 Mishnahs, it means that this entire numerator is influenced by denominator. That is the logic. This entire 1,20,000 is influenced by Mishnahs. That's why you are dividing the entire overheads with Mishnahs is the logic. The entire 1,20,000 overheads is influenced by Mishnahs, but this logic is wrong. Why? Because 1,20,000 overheads is not a single expense. It's a pool of so many expenses. If you do further analysis of this 1,20,000, you get that machining cost is 40,000 out of this 1,20,000. Setup cost is 30. Inspection cost is 20 out of this 1,20,000. Material requisition cost is 30 out of this 1,20,000. And only this machining cost of 40,000 is influenced by machiners. Which means out of this 1,20,000, only 40,000 portion is influenced by machiners, which means entire 1,20,000 should not be divided by 10,000 machiners. Only 40,000 should be divided by 10,000 machiners. That is the logic. Remaining cost of overheads are influenced by different factors. Then they should be divided by those respective factors, not machiners, because these are not getting influenced by machiners. Only this 40,000 portion is influenced by machiners. Therefore, divide it with machiners. These three are not influenced by machiners. They are influenced by different factors. So divide them with respective factors. Thereby, you'll get multiple overhead absorption rates or multiple rates of recovery. That is nothing but we call it as activity-based cost. You got the point? So that is the logic and the concept of activity-based costing. You got this? Got this, guys? Right, chalo. Let's move on to the next one. Concept of sell or further process. See, the confusion is very simple. Should you sell now at whatever the selling price that is available right now, or you should further process that particular product and sell? Well, the answer is very simple. Take sale value after further processing. Let's say it is 1500. After further processing, let's say your sale value is 1500. Right now, your sale value is 1000, which means if you further process, you'll be getting additional sales of 500. What is the cost for further processing? Let's say it is 400. Then there is a net benefit of 100. In that case, you can further process. So if it's positive, you can further process. Suppose your sale value after further processing is 1500. Right now, the sale value is 1000. So additional sales is 500. Whereas the additional cost is 600. In that case, this will be 100 negative. Then do not further process. Very simple. Very simple. You got this? I hope this is clear. All of you? Right. Okay, let's move on to the next one. Still, there are so many concepts like concept of limiting factor and so many other indifference point concept and all those things that we'll see as part and parcel of transfer pricing chapter. Okay, I'll cover it in transfer pricing chapter. So right now, I'm not going to cover those concepts. Is that clear? So don't get worried. That I'll be covering in transfer pricing chapter. Now let's move on to the last concept of this particular chapter, decision making. That is relevant costing. So based on elements, basically we can classify cost into three categories: material, labor, and overheads. So let's try to start with the first cost, that is material cost. And what is our object right now? Our objective is to find what is the relevant cost of material. Our objective is to find what is the relevant cost of material. How to find relevant cost of material? Ask yourself the first question. Is raw material is in stock or out of stock? If it is in stock, then it is different. If it is out of stock, straight away the relevant cost is replacement cost, which is nothing but buying price. The logic is very simple. When there is no raw material in stock, how will you get the raw material? You'll go, you'll buy and you'll get it. So what is the cost of using it? Whatever the price with which you have bought it. It's as simple as that. So when it is out of stock, you're gonna buy it and bring it over. Therefore, that buying price is nothing but replacement cost. So relevant cost is replacement cost. Very simple. Suppose if the raw material is in stock, then what is the relevant cost of that particular raw material if you use it? For that, you need to answer one more question. Is it regularly used? You have two answers. Yes, it is regularly used. No, it is not regularly used. If it is regularly used, then again the relevant cost of using it is replacement cost. Why, sir? Why? Because let's say the raw material comes like this. Immediately it will be going for consumption. Comes, goes for consumption. Comes, goes for consumption. Comes, goes for consumption. In that kind of situation, if you use in between some units of raw material, then it will create stockout situation. So immediately you need to, solve that stockout situation. How will you solve it? By buying and then putting it over. So when you're trying to use any stock in the middle for temporary requirement or whatever it is, are you able to understand? So what is the cost of using it? Replacement cost only, because you're immediately replacing it with the newly bought raw materials, correct? Therefore, if your raw material is regularly used, and it is there in stock, but it is regularly used, it's a busy raw material, and you're using such raw material, then the relevant cost of using it is replacement cost. Why? Because when you use such raw material, immediately it has to be replaced. So you will buy and you will replace. So what is the cost of using it? I've bought and I've replaced. Now, so the bought price, which is nothing but, the buying price, which is nothing but replacement cost. So if it is not regularly used, then you see whether it has got any resale value. Let's say it can be sold for a value of 100. Then 100 will be the cost of using it. Why? Because you're using it, you're losing an opportunity to sell it for a price of 100. Therefore, 100 rupees of benefit is lost. Benefit lost is nothing but opportunity cost. Therefore, relevant cost will be 100. So you need to think like that. There is a raw material stock like this. It can be sold for 100. That stock I'm using for some purpose. In that case, I lose an opportunity to sell it for 100. Therefore, 100 rupees is gone. Therefore, what is the cost of using this raw material? That 100 rupees which I have lost, which is nothing but opportunity cost. Therefore, relevant cost will be resale value. Suppose this so-called irregularly used raw material, which is there in stock, can be used as substitute in the place of some other raw material. Let's say this irregularly used raw material is X. It can be used as a substitute in the place of Y. Y right now is not there in our stock. We need to buy Y by paying a price of 150 per unit. But we came to know that instead of buying Y by paying a price of 150, we can use X as a substitute for Y, which is already there in stock. X is already there in stock. Therefore, what is the relevant cost of using X? 150. Why? Because of X only. Now you have saved 150. Well, the logic is very simple. Therefore, price of the substitute will be your answer. Very simple. You got the point? Yes. So price of the substitute will be your relevant cost. Yeah. So when both the options are available, whichever is higher will be your answer. So if both the options are available, relevant cost will be whichever is higher. 100 or 150, 150 will be your relevant cost. Pretty simple. Can be sold for something, can be used as substitute. Whichever is higher will be your answer. Now coming on to next one, that is labor. You need to find the relevant cost of your labor. That is your objective. What type of labor it is your first question. Is it skilled labor, unskilled labor? If it is unskilled labor, he is very easy to find. So you will not take them as permanent employees, because whenever you need them, you can easily find them because they are not skilled. In that case, the relevant cost will be actual wages paid, which is whatever you pay. So whenever I need them, I'll recruit them, I'll use them, I'll pay them, I'll ask them to get lost. So what is the cost of using them? Whatever that you have actually paid, which is nothing but actual wages paid. But when it comes to skilled labor, that is not the case. Because they are difficult to find, they will generally be taken as a permanent employee. So to find out the relevant cost of skilled labor, you need to find out whether he is busy or idle. If he is idle, then the relevant cost of using a skilled labor is 0. Why it is 0? Why? Because he will be permanent employee, which means your wages are committed already, whether he works or he doesn't work, whether he is busy or he is not busy. Anyway, you have to pay them. So you're already paying him and he's idle. So what is the incremental cost of using him now? Nothing, because you're already paying him. Whether I use him or I don't use him, in both the cases you have to pay. So therefore, what is the relevant cost of using him? 0. Because the incremental cost of paying him is 0, because you're already paying him. You got it? Even though he's idle, still you are paying him. If he's busy, then what's gonna happen? Very simple. If he's busy and you want him, say for example, for project XY, okay, you will get him over here and see that the project in which he's already busy, is there a substitute available? If a substitute is available, whatever you pay to the substitute will be the relevant cost of using this particular skilled labor, because the value of skilled labor is what you're paying to the substitute, because the substitute is doing the same job that your skilled labor is doing. Correct? The logic is very simple. So if he's busy, you try to bring him to another project. Here it is project A. You're asking him for project XY. You bring him over here. Then here somebody has to replace his work. Let's say there is a substitute worker available and you're replacing him and you're paying him some 10,000. Then 10,000 is the worth of this so-called skilled labor. Isn't it? Because somebody is doing the same work that the skilled labor is doing at some X price. Then X price will be the value of the skilled labor, as simple as that. So therefore, relevant cost is nothing but wages you paid to the substitute worker. Suppose if substitute is not available for project A and you're asking skilled labor to come to project XY, then if substitute is not available, then you have to stop this particular project and work for project XY. Then whatever the profit that you're losing because of stopping this particular project A is a benefit loss. Benefit loss is nothing but opportunity cost. That opportunity cost will be the relevant cost. Got it? And finally, overheads. Material is done, labor is done, and the last one is overheads. Two types of overheads: variable, fixed. Variable overheads will always be relevant. Why? Because they're variable, they change. When they change, they are relevant. Isn't it? In fixed overheads, if it is general fixed overheads, it is irrelevant, which doesn't change, which remains constant. Okay, absorbed fixed overheads, general fixed overheads, share of fixed overheads, all these things are constant. Allocated fixed overheads, all these are irrelevant. But if it is specific, then it is relevant. Specific, incremental, additional, discretionary fixed overheads, all these are relevant. Why? Because they are changing. You are incurring them right now. They are increasing. So fixed cost also, if it changes, then it is relevant. If it remains constant, then it is irrelevant. Simple logic. You got it? That's it. So we're done with all the concepts. As I told you, the limiting factor, indifference point, all those concepts are there that we will cover in transfer pricing, okay, chapter, when we are revising that particular chapter. Is that clear? That's it, guys. With this, we are done with all the concepts. I've covered activity-based costing also over here. I hope you guys are really getting benefited from these rapid revision videos. I'm trying to cover all the concepts as much as possible in the limited time. Are you able to understand? We'll try to do the same for all the important chapters for this particular attempt. So stay tuned to our channel, subscribe our classes so that you'll get the notification the moment I upload without wasting your time. Okay, and also you share this video, so let your friends know so that they'll also get benefited. So that's the reason, as you can see, I'm working late night whenever I find time, midnight or late night, and then I'm trying to record this session for you guys. Thank you so much. I hope this video helps you write your exams better. That's it, guys, from my side. Bye-bye. Right. So what we're going to do is that we will revise, okay, the whole concepts, and after revision, we'll go with the sums. Okay. Shall we start? Right. Chalo. Let's move on. So what is the chapter that we have started, Nana? MBA. Tell me, is it important chapter or unimportant chapter? Obviously important, very important. Okay. It belongs to A category. Now, coming on to all the topics in this particular chapter, I gave you the bird's eye view. What are the topics we have got? Quality management. Under that we have cost of quality, total quality management, as well as what, Nana? Business excellence model. Then we have theory of constraints, supply chain management, as well as gain sharing arrangement. Correct? Now, priority wise, what's your first priority in this chapter? Quality management, all the areas of quality management, okay, which covers cost of quality, total quality management, as well as business excellence model. Then comes supply chain management, then comes theory of constraints, and finally gain sharing arrangement. After that, we have seen the intro. What is the intro part, Nana? During the past 2 decades, earlier, what was the market? It was dominated by sellers. Let's say roughly before 1990s. Okay, so seller dominating the market means everything is decided by the seller. For example, as you can see here, the price is determined by the seller, the response time is determined by the seller, the quality of the product is determined by the seller, as well as performance is dictated to the customer. So this is the performance that we're gonna give through our product. Say for example, if it's a bike or car, everything is dictated by seller. So seller domination purely. And seller was the price setter. That is also very important. Price setter means what? He can fix the selling price. Okay. But coming on to buyer's market, which took domination after what, Nana? Yeah, exactly. After 1990. Roughly, I'm just trying to give you an idea. That's all. Okay. So post 1990, what has happened? There was a tectonical shift in the way the business was going on. And that is what we call it as modern business environment, where like once upon a time, it was not the market that was dominated by the seller. It's purely a market which is dominated by the buyer. So buyer dominating in the sense, what does it mean? It means price is determined by the buyer, not directly, but what? Indirectly through the forces of demand and supply. So therefore, now the seller becomes price taker. He just need to accept the selling price that has been determined by the market. Unlike, earlier once upon a time where he used to be what? Price setter. And response time also will be determined by the buyer. What is the response time of the service that you are providing, or by within what time you will be delivering us the product. Similarly, quality also will be determined by the buyer. He will say, okay, this is the quality level that I'll accept, otherwise I'll reject. Similarly, performance also will be determined by the buyer. Now, I told you examples for that, right? Royal Enfield Classic 350 we have seen, and we compared that with what, Nana? Java, as well as what? Honda CB350 and all that. Isn't it? And so what? All right. Now, the reasons for the above transition, we have seen all the reasons. First reason is what? Globalization, which led to what? Opening up of all economies, and as a result, multinational companies came into picture, correct? Because of multinational companies in every single country, what has happened? Competition has got increased, and that gave upper hand to whom? Buyers, okay? After that, we have competition, which I have discussed just now. Then, excess capacity is also one of the reasons, especially due to industrial revolution. What has happened? A lot of machines have come into picture, and as a result, what has happened? Their capacity to manufacture a lot of things has got increased, overriding their domestic demand. Domestic demand means what? Suppose a company is there in a particular country and they have a capacity which will satisfy the entire demand in that particular domestic country and beyond that. So what they started doing is that, okay, fine, they started exploring the other markets, which is obviously beyond their borders, okay?
And after that, that is one of the reasons why we had emergence of multinational companies. You got the point? And they started getting into other countries, and they started setting up their plants, manufacturing plants, and started selling their products. Next, ease of travel is also one reason why we started getting imported cars and all that, isn't it? Right? Internet, of course, that's where the revolution has started, and customer has got access to all the details right now through the internet. So he became more intellectual in buying things, And finally, availability of raw materials is also one of the reason. I gave you some examples, right? DB's group, I gave one example for diamonds and all that, and Coca-Cola example also I gave you, correct? Where they try to set up their plant where water is available primarily. Okay, anyways. So this is just the intro part of this particular chapter. Okay, after that, what we have seen, Nana? Cost of quality. What is cost of quality? First of all, before we get to that, one thing we know that quality is not free. It takes some cost, correct? Otherwise, everybody will provide quality. Why quality is possible only to few people? Because you have to spend money to get quality, correct? Now, first of all, before we get to something called cost of quality, we need to understand what is quality. So I told you in a very simple way, quality means any product must be free from three things. What are those three things? Defect, deficiency, significant variations. Okay, I explain you what those significant variations and all that. Okay, after that, we try to understand how many types of cost of quality we have got. Okay, so first of all, what is a simpler understanding of quality? It is ability to meet what, Nana? Customer expectations and provide value for money. If you are able to do that, it means from the customer's point of view, you are set to have quality. He feels that your product has what? Quality. If you are able to meet his expectations and also provide what? Simultaneously value for money. I gave you an example for that. Scorpio N is doing right now, the same thing, isn't it? In fact, you can see the managing director interview yesterday. I don't know whether you guys are able to follow that or not. Exactly, this is the wording that he has used. Okay, he said that Indian customers at heart are always value conscious. Okay, they always look for value for money, no matter how rich they are. So by default, they look for what? Value for money. That's the exact dialogue of what. So obviously, they were also looking into these kind of aspects once they go for pricing. Okay. Anyways, now moving on to the next one. We try to understand what is cost of quality over here. Cost of quality has got two things. One is cost of creating good quality. Other one is cost of correcting bad quality. So cost of creating good quality can also be called as cost of good quality. Cost of correcting bad quality can also be called as cost of poor quality. There is one more name for cost of good quality, which we call it as conformance cost, where you conform with the quality standards which has already been set. We call it as conformance cost. Whatever the costs that are incurred in order to ensure that you conform with the quality standards that has been set, we call it as what, Nana? Conformance cost. And whatever the costs that are incurred in case you are not able to meet the quality standards, your product is not able to meet the quality standards, then to bring it back to the quality standards which we have planned, we call it as non-conformance cost. And of course, conformance cost can also be called as cost of meeting the quality. Non-conformance cost can also be called as cost of not meeting the quality. Once you are not able to meet the quality standards, then again I have to what? Work it out, bring it back to the quality standards. For that I have to incur some cost, which I call it as cost of poor quality. Right. After that, what we have seen, cost of quality, especially cost of good quality, can be further classified into two. What are they? Prevention cost and appraisal cost. And cost of poor quality can be further classified into two. What are they, Nana? Internal failure and external failure cost. Then we try to understand one by one. Okay, so what is prevention cost? Whatever the cost that you incur for preventing what, Nana? Poor quality of products. For example, if I train somebody, okay, what is the ultimate intention of training somebody? When you train them, exactly, they'll not do what? Mistakes, isn't it? So they'll not do mistakes. They'll be able to manufacture the product in the best way possible, isn't it? Is it a good thing or a bad thing? Good thing. So you are trying to avoid something wrong from happening. What is something wrong from happening here? Bad quality. Okay. So training, even planning also comes under similar kind of a thing, isn't it? I gave you an example for that, isn't it? For example, for your exams, you plan, right? If you don't plan, what will happen? The probability of you failing in the exams will be really high, isn't it? If you plan, then the probability of you failing in the exams will be what? Relatively less. Same logic happens here also when you're manufacturing something, isn't it? Next, supplier evaluation. What do you mean by evaluating a supplier? To ensure that the supplier does not give you what? Low quality raw materials, or does not give you, what can I say? He will deliver the products on time. He will deliver the raw materials on time. New product review or evaluation. Whenever you are evaluating something, what is the logic behind evaluation? You try to ensure that things are correct. You understand the point? You try to ensure that things are correct. If you don't evaluate, then what will happen? Indirectly, you're trying to increase the probability of something wrong happening, correct? So that's the reason you try to evaluate. Training, already we have seen. Meetings also with the same intention, either to plan or to train people. Error proofing, already I gave you an example. What is error proofing? Quality management system such that your product will be free from errors. We have seen that Coke example, cool drink example, correct? Where the cool drinks are getting filled up. Before it gets sealed, you'll try to implement a laser system or something such that if there is any under quantity in that particular bottle, right, it will be filled up, and then after that it will be what, Nana? Sealed, such that once it is sealed, always it will be of good quantity, correct? Same thing we have seen with what is that, a printer example, where once you want to insert the cartridge, you need to insert the cartridge only in the right way, only then it gets locked, correct? So which means it has been designed in such a way that once the cartridge gets locked, it means that it is a good unit. So thereby you have created a system in such a way that there is no chance for error, that we call it as error proofing. Okay. Then of course we have something called capability evaluation. So I told you already, the easiest way to remember this is, remember the words evaluation, okay, remember the words planning, and remember the words what, Nana? Training. So the moment you see these words, you got to understand that they come under what cost? Prevention cost. And of course, these prevention costs will be implemented before your product goes for actual manufacturing. Are you able to understand? This is really important. So you do all these things before your actual manufacturing starts. Okay. After that, coming on to something called appraisal cost. What did I say? Once your prevention costs are done, which means you have invested a lot of money into what? Prevention cost. Later, what will happen, Nana? You have a doubt whether whatever the money that you have invested in preventing something wrong from happening, has it been really able to prevent that or not? That is a doubt for me. Okay, so therefore what I'll do, I'll start checking. Isn't it checking or inspecting or whatever it is? So that we call it as what cost, Nana? Appraisal cost. Same logic we have seen in environmental management accounting, where Hansen and Mendoza's classification, where we have prevention environmental cost as well as what? Appraisal environmental cost. There also we have seen the same logic. In prevention environmental cost, you will buy some pollution control equipment, air cleaning equipment, water cleaning equipment, something like that. And then that is prevention cost, because you are trying to prevent something wrong from happening. In this case, it is pollution. Okay. And then you have a doubt whether is it really preventing or is it really doing what it is intended to do. Then I have to check it. Checking, testing, auditing, all these things. Okay, then I'll start really checking the water levels or really checking the pollution levels of what? Air. So that we call it as what cost? Appraisal cost. Correct? So that is what we have seen here. As you can see, verification, quality audits, checking, testing, field testing, as well as what, Nana? Supplier ratings. Here you have evaluated the supplier, that is prevention cost, and then you will check whether the evaluation is correct or not through ratings. That we call it as what, Nana? We call it as what? Appraisal cost. Exactly. Next. Internal failure cost means what? Despite investing your money in prevention cost, as well as what, Nana? Checking it through appraisal cost, still something wrong can happen, correct? Yes or what? Everybody. So when something wrong can happen, that we call it as a failure. And that wrong can happen at two places. One is within your factory. The other one is what? Once your product has left your factory and it has reached the destination. Destination in the sense customer. Okay. So if the mistake is identified by you within the factory premises as a company, then we call it as internal failure. If that product reaches the customer and then customer identifies the problem and then tries to communicate with you, then we call it as external failure. So what are the examples for internal failure? Once you identify the failure within the company premises, we call it as waste, scrap, rectification, redesign, rework, failure analysis, delays, as well as what, Nana? Downtime. When I say downtime here, it is unplanned downtime, not planned downtime. Okay. Right. Another important thing is that the easiest way in a question to identify what internal failure cost is to look at the word re. Okay. Because whenever you check something, you test something, you inspect something for the first time, that comes under appraisal cost. But after checking also, if there is a failure, and then again you try to rectify the product, and again you try to recheck it whether the rectification has been done correctly or not, we call it as what, Nana? Internal failure. Are you able to understand? So the best example for that is rechecking, retesting, re-inspection. So whenever you see the word called re, then you have to understand that it comes under internal failure. Okay, then we have something called external failure, which we obviously know. The moment customer is involved, we know that it is a external failure, and which is the most dangerous cost out of these four: external failure, because it not only gives you a cost because you in the form of warranty claims or goods returned by the customer, whatever it is, but still it also affects your goodwill. So that goodwill will reduce your sales in the long run, which is really dangerous. Got the point? So you can see the examples over here: repair of goods return, warranty, servicing, lost sales due to what? Customer dissatisfaction, complaints, etc. Okay. So after that, what we have seen? We have seen some important notes for solving case scenarios and case studies. What are those notes? We know that cost of good quality is inversely proportional to cost of poor quality. So the more you invest in prevention and appraisal cost, the lesser will be what? Internal failure and external failure. So therefore, if a company wants to achieve zero defect level, it has to invest a lot of money into what? Prevention and appraisal cost, not just at one time, not in one shot, but regularly over a period of time. So that is what we call it as continuous improvement program. So you keep on investing your money in prevention appraisal costs such that your internal failure and external failure at some point of time may become what, Nana? Zero. Okay, after looking at this, we have seen something called optimal cost of quality. So what is optimal cost of quality? This is cost of good quality graph. So which means here you're investing a lot of money in prevention appraisal. At the same time, if you have invested a lot of money in cost of good quality, cost of poor quality will be at its minimum or almost zero. Similarly, if you have not at all invested any of your money in cost of good quality, then cost of poor quality will be really high. Correct? So what this optimal cost of quality tries to tell you is that this is wrong, this is also wrong. Why? Because in both the cases, your total cost of quality is what, Nana? Really high. Correct? Your total cost of quality is really high. So he says that you try to find a balance between them such that you have an agreeable level of defects percentage so that your total cost will be at its minimum. So as you can see, where these two lines intersect, this is the area at where your optimal cost of quality exists, which means your total cost of quality will be at its minimum. Got the point? That is a concept. Although I told you I don't agree with this concept. Why? Because this concept only considers what, Nana? Cost of quality. But we generally prefer, it's my personal opinion, we prefer what? This one. Which one? This one, where your prevention and appraisal cost is really high. Yes, we agree that total cost of quality will be what? Here. It's very, very high when compared to what? This level. Okay, by this much. But still, you have a lot of other perks. What are the other perks? One is almost you are defect free. When you're almost defect free, your customer will be really satisfied. He knows that once he buys a product, it will be absolutely sure shot. Correct? That increases your brand value. As a result, that increases mouth publicity. That increases sales in the long run. So that additional contribution from additional sales has not been considered here. Second is you can also try to sell at a higher price because of the brand value, because of the higher quality. You understand the point? That extra sales which you are enjoying, that is also not considered here. As a result, I personally feel that which is the best one? Which is the best one? Yeah, this one over here. Got the point, Nana? When your cost of good quality is at its maximum. Okay. Sometimes it can be inefficient also. Anyway, at that time we'll see, look at the individual situations and then accordingly we'll take the call. Okay. Right. Okay, let's look at here. So point at which total quality cost is minimum is known as what, Nana? Optimal cost of quality. This implies that striving for zero defects through continuous improvement is not at all good from what point of view? Economic point of view, which means from numbers point of view. And the argument is that there should be some acceptable level of defects, which I have told you. So lower external failure and internal failure cost will result in what, Nana? Higher customer satisfaction, which will also result in more sales. We have discussed this. It is also possible that a project may not be attractive from financial perspective due to what, Nana? High cost of good quality, which is nothing but prevention and appraisal, but it can be attractive from non-financial perspective in the form of higher customer satisfaction. Always remember, today's good non-financial perspectives or tomorrow's good financial perspectives. Okay, today if customer is satisfied, which is a non-financial perspective, tomorrow your finance will be very healthy because the customer will indirectly increase your sales. Correct? Right. Okay, now next question is, discuss any measures to reduce what, Nana? Non-conformance cost. Very simple. If you want to reduce the non-conformance cost, which is internal failure and external failure, what you will do? Increase the investment in prevention and appraisal. Correct? That we know already because both of them are inversely proportional to each other. Apart from that, we have certain other things as well. You can invest in TQM, total quality management. You can invest in Six Sigma because the job of Six Sigma is to identify the root cause of defects and reduce the defects. Correct? We can also invest in total productive maintenance because the entire intention of total productive maintenance is to ensure that your machines are working at optimal efficiency level. Correct? Automatically the quality of your finished goods will be good. And of course we have Kaizen and target costing. Okay, chalo. After that, we took a small example where we try to understand what is the calculation of what, Nana? Cost of quality. So I gave you a selling price and variable cost, okay, and contribution over here. And we took the example of customer demand as how much, Nana? 4,000 units, and rejections by the customer as 20%. So when the rejections by the customer is 20%, to satisfy a demand of 4,000, you need to deliver how many units, Nana? 5,000 units, which is 4,000 divided by 80%, because 20% will be rejected. So once you manufacture 5,000, ultimately customer will be accepting 4,000. Okay, after that we have seen certain scenarios. We went with scenario 1, where there are certain presumptions that I've taken. What is the first presumption? Rejected goods are not replaced. Loss of market share due to loss of goodwill is how much, Nana? 1,000 units. And return goods by the customer will not be exactly repaid, and they don't have any scrap value. In this case, in this scenario, we try to understand what is cost of quality, right? So to calculate cost of quality, the first thing you guys need to understand that there will be a contribution loss. From where? From the loss of market share due to what, Nana? Loss of goodwill, which is how many units? 1,000 units. So from each unit, what is the contribution that we have already calculated? 30. So 1,000 into 30, how much I'll be losing? 30,000. Apart from that, even though the sales is 5,000, I'm actually manufacturing how much, Nana? Sorry, even though the sales is 4,000, I'm actually manufacturing 5,000, which means 1,000 units are produced, rejected, and they got wasted according to our presumption. Okay. So therefore, once 1,000 units are wasted, I've already spent how much of money on manufacturing those 1,000 units? 70. Not only manufacturing, you're also delivering them to the customer. After that, only customer is rejecting. So therefore, you'll incur the delivery cost as well. So ultimately, I'll be losing how much? 70 on per unit basis. For 1,000 units, I'll be losing 70,000. So total external failure cost for me will be 30,000 in the form of loss of sales because of loss of goodwill, which we call it as opportunity cost. Plus, we have 1,000 units which got wasted, where we have manufactured and delivered to the customer, but customer has got rejected, and therefore we have lost how much on that? 70, and that gives us 70,000 loss. So the total loss is how much? 1 lakh, which we call it as what cost, Nana? External failure cost. After that, we have seen something called scenario 2, where in scenario 2 we took some different presumptions. So the first one was goods will be what, Nana? Replaced, unlike scenario 1 where it will not be replaced. Replaced components can't be repaired, but I'll be replacing, that's all. I'll not be repairing. Scrap value still here is 0, which means you just need to throw it away. And loss of market share due to the loss of goodwill is still the same, which is how many units? 1,000 units. And also here, because you'll be replacing, which means you have to deliver the product again to the customer, and that additional delivery cost will be how much, Nana? How much? 10 rupees. Those are all the presumptions. So now again in this scenario, we try to calculate cost of quality. How to calculate cost of quality? First, again you're losing contribution because of loss of goodwill, correct? Yes. So how many units are you losing? 1,000 units at a price of how much, Nana? 30, which means I'll be losing how much? 30,000. And then you also need to replace 1,000 units, correct? What 1,000 units? The customer will be rejecting 1,000 units, and then you have to again replace those 1,000 units to the customer, correct? So which means again additionally you will be incurring 10 rupees, correct? So therefore earlier it was just 70 rupees what you were losing, but now you have to again send back a new unit, correct? Where you will be incurring additional 10 rupees. So therefore you will be losing how much? 80 rupees. So therefore 1,000 into 80, how much you will be losing? 80,000. Anyway, contribution loss or opportunity cost is already there, which is 30,000 plus 80,000. How much will be your external failure cost? 1,10,000. Right. After that, what we have seen? Shall move on. Now, what is the next one? We have got solution 1. So here, what is that we are trying to see? How to solve the above problem of defective units reaching the customer and affecting the goodwill negatively. Okay, because since in the earlier two scenarios, what is that we are facing? We know that the defective units are reaching the customer. So once defective units are reaching the customer, what is happening? Customer is feeling pretty bad because he is rejecting, and as a result, the goodwill is getting bad. I mean, the goodwill is going down, and as a result, ultimately, the bad word of mouth is spreading, and as a result, I'm losing what? 1,000 units of market sales, correct? Now, what I'm trying to do eventually is that I'm trying to rectify that case. What case? Customer should not feel bad about my product. I have to protect my goodwill. So to protect my goodwill, I'm going with two solutions. The first solution is I am trying to completely eliminate the defective units. How can I eliminate defective units? For that, first I need to find out root cause of the defect. So I have done my research, and eventually I found out that the root cause of my defect is what? Defective raw materials from the supplier. Got the point? So once I've identified that raw material defects are the reason for my finished goods defects, okay, what I've done, I have kept a inspection where the moment I buy the raw materials from the supplier, immediately it will be inspected before it goes for production. As a result, this will result in two things. What are the two things? You will save variable manufacturing cost of rejected units. Why? Because first of all, you will not manufacture any rejected units, isn't it? Because your defective units are completely eliminated. As a result, 1000 units of 70 rupees will be what, Nana? Saved. So therefore, 70,000 will be saved. Apart from that, customer will not be getting any defective units. As a result, customer satisfaction will be high, your goodwill will increase. Therefore, you will be able to sell 1000 units more. So therefore, on every unit, you will be earning a contribution of 30. So therefore, I'll be getting an additional contribution of 30,000. Totally, my benefit will be a cost saving of 70 plus additional contribution of 30. Total, it's going to be how much? 1 lakh. But to actually implement this solution to inspect the raw material, I have invested how much here? 95,000. So therefore, my net savings will be 5,000. So this is one solution where we have eliminated what? Defective units once for all. But in the second solution, what we are trying to do is that we are not trying to eliminate the defective units. Rather, we are trying to identify the defective units before they reach the customer. Got the point? So what I'll do is that I'll try to have a inspection process at the end phase of the production. Okay, end phase of the production means once your finished goods are manufactured, before it leaves the factory premises, there I'll do the inspection such that all the defective units will be what, Nana? Identified, and they will not leave the factory premises, thereby avoiding the possibility of reaching the customers. So as a result, all the defective units here, we are not avoiding creation of defective units. What we are trying to avoid is only the reach of the defective units into the customer's hand. That's all. Okay, right. So for that, how much is the cost we are incurring to inspect the finished goods before it leaves the factory? 25,000. And this will result in three things. What are those three things? First, anyway, your goodwill will increase because ultimately the defective units are not reaching the customer. Therefore, they'll be happy. And as a result, good word of mouth will spread. And therefore, my sales will increase by 1,000. If sales increases by 1,000, I'll be able to get more contribution, which is 30. Thereby 30,000, which we know. Next, but the problem here is, unlike in solution 1, I did not avoid manufacturing of what, Nana? Good units. Sorry, I did not avoid manufacturing of bad units or defective units. Therefore, even though if my sales increases by 1,000 units, actually I have to manufacture how much? 1,250 in my factory because there will be 20% defects. Okay, so 1,250 I'll manufacture inside my factory. And at the end of the factory gate itself, 250 units will be identified and it will be stopped, and exactly 1,000 units will reach the customer. Got the point? So therefore, even though I have increased sales of 1,000 units, actually I have to manufacture how many for that 1,000 sales? 1,250 units. Got the point? In this 1,250 units, 1,000 are produced and sold, and 250 units are produced, and they will be what? Wasted. But they will be identified within the factory. But you need to remember that we won't be incurring delivering cost on these 250 units because they are identified within the factory. So therefore, cost of 250 wasted units will be what, Nana? Only 50. Thereby, I reduce the delivery cost, and eventually I will be losing how much? 12,500. After that, delivery cost also will be saved on the other defective units, because earlier when the sales demand is 4,000, actually I need to manufacture and send how many? 5,000. In that, customer will reject what? 1,000. So therefore, ultimately I am incurring delivery cost on the entire 5,000. But now what's happening? Exactly. Now what's happening? Yeah. So he is rejecting what, Nana? Sorry. Now what's happening is that we are only identifying what? 1,000 units within the factory premises. As a result, ultimately we are delivering only 4,000 units. You understand the point? Therefore, we'll be saving delivery cost on those 1,000 units, which is the difference between 5,000 and 4,000. And that savings will be how much? 20,000. So the total savings will be how much for us? Here we have additional sales, additional contribution from additional sales, which is 30,000. And also we have the delivery cost saving, which is how much, Rana? 20,000. So the total gross savings will be how much? 50,000. And the cost for this will be initially I've incurred 25,000 for inspection of finished goods before they leave the factory gate. And after that, here again I'm incurring cost of 250 wasted units for the additional sales, and that will be 12,500. So the total cost will be how much? 37,500. There is a net savings of 12,500. So if you take the summary of the above, here in solution 2 there is a net savings of 12,500. In solution 1 there is a net savings of 5,000. So you might be feeling from financial perspective that solution 2 is better. But always in the long run, which solution is better, Nana? Solution 1 is better. Because first of all, you're not manufacturing any defective units, which means you're doing optimum utilization of resources. So tomorrow after 5 years, maybe the raw material may become what? Scarce. In that case, obviously solution 1 will be better. So therefore, always in the long run, which is better? Solution 1 will be better. That is one thing. Got the point? That is what we have seen here. Okay. Yes. And apart from that, there is one more solution. Already we have seen 2 solutions right now. One solution was you just try to keep an inspection department at the beginning of your factory, where the moment you get raw materials from the supplier, immediately it will be what? Inspected, and thereby all the defective raw materials will be rejected, and only good unit raw materials will go for what? Production. Thereby all the finished goods will be good. That way you have avoided defective units. The second solution was you did not avoid defective units, you just started getting all the raw material, you did not inspect them, straight away it went into production and it created defective finished goods. But that defective finished goods were identified by way of inspection process of finished good before it leaves the factory gate. Exactly. And therefore ultimately good units will be reaching the customer. That was second solution. There is a third solution also, which we have already implemented as per JIT. So as per JIT, what we generally do is that, because we can't have the luxury of defective units, because as per JIT, because it is just in time, after getting the sales only, I'll be what? Producing eventually. So I don't have the luxury of time, right? And moreover, I don't maintain stock as well, isn't it? So therefore, what I do in JIT is that I go to the supplier, I tell him that I have identified that the reason for my defective finished goods is your defective raw material. So therefore, please don't try to send me defective raw material. You try to do the inspection process yourself. We will also support you for that, and we were doing that. We were sending our engineers to the supplier's factory, isn't it, to improve his quality. And you improve your quality and finally send me only good units. I'll pay you that extra bit of premium for doing all this work rather than the normal price that I pay for your raw material. You understand the point? As a result, eventually what will happen? He will give me directly what? Good units only. Thereby, there's no need of inspection and all those things. I'll get the good units and thereby I'll manufacture only good units. Everything is solved. Got the point? So this is the last solution, okay, which indirectly we have seen in JIT. Okay, right. So after this, we have seen something called total quality management. We have seen the definition of total quality management. Definition is very easy. It is a management philosophy which seeks to integrate what, Nana? All organization functions like what? Marketing, finance, design, engineering, production and customer service. What is the intention of doing all these things, like integrating all your functions, is to focus on meeting the customer needs. Not only meeting customer needs, but also what? Satisfying the organization objectives. It can be profit maximization or wealth maximization, whatever it is. So that is the definition. Pretty easy to remember. After that, we try to understand the concept of TQM in detail. So what is this TQM? I told you that the key word here is all. So what do you mean by all? Your objective of TQM is to meet what, Nana? Customer expectations by removing what, Nana? All the waste, and also simultaneously improving efficiency. Not just in one process, not just in one department, not just in one function, but in what? Everything. So the key word here is all. That is why it is called total quality management and not quality management. Okay. This requires ensuring that all the things are done right the first time itself. The same thing we have seen in Deming's 14 points also. Correct? So according to JIT also, they feel that inspection is a non-value added activity. As a result, they say, why are you depending on the inspection? Now the biggest question is, why am I depending on inspection? Because I have a doubt that I'll manufacture defective units. So try to remove that doubt. How to remove that doubt? Ensure that you get everything right the first time itself. Thereby there is no chance of defective units. Then there is no need of inspection. Are you able to get me? Right? So next. The next question is how to get things right the first time itself. Now this can be achieved by continuous improvement of all the functions of the organization, like what, Nana? Design, engineering, production, marketing, finance, through the most important wording here. What is that? Joint efforts of all. Joint efforts of all means who are they? Top level management, middle level staff, lower level workforce, as well as the third party who is supplier. Okay. Because everybody put together, what will happen? I gave you a perfect example for that. We have seen a very big example where we try to understand, okay, how all these guys put together will help you out to get a best product. Correct? Because supplier will give one input, right? Design team will give one input. Production manager will give one input. Correct? Marketing guy will give one input, saying that this is what the design that customer expects or accepts. You understand the point? You guys remember the example, right? Now we don't have time because we are revising, but what I'm trying to tell you is that we have seen a very good example where how a team together will give you a lot of advantage, right? Anyways, so after that, what did we see? We have seen certain important notes for TQM, where I told you that there is no single theory of TQM. It is just a philosophy that assumes that quality is an outcome of all the activities taking place in the organization, and everybody in the organization has to participate. Do you guys remember the same wording we have seen somewhere, where we have seen that everybody needs to participate to make this successful? Kaizen costing, very good. That was one of the important sentence. We have been repeatedly seeing that when we were studying Kaizen costing, correct? In target costing also we have seen, but in target costing mostly the designer team has to be involved completely, not the whole of the organization, correct? Yes, sir, what? But when it comes to Kaizen costing, that was not the case. Everybody has to involve at all the levels. Only then Kaizen costing will give you the desired results. Same logic happens here as well, even in TQM. Okay, another important thing is quality is not measured from manufacturer's perspective. Quality is always measured from customer's perspective. This is very, very, very important. What customer feels that this is the quality, that is the quality that we need to accept as a manufacturer and try to give the same to the customer. You understand the point? Everybody, very, very important. Keep this in mind. Expected quality standards is based on internal priorities or industry standards. It depends upon where the company stands in the industry. Okay, if the company is already benchmark in the industry with respect to quality standards, then it will go with internal priorities. If the company is not benchmark in the industry, if it is a very small company or a beginner company, then it will look at industry standards that we have seen. Then TQM is to be viewed as investment rather than cost. Correct? This we have already seen somewhere, same sentence, where business process reengineering, where we have seen that BPR should be seen as a investment in the short term and benefit in the long term. Same goes with TQM as well. Correct? After that, we have seen a question where how to use TQM to gain what nana competitive advantage. So we have 4 points over here. First one is what? Fine tuning of the existing process to improve what? Quality, to ensure that the quality is happening. And also you have to train your employees such that they will ensure that quality will be there in each and every aspect of the function of the business that you are doing. And developing commitment towards quality. That is what we call quality culture. Just like how we eat food, how we try to breathe, how we try to bathe every day, correct? Just like that, quality also should become normal. It should become normal for everybody in your company. Only then TQM will be implemented successfully. And finally, ensuring that customer satisfaction is there. When there will be customer satisfaction, automatically once you provide quality product at the desired price, automatically customer satisfaction will be there, right? Yes or no? Right. After that, what did we see? Suppose you want to implement TQM in a bank, what will you do? Very simple. You provide training to the staff. What kind of training? Not just technical training where you'll be teaching him how to open the bank account, how to look at the accounts and stuff like that, all the technical part, but also how to treat your customer, how to talk to him, how to explain him. Suppose sometimes you are not able to solve his problem then and there itself, then how to convince him that this is not going to happen today. You understand that? That's customer care. And also, next thing that you would like to do is try to give more staff to solve customer complaints faster and also reduce the length of the queue in case customer is suffering from what? Long queues in your bank. That way you can implement TQM. See, these are all one of the things how we'll implement TQM, correct? And also increase working hours of the bank for better customer experience. Suppose customer office timings ends at 5 o'clock. You also close your bank at 5 o'clock. It's not going to work. Try to open it till what? 7 o'clock so that customer can come and take the services from your bank. And finally, provide single point of contact and also what nana? Online banking services. This way you can try to implement TQM in a bank. Suppose if your bank is falling behind when compared to the competition, right? After that, we have seen something called what nana? 6 C's of TQM. So what are 6 C's of TQM? We have seen commitment, culture, control, customer focus, cooperation, as well as continuous improvement. In this, lot of things we have already seen. Already we know that to implement TQM, we need to do something called continuous improvement. Already we know that for implementing TQM, we need cooperation of everybody. Already we know that to implement TQM in the definition itself, the entire focus will be on the customer. Already we know that to implement TQM, we need quality culture, correct? Yes sir, what? And also there is something called control, which I have already explained you, right? This is one of the negative points of TQM also. There will be too much of documentation for everything that you do, isn't it? Yes sir, what? All right. So probably a little bit of new point here is that we can say commitment, where quality improvement should become a normal part of everybody's job. That I already told you. It should become a normal habit, correct? Yes sir, what? Right. Culture means, I told you, it is a change in attitude completely. Okay. That will happen once you train your employees. Next, control means what? I told you. Control is really important. I gave you a perfect example of standard costing where just because you set the standards, everybody is not gonna follow it and achieve it. You have to what? see the actuals, you need to calculate the variance. After calculating the variance, you need to get the report, you need to document it, and you have to take a countermeasure on it and punish or reward somebody who is responsible for something wrong, isn't it? This whole process we call it as control, correct? And that's why control is also important. In TQM, if you just set the rules and then leave it, it's not going to happen. You have to eventually what? Control it. And then customer focus. Yes, we know always will be focusing on the customer, not just the outside customer, but also the inside customer. Internal customer will be the other divisions, correct? And of course, cooperation means total employee involvement, where if you have multidisciplinary teams from different departments and functions, everybody has to put joint efforts and give solutions. And finally, we have something called continuous improvement. So it is not a program where you have a starting date and ending date. TQM is not like that. TQM is like a process which goes on what, Nana? Continuously. Right. After that, we have seen one important thing. What is that? Deming's contribution to TQM. We know that Deming is known as father of quality control. And what Deming was trying to say is that you guys are obviously wrong, because always you blame the quality issues to what? On the laborers. And that's absolutely wrong, because only 15% of the quality problems is due to the inefficiency of the labor, whereas 85% of the quality problems are due to what, Nana? Your inefficient processes, systems, and your poor management. Okay, right. Then we have seen very important 14 points of Deming. I told you, you need not remember this 14 points where he'll be asking you a question in the examination where please write Deming's 14 points. Will he ask you something like that in the exam? No. But what will happen is that when we are trying to answer certain case scenarios and case studies, we have to make use of these points to answer those case scenarios as well as case studies. So that is important. Okay, right. So what are the Deming's 14 points, Nana? First one, create constancy of purpose towards improvement. So what is the meaning of it? Replace short-term reaction with what, Nana? Long-term planning. I gave you MCL example there. You remember that, right? Next, adopt the new philosophy. What philosophy I have to adopt? Deming's philosophy only, where always don't throw the blame on the laborers. The actual blame, you have to rectify your own internal systems, internal process, as well as the management. And cease dependence on inspection. That we have seen already. So try to get it right the first time itself. We have seen the example of the, what is that? Printer. We have seen the example of that, oil bottle and all that. Next, move towards single supplier for any one item. Why? Because if you buy the same raw material, even though the raw material is same from different suppliers, there will be significant variations in your finished good, because each supplier will give you a different, slightly different quality of raw material. So to ensure that quality is there for one finished good, entire input should be bought from one supplier. Got the point? So that the uniformity will be there. Next, improve constantly and forever. That is nothing but continuous improvement, which we know, correct? Institute training on the job. Yes, you have to give training to your employees such that they will not create what? Defective units, correct? Next, institute leadership. I told you the difference between leadership and bossism, where bossism goes with what? Targets and pressure and all that. Leadership doesn't go with that. It goes with quality of work, okay? Next, drive out fear. What fear? It prevents workers from acting in organization best interest. Means, suppose a worker at the lowest level who is operating a machine has got a phenomenal idea to improve the operation of the machine or whatever it is, and then you have to let him come forward and share his thoughts, correct? And we have seen in JIT also, one of the performance measurements in JIT is number of ideas generated. So therefore, the more freedom that you give to the lower level workers who are operating on the machines, the better ideas you'll get, and that will be in the interest of the company as a whole. So to make that happen, you need to drive out the fear. It's not there right now, but once upon a time it was there. So we were talking about 1970s, 1960s, 1950s. You got the point? Next, break down the barriers between departments. So you see, supplying division is there. You should look at the receiving division as what? Another customer. Don't try to see him like normally what will happen before this, if supplying division is selling certain goods to the outside environment, which means to the real retail customers, and also he's selling the same good to what? Receiving division. He never used to give same importance to both the people. He will treat the external customers with real maturity, real what is that? He'll give a lot of importance on the timing and stuff like that. But when it comes to the internal customer, he used to take him in a, what do you say, take it for granted, something like that. That kind of an attitude used to be there. But Deming said that don't show this differentiation. You treat him the same way you treat what? External customer. Next, eliminate slogans. What is eliminating slogans? Earlier, they used to put a lot of posters and slogans where, because they felt that all the mistakes were on the laborers, correct? And as a result, the laborers used to get demotivated, and that was actually counterproductive, okay? It was not helping the employees to increase their productivity. So therefore now you eliminate all these things, okay, because you know that 85% problem in quality is due to what? Your own processes weakness, as well as what? System weakness, as well as poor management. So therefore now you eliminate all these slogans. They are no more necessary. And after that, we have seen something called production targets. What is that? Eliminate management by objectives. Objectives means target. You never run a management with targets, because you try to push the targets on your employees. What they will do? They will try to rush up their work. So therefore, they'll try to compromise on quality work. For example, they'll skip inspections, and then they'll try to deliver the product faster to the customer. Now this will definitely affect the quality. So don't do that. Next, remove barriers to the pride of workmanship. So if any worker has really performed well, and that should be known to the top level management, recognize that, and then try to give him a bonus or incentive or something like that. Make him an employee of the week or month or whatever it is. That will also encourage all the other employees. Overall, your efficiency of your entire employees will increase. And of course, last 2 points are very simple. What are they? What are they? Exactly. Institute education and self-improvement, and transformation is what, Nana? Everybody's job, that we know, because everybody has to involve when it comes to TQM. Correct? Then we have seen criticisms of TQM. What are they, Nana? Too much documentation, which we know. And of course, I gave you this example as well. What is that? Too much of focus is on quality assurance and not on quality improvement. I gave you the perfect example of Toyota, both Innova as well as Fortuner. Correct? So yes, once you buy an Innova, whatever they are offering, it's going to be a qualitative stuff. There is no doubt in that, isn't it? It's going to work for sure. But you're not trying to improve what you're offering. You understand the point? Yes or what? Whatever Toyota is offering, yes, it perfects. It will run for 5 years, 7 years, 10 years, fine, down the line. But when compared to the competition, you are offering less features, less luxury, less quality of materials. You understand what I'm trying to say? So there is quality assurance. Yes, whatever you are assuring is going to work. In that, there is no deceiving part. But your competitors are offering better. What about that? You try to do that as well. So that is one of the negative point of what, Nana? TQM. And of course, I've just give you one small point over here, because some of you guys are getting confused between TQM and Six Sigma. So I told you that both of them indirectly they improve the quality, but the approach is different. Six Sigma tries to improve the quality by what? Reducing the defects, by identifying the root cause of the defects. But TQM is not like that. It tries to improve the quality by focusing on process improvement, process efficiency, the way work is done. You understand the point? So totally both these guys are actually different in their approach, although the target is the same. Got it? All right. Okay. After that, we have moved on to the next one. What is the next one? We have got business excellence model. Right. Right, guys. So now we have something called business excellence model. I told you that it is a dry topic already. Correct? Right. And in the recent study material, the content has got changed. So let's try to understand. What is this? A very simple understanding is it is nothing but self-assessment for a company. So any organization would like to self-assess, themselves. So where do they stand with respect to their industry? How are they competing with respect to their competition? Do they have edge over their competition? Or are they actually weak with respect to what? Competition. If that's the case, then how they have to improve themselves so that they'll be able to what? Compete eventually. So it's just like self-diagnosis, okay? Self-assessment of an organization. Got the point? Anyways. So now, why do we need business excellence model? Well, to survive in a complicated and competitive modern business environment, a company should achieve excellence in what, Nana? All aspects of their business. Not one, not two, every aspect. So excellence in all aspects of business is nothing but business excellence. Why have to excel? Because you want to satisfy the needs of those who are impacted by your business operations. In simple words, stakeholders. Okay. You got to satisfy all your stakeholders. Okay. What kind of stakeholders? Your customer is a stakeholder, your employee is a stakeholder, your supplier is a stakeholder, okay? The banks or financial institutions who has given you loan is a stakeholder, correct? Government who collects taxes from you is a stakeholder. The society around you is a stakeholder if they are getting affected by you. You understand the point? So your responsibility is to ensure that you give everything to these guys which you are intended to give. For example, you have to make payment on time to the supplier. You have to give good quality product to the customer with good customer service. You have to give good compensation to your employees and give them good growth opportunities, correct? Yes sir, what? Right? And you have to pay your bank loans on time, and you have to pay taxes to the government on time, isn't it? That's the thing. So that is what we call to satisfy the needs of those who are impacted by your business operations. In other words, all stakeholders. I gave you two stakeholders example over here. One is employers, where you have to give them good compensation, growth, learning, experience, and for society, you have to give them ethical work. You have to ensure that you do not employ any child labor, and also betterment of your surroundings, indirectly raising the standard of living. Will it happen? Yes, it will happen. Whenever you see when there are a lot of companies, the standard of living around those areas gets what? Improved, because you have a lot of money, right? Because a lot of people will be working and you've got a lot of money, so automatically you'll buy a lot of things. Naturally, what will happen? Standard of living will increase, right? After that, we have seen the summary of BEM. What is summary of business excellence model? Excellence in what, Nana? All aspects, and satisfying the needs of all stakeholders. And there are a lot of business excellence model in the entire world. We have EFQM, European Foundation for Quality Management. We have got Singapore Business Excellence Framework. We have Australian. We have what? Japanese. But what we have in our syllabus and what is relevant for exam is what, Nana? EFQM model. Next, we try to understand what is EFQM. We have a diagram, but before we get to the diagram, first we need to understand what it is. So what is EFQM model, Ray? First of all, it has got three modules that provide a logical and systematic method of self-assessing the organization, because we know that business excellence model is all about self-assessment of an organization, correct? How to self-assess? We have three modules. What are those three modules? Module number 1 is direction, module number 2 is execution, module number 3 is results. Sir, what is direction, sir? Very simple. Why does an organization exist? Got the point? Explain the purpose of the organization and the strategy that it uses to operate its organization. Got the point? Yes or what? For example, now imagine for a moment that you are the organization. Okay, why do you exist right now? As of now, let's say that, yeah, your target is to pass what? CA. Let's put it that way for ease of understanding. Okay, then that is nothing but the module 1, direction. So what's your direction? In the direction of passing your CA, correct? Yes. For example, you take RICA. Why do they exist? They have to create what? The qualified charter accountants, and they have to manage them, isn't it? And yes or what? Right? You got the point. That's the purpose why an organization called ICA exists, right? To create these professionals, to manage these professionals, isn't it? Everybody, right? Next, module 2 is execution. So what do you mean by execution? How does it deliver on its purpose and strategy? For example, we took our example, right? So your target is to pass the CA. That is your direction, right? Next, how does it deliver on its purpose and strategy? How are you going to achieve the passing CA, which is your direction, correct? Probably you have to what? Put some efforts. You have to write some exams. You have to get minimum 50 marks and stuff like that. Yes or what? You have to prepare for it. You have to appear for the exam. All these things that will come under how. Next, results. What has the organization actually achieved and what it wishes to achieve in future? Now you will actually write the exam and we'll see your results. Okay, did you really achieve what you're intended to do? You got the point? In case if you pass, then you as an organization, you have achieved what you wanted to achieve. There is a matter, that's all. So it's a simple 3 modules. What are those 3 modules? Why do you exist? Okay, how are you going to? So why do you exist means there is a purpose. And the next question is, how are you going to achieve that purpose? And the third question is, did you really achieve that purpose? Which is nothing but results, correct? Everybody, it's a pretty simple thing. Okay, just try to remember. That's what we have in the diagram. Direction, results, as well as what, Nana? Execution. Got the point? Right. Okay, after that we have seen that there is a key term over here which I have underlined. What is that key term? Sustainable. What is that? The logic of this particular model is to connect the purpose and strategy. Purpose means why a company exists. Strategy means what is it trying to do to achieve its existence. You understand the point? Which means, say for example, a company is there. Let's say we talk about Royal Enfield, for example, Eicher Motors. So what is the purpose of that particular company? Yeah, I want to be a leader when it comes to what? 350cc segment vehicles. Let's put it that way. Got the point? So that will be your direction. Why do your organization exist and what you want to achieve, correct? How are you going to achieve it? Yeah, I try to provide quality 350cc vehicles of varied models, like Classic, like Meteor, which is a touring model. Like you have got multiple models, isn't it? And did you really achieve it? Yes, the results show that he is the market leader even today, isn't it? Yes, so it's a simple thought process. So the rationale of this business excellence model is to connect the purpose and strategy. Also find out how this connection between purpose and strategy can help the organization achieve and deliver what, Nana? Sustainable value and outstanding results for its stakeholders. When I say stakeholders, it includes your customer, your employees, your suppliers, your people who are trying to do business with you, everybody. It includes everybody, right? And the most important word here is sustainable value. What do you mean by sustainable value? Not just today, not just tomorrow. For infinite amount of time, let's say 20, 30, 40, 50 years, you have to keep on delivering the same. It's not just this year, it's not just next year, right? Then we have seen something called radar. So what is this radar? It acts as a diagnostic tool for this particular EFQM model, because through EFQM model you are trying to self-assess yourself, correct? As an organization. That is nothing but we call it as business excellence model. And for that, radar will help. Now how radar will help? First of all, what is radar? Radar is an acronym for what? R stands for results, A stands for approach, D stands for deploy, A stands for assess, and again R stands for refine. So let's try to understand them. So results means determine the results of the organization it is aiming to achieve as a part of its strategy. In our example, I just asked you to presume that you are an organization so that you'll have an ease of understanding. Then what's your results then? Determine the results that the organization is aiming to achieve. What are you aiming to achieve? Pass CA in November 2022 or May 2023, for example. Okay. Next, approach means what? The approach the organization will take to deliver the result now as well as in future. For example, based on our assumption, in our example, you are the organization, and what is the approach that you will take to pass the CA exams? You will take coaching, you will study for 10 hours per day, and you can get the right materials. You got the point? Yes. Next, deploy. Deploy means what? You have to execute this approach properly. Now, in approach, you know what to do, and in deploy, you have to execute it. In reality, you have to really do that. For example, in reality, you have to study for 10 hours. In reality, you have to take coaching, or in reality, you need to prepare from the right materials. And then finally, we have something called assess and refine. Assess and refine means what? You have to check whether what you have approached here and what you have executed, did they really work? Assessment is nothing but checking out whether it has really worked or not. How can you check whether it has really worked or not? Your exam should be, you should be passing with good marks, correct? In case if it works, then whatever you have done so far is fine. In case if it didn't work, then you have to what? Refine. Refine means what? Better what you have done. You understand the point? Then you have to change your strategy. Again, start from this one, and again you try to achieve. Got it? Anyways. Then after that, finally, we have seen that EFQM model along with the radar which we have seen just now has got the following uses. So what are the uses that we have got? First use is it helps the company to build a holistic view of its current operation. Now what is holistic view? Complete view. Okay, A to Z view. Okay, how are we operating? What are our strengths? What are our weakness? Okay, what is our market share? What are our competition? In relation to them, where do we stand? Where does our industry stand as a whole? Every single picture you will have a clarity. With the help of what? Business excellence model. And that business excellence model is what? EFQM. Next, it helps organization to drive transformation through well thought of course of actions that can change its current operations to achieve what? Excellence in operations. This steers the organization to achieve and sustain long-term vision through continuous improvement. What do you mean by this? This so-called EFQM model with radar framework will help you drive what? Transformation through well thought of course of action. For example, in our example, we were talking about passing your CA exams, correct? So what? Once you do self-assessment to pass your CA exams, that so-called self-assessment will help you what? To understand where you are right now, and it will drive the transformation. Transformation means what? The change. What needs to happen? Say for example, you're just studying for 4 hours or 5 hours a day. The transformation will happen. Maybe you'll start studying for more number of hours, or you'll start studying effectively, or you'll start studying the right books, or if you feel that you can't self-study, then you'll start taking coaching, or if you're already taking coaching, if you feel that self-study is enough, you'll go for self-study. Whatever it is, ultimately it's a transformation. It's a change. Got the point? Hello? Yes. All right. It also helps organizations sense and prepare a response for market disruption. Very, very, very important. This build agility, or in other words, flexibility and resilience in what? Business operation. I think I gave you a fantastic example for that. What example I gave you? With regard to building the response for market disruption. Something wrong happens in the market, how will you respond? The greater flexibility you will have, the response will be very strong, and you will not be affected by that. Correct? I gave you a perfect example of what? Saffola. You remember that? Did I give you the Saffola example or not? What is the challenge that they have faced? How did they really overcome that? Correct? Yes, it was a very interesting case study. Anyways, after that, the EFQM award is a coveted award, of course. If you follow EFQM, there is a good thing, because EFQM is very famous, and as a result, we will also start giving awards. And if you follow our EFQM model, then we will be giving you the best implementation of EFQM, whatever it is. And then because of that, your goodwill also will what? Increase. That point they are trying to say. Because they say that, yeah, EFQM is what? Globally pretty famous. and therefore they can bring what? Not only that, another important thing, just like your accounting standards, what they are trying to do is that if every company starts implementing EFQM to self-assess themselves, then what will happen? We'll have the data of all the companies, isn't it? So that will bring uniformity in criteria while assessing the organization relative position in the marketplace. I'll have the data of business excellence model of one organization in EFQM, another organization also in EFQM. What can I do? I can compare them. You understand the point? And then I can see what is the total position of the industry. I'll be able to understand clearly what company, where it stands. Got the point? Hello? Yes. All right. Fantastic. So with this, we're done with what? We're done with what, Ray? Business excellence model. Okay. Now we're done. Shall we move on? Bol Ray Mukus. All right. Now next we have something called theory of constraints. Okay. Now before we get to theory of constraints, I told you that we need to understand three things. What are those three things, Nana? What is a constraint? What is a limiting factor? And what is a bottleneck? Constraint means, I told you that anything that makes achieving your objective difficult than it would otherwise be is a constraint. Means suppose you want to reach a destination on your bike and reaching the destination is your objective, then in the way a pothole, a speed breaker, a traffic signal, a narrow lane, everything will make reaching your destination difficult than it would otherwise be. Correct? So all those potholes, speed breakers, that does everything, we call it as constraint. So constraint is a very big term. Okay. What is a limiting factor? We already know. We have seen it in decision making chapter. Scarce resources are nothing but limiting factor. Raw metal can be scarce, labor hours can be scarce, machine hours can be scarce. Correct? If their availability is less, automatically they'll become limiting factor. So then we have seen something called bottleneck. So what is a bottleneck? Anything that slows down your manufacturing activity is a bottleneck. So logically speaking, limiting factor and bottleneck, they are actually same. Okay. So if raw metal availability is less, automatically it will slow down your manufacturing activity. It's as simple as that. If machine hours availability is less, automatically it will slow down your manufacturing activity. Correct? So basically both of them are same. Right. After that, we have seen something called, there are two people called Goldratt and Cox, and they had a new approach for production, and that approach is referred as what, Nana? OPT. What is OPT? Optimized production technology. So what is this optimized production technology? This OPT says that you can expand your profits by increasing what? Throughput. Now what is throughput? Throughput is nothing but sales minus direct material cost. Now that throughput can also be called as a throughput contribution. For that I already told you the logic. What is that? We presume that the time scale is what? Very small. So when the time scale is very small, almost every cost will behave as a fixed cost except one cost. What is that one cost? Direct material. And therefore the only variable cost in such a kind of a scenario based on the presumption is direct material cost. So logically speaking, this formula is actually what, Nana? Contribution is equal to sales minus variable cost. And that variable cost is what? Direct material, because in this scenario only direct material is a variable cost, and the contribution will be referred as throughput contribution. So in other words, it is nothing but sales minus variable cost. Okay, right. Then we try to understand what is this OPT approach. What is OPT? Optimized production technology. So OPT basically means that they say that first of all you identify all your resources in your factory, then divide them into two categories. One is bottleneck, the other one is non-bottleneck. And then non-bottleneck resources, do not utilize them to their 100% of their capacity, and bottleneck resources, you utilize them to the 100% of the capacity. That is what OPT says. Okay, now we try to understand the logic behind that. Why are they telling us to utilize bottleneck resources to 100%, and why are they telling us not to utilize the non-bottleneck resources to what, Nana? 100%. For that we try to take an example. We took 3 machines, and machine 1 capacity per hour is how much? 5,000. Machine 2 is 3,000. Machine 3 is 6,000. Now out of these 3 machines, we know that machine 2 is what, Nana? Bottleneck. Correct? Right? Because it is slow. So we have 3 machines over here, and machine 2 is the bottleneck. Why machine 2 is the bottleneck? Because its capacity is what? 3,000 units per hour. So according to the OPT, what is that he's trying to say? Utilize this machine 2 to what? 100% of its capacity, because it is bottleneck, and do not utilize machine 1 and machine 3 to its what, Nana? 100% of its capacity. What is the logic? The logic is, suppose if you utilize machine 1 to 100% of its capacity, then you will be able to manufacture how many units, Nana? 5,000 in 1 hour. And this guy will be able to manufacture only 3,000, or he'll be able to take only 3,000 in that 1 hour, correct? And as a result, indirectly what happens, there will be a 2,000 units of WIP stock getting piled up between machine 1 as well as machine 2, that is in 1 hour. Then imagine what's the situation in 2 hours, 3 hours, 4 hours, 5 hours, 6 hours. There's a lot of WIP inventory that will get piled up. And we have already seen in JET that if WIP inventory piles up, there are two problems majorly. One is there's a lot of money that gets blocked, so you'll have a heavy opportunity cost, or working capital requirement will increase. And if any defects are manufactured by machine 1, unless the machine 2 operator works upon the pile of WIP stock over here, that defect will not be communicated to the machine 1 operator. Till that time, machine 1 operator will keep on what? Manufacturing the defects, which is not good for the company, correct? So to avoid this WIP stock before the bottleneck machine, which is M2, we say that utilize bottleneck machine to the extent of 100%, which is 3,000 units per hour. And also the non-bottleneck machines, which is M1 and M2, M1 as well as M3, do not utilize them to their 100% levels. Not utilizing to the levels of 100% means what? Utilize them to the level of what? Bottleneck, which means now bottlenecks is manufacturing 3,000, which means M1 also should manufacture 3,000, M3 also should manufacture 3,000, so that WIP will be avoided, correct? That's what OPT says, right? After that, what did we see? We have seen operational measures of TOC. What is that operational measures? We just try to understand three important terms in theory of constraints. What are those three important terms, Nana? Throughput contribution, then what? Investment, then we have something called operating expenses, correct? So throughput contribution means what? Obviously it is an inflow, so I want it to get increased, correct? Investment means it is the money that is getting blocked, so always I want it to keep at its minimum. And operating expenses is nothing but outflow, so I want it to get reduced or minimized, correct? And of course, here I told you the most important thing, even direct labor will be considered as what, Nana? Fixed cost, because there is an assumption of small time capsule. So the only variable cost is what, Nana? Direct material cost. Although sometimes in questions, he will also tell you that direct labor is also variable. If it is specifically told in the question that direct labor is variable, what do you have to do? Take direct labor as variable cost only. So ultimately it's a question that you have to follow. But 90 to 95% of the cases, only direct material will be what? Variable. Got the point? Anyways, after that, what did we see? We have seen Goldratt's 5-step method for improving what, Nana? Performance, correct? For bottleneck machine. What are the 5-step process? First, you have to identify the constraint. In our example, it is M2, correct? And exploit the constraint. So utilize M2 to 100% of its capacity, which is 3,000 units per hour in our example. Then subordinate and synchronize to the constraint, which means M1 and M3. You need to subordinate them to what? M2 and synchronize. Synchronize means what? M2 is manufacturing 3,000. Therefore, M1 and M3 also should manufacture 3,000. That is what we call it as synchronization. After that, elevate the performance of the constraint. Elevation means what? Improve the performance of the bottleneck. Right now, it is operating at 3,000, which is M2, correct? You try to elevate it such that it will manufacture something more than 3,000. How can you ensure that it will manufacture something more than 3,000? How? I told you a lot of examples yesterday. Suppose there are 4 workers who are working upon M2 machine right now. Increase it to what? 6 workers. If you feel that because of 4 workers, they are not working to the fullest capacity of M2. Suppose right now you are working 5 days in a week. You increase that to 7 days. Suppose you are working 8 hours per day. You increase that to 12 hours. Suppose there is any spare part that you can change such that the efficiency of the M2 will increase. Then you do that as well. Ultimately, you do a lot of things. If nothing is working, you can change the machine as well. That's the last resort. Ultimately, the intention is to elevate the performance of the constraint such that what will happen once you elevate the performance of the constraint, which is a bottleneck, it ceases to become bottleneck, correct? But once it ceases to become bottleneck, somebody else will become bottleneck, and again you will repeat the same process. Then you take that somebody else, he will become bottleneck, then again you will exploit, which means utilize to 100%, again you will subordinate and synchronize all others to the bottleneck, and again you will elevate the performance of the bottleneck, and again somebody else will become bottleneck, and then this keep on what? Going. So it is a non-stop cycle. Okay, so that is what I've explained here as well. Okay, chala. Right, Nana. After that, what we have seen? We have seen something called throughput accounting ratio. So what is throughput accounting ratio? Inflow per limiting factor divided by outflow per limiting factor. That's what I've told you in the simplest terms. Inflow is nothing but throughput contribution divided by limiting factor is nothing but bottleneck minute. Correct? It can be bottleneck hour or it can be bottleneck minute. Divided by outflow is nothing but factory cost per limiting factor is nothing but per bottleneck minute. Correct? So ultimately this will give us an idea of how much is inflow with respect to what outflow. Just like your profitability index in your CA Inter, correct? So generally we'll calculate this TA ratio for so many products like A, B, C. Suppose for A the TA ratio is 1.2, for B it is 0.9, for C it is 1.3. What does it mean? It means that B should not be continued to be manufactured because 0.9 means it is less than 1. Less than 1 means what? Your inflow is less than outflow. Therefore, you should not be manufacturing B. What about A and C in my example? It's greater than 1, so no problem. And C is the most profitable one. You understand the point? That way, TA ratio will help you to identify which product is actually giving you what? Good profit. Chalo. Okay, how to improve TA? This we know. If you want to increase this TA ratio, what are the two choices? Increase the numerator or what? Reduce the denominator. Pretty simple. Okay, after that, what did we see? A very important topic. What is that, Nana? Supply chain management. Right. So what is the supply chain management, buddies? It is nothing but management of what? Flow of products, not only products, services, not only services, data, which is information all the way from origin of the product, which means in our example we took the tires example, correct? Where the origin of the product will be from the forest, where the raw metal you will be getting, right? From there to the consumption of the final product, where it is consumed by the end user, correct? Who is using a bike or a car or whatever it is, right? And that we call it as what, Nana? Supply chain management. To put it very simple, ensuring that the entire chain of supply is intact. It's not broken. You understand the point? Because in that entire supply chain, you can see some 10 companies or 20 companies or 30 companies will be there, right? From the original origin and the end user, correct? If any of these companies are suffering, then the whole supply chain gets affected, correct? Yes or what? Right now, that is what is happening. Na? In the entire supply chain, there is one area in China, which is Shanghai. I don't know whether it is Shanghai or, I don't know. I think it is Shenzhen, I think so. Whatever it is, I'm not sure with respect to the name. In that area, because of Corona, what has happened? The entire manufacturing operations has got stopped, which has not been started even today, if I'm not wrong. Because of that, the whole supply chain got affected. You understand the point? And that's the reason why we have so much waiting periods with respect to our cars today. You understand the point? So from this only you have to understand that managing the supply chain is that important. That's why we have a separate topic on that, which we call it as management of supply chain, which is nothing but supply chain management. Okay, what is the objective? What is the target of this supply chain management? You have to correlate your production and distribution of the goods in case you are manufacturing something with the demand of the product such that it should match with the customer's demand, so that customers get what they want, when they want, where they want, and the price they want. But right now what's happening is that the companies are not able to match their production with the demand of the product, especially in case of cars, correct? Because the demand is very high, especially post Corona. Many people are willing to buy what? Private vehicles, exactly. And because of the supply chain shortage, especially the chips, because one organization in your entire supply chain got affected, these guys are not able to meet the demand. So they are not able to provide customers what they want, especially when they want, and also at the price they want. Now you can see price has got increased like anything, isn't it? Everybody, all right? Okay. Then we have seen something called process of supply chain management. This is very important for us, especially for solving what? Case studies and case scenarios. So the entire process of supply chain management has got how many, Nana? 4 things. What are those 4 things? Plan, develop is nothing but procure, make, as well as what, Nana? Deliver. It's very easy, right? First you plan, then you procure the raw metals, then you manufacture, then you deliver. That's all. It's very simple to remember, isn't it? Everybody. All right. So what is plan? Instead of ad hoc production, ad hoc means blind kind of production. Blind means without giving any importance to what the actual demand is. You just keep on producing on your own without any thought process, just based on gut feeling. Okay. So instead of doing like that, don't do that. You develop a proper production plan after understanding the customer requirements. You try to do the research, see how many units they want. Accordingly, you try to make your production. Then once you have done with your planning, now I have to procure the raw materials in order to manufacture, correct? Where you will procure raw materials? From your suppliers. What sort of raw materials? Good raw materials with good quality and on time. It should not be delayed, correct? After you get the raw materials, you will manufacture the finished goods, which is nothing but making. So how to manufacture the finished goods? Manufacture it in such a way that the quality is equal to the requirement of the customer. Got the point? This will automatically capture the ever-changing customer demand. For example, I gave you an example. Earlier, sedans were in demand in India. Now what? SUVs are in demand. So accordingly, every brand is launching an SUV only when they try to launch their brand. For example, Kia Seltos, MG Hector, correct? We have seen all those examples in detail or what? Alright. And finally, deliver. Deliver manufacturing product to customer with what, Nana? Excellent logistics. And I told you logistics are really important because you have to deliver on time. I gave you an example of Toyota Glanza versus Toyota Baleno. You remember that? Did I give you that example? Yes, exactly. Chalo. Okay, after that we have seen some important notes. What is that? Always logistics will play a crucial role. Right from procuring raw materials, you need logistics. Movement of raw materials in the plan also, you need that. Delivery of the final product to whom? Customers. You need good logistics. For example, Amazon and all these guys, they're taking, I gave you the real life example of what? E-cart. You remember that? Alright. Next, warehousing also plays a crucial role. I gave you the example of Samsung mobile phone. In case your screen gets damaged, you try to go and try to give it to the service center. And if there is no local warehouse, if there is a centralized warehouse, I explain you how it will happen. Correct? You guys remember that or what? Alright. Next, seamless flow of information is also critical. Right from capturing customer requirement to production plan to intimating supplier for supplying what, Nana? Raw material. For that you need integrated ERP. Here also I gave you example of McDonald's. Do you guys remember or what? Seamless flow of information. I also gave you example of Amazon. Correct? Also, SCM is the backbone of e-commerce industry, which requires fulfillment of orders from any place and any time. That we know. Why? Because SCM research is a core reason why e-commerce industry has got boomed right now, isn't it? Because in e-commerce, basically what happens, you got to connect a lot of people, that too on a real-time basis, isn't it? Yes sir, what? I gave you that example as well. And because there was a lot of study already went through into SCM, and that SCM worked as a backbone for your e-commerce boom. Got it? So which means what you're trying to say is that if there is no SCM, there will be no e-commerce? Absolutely yes, that's what I've told you already, isn't it? Yes? Alright. Okay, finally, later we have seen types of supply chain. How many types of supply chain we have? Two types. What are they, Nana? Exactly. One is push model. The other one is pull model. Push model means what? First of all, we will decide a product. I gave you Colgate Plaques example. You remember that? And then we will try to push the product into the market by doing what? Advertisement. And customer will not ask for anything, correct? But in pull model, what happens? Customer will demand the product and then he will pull the dealer. Dealer will pull the company through, let's say, I gave an example, right? The last department in the company, let's say production department 3. Production department 3 will pull P2. P2 will pull P1. P1 will pull the supplier. You remember that? That's why it is called as what model? Pull model. I explained you with the help of this example, correct? So this guy pulls this guy, 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 and this guy pulls what? Vendor. So it is pull model. That's why, because you are pulling, correct? Hello, here what is happening? He pushes here, this guy pushes here, this guy pushes here, this guy pushes here, and finally you push it onto the customer through advertising. Got the point? Or we can also call it as marketing, correct? Hello, alright. So after that we have seen SCM for service industry. What are the problems that we're gonna face in service industry? Basically services are more customized, unlike your products, correct? So therefore, meeting customer requirements which are uncertain, and also they will be what? Ever changing. That's the biggest challenge you will face once you try to implement your supply chain management in a service sector industry. The best example that we have seen yesterday is what? Tourism industry. I explained you that. You remember that? So customer requirement should be fulfilled considering capability of the organization, which means we should not give over promises more than what we can capable of doing. Yes. In other words, there has to be a balance between meeting customer requirements and also maintaining effective supply chain management. What is effective supply chain management? Customer and company both get required level of service in what? Nana? Cost effective manner. Got it? All right. So example I gave you, if you are running a tourism industry, okay, tourism company, accept only those packages where customer and tourism company both can get what? Required level of service from their suppliers. From their suppliers means what? I ask my customer to go to some other place, Nana. Like for example, let's say it is Sri Lanka. Suppose in Colombo. In Colombo, I'll have my own partner, my supplier. As a tourism industry guy, I'll have a taxi partner. I'll have a hotel partner, isn't it? Is that what? So what I have to do when the customer comes to me, look at the wording. Accept only those packages with the customer. I'll accept only those packages from the customer. Means what? I will only give some promises to the customer such that where customer and tourism company, customer and me, I'm the tourism company, both can get required level of service from their supplier. Means what? I need to get money from him, right? Plus the customer needs to get required level of service, whether it can be food or it can be transport or it can be sightseeing places, whatever it is. You understand the point? Yes, everybody. All right. After that, we have seen that there are two things in supply chain management. One is upstream, the other one is downstream. So what is upstream, Nana? So I am the company. Above me, we call it as up. Who is above me? Supplier. So all managing of all the transactions with the supplier, I call it as upstream supply chain management. Who is below me? Customer, right? So all management of all the transactions with the customer, we call it as downstream supply chain management. Now upstream is very simple. I told you it is not that important as well. And there are only two things when it comes to upstream. What are those two things, Nana? One is relationship with supplier. The other one is use of information technology. What do you mean by using information technology? You try to source the supplier online, which we call it as e-sourcing. And you try to what? Purchase the raw materials from the supplier online. You try to make payment online, which is nothing but we call it as e-sourcing, e-purchasing and e-payment, which is nothing but use of IT. Another thing and most important thing is maintaining the relationship with the supplier. That also comes under upstream supply chain management. What do you mean by maintaining relationship? For example, what are your strategies when you try to finalize a supplier? First of all, do you need supplier? Then try to take a make or buy decision. If I manufacture on my own, what's going to be my cost? If I try to buy from the supplier, what will be my cost? Accordingly, take a good decision. Then try to identify number of suppliers. And don't always depend on one single supplier. You always depend on multiple suppliers, but have relationship with one core supplier. Then cost, quality and speed. So your supplier should be selected based on three important criteria. What are they? Cost, so that he gives you at an affordable price, plus the quality of the raw material should be good, plus he should be able to deliver faster as per the promise. Got the point? Everybody, right. After that, what do we have? Source. Source means what? The supplier should be nearby, the location should be nearby, and he should be available all the time in case of emergency as well. Correct? Right. After that, what did we see, Nana? We have seen something called downstream supply chain management. In that, I told you only two things are important. What are those two things? Customer relationship management and relationship marketing. Brand strategy and use of IT are pretty simple. Okay, first we started with relationship marketing, where we have something called what, Nana? 6 market model. Okay. What is this 6 market model? See, as per relationship marketing, what is your objective? Your objective is to keep your existing customer, but also to attract what, Nana? New customer. Exactly. Isn't it? Right. So to do that, one organization should have proper customer care, appropriate prices, and also what, Nana? Helpful staff. To achieve this, organization should focus on 6 market domains. So we have seen that 6 market domains, right? What is the first market? Supplier market, where supplier itself will act as a customer. Then we have internal market, where your own staff also should act as your customer. Correct? Then we have recruitment market. I need good relationship with the recruitment so that I'll get the potentially good employees. Without them, I can't manufacture a good product. I can't provide a good quality service. Correct? Then influence market means we have seen Instagram influencers. Correct? They will influence our product through advertising. Of course, we have to pay them money. Then we have customer market. Once our customer is satisfied, he himself will act as what? Reference. He will refer. And then we have referral market as well. Here we will refer it officially. We'll give them some money that if you refer, then so much money will pay you, right? Just like how apps are doing. Whereas in customer market, it will happen unofficially. Customer out of his own interest he'll do without any monetary compensation. Got the point? Yes, everybody. All right. Then we have seen use of IT. Of course, in use of IT, how will you maintain your relationship with the customer? You will send him what? Mails. Also, you'll try to give him some links. You try to sell your product through what? E-business, and also monitoring your customer transactions, which we have seen daily in our social media. Correct? And then Amazon is also doing the same thing. Nah? Once you search something in Amazon, you know what's going to happen. It will really bombard you with what? Advertisement, isn't it? Buy this, buy this, buy this, buy this. Just like in that movie, Junior NTR movie is there. Andhra Wala. In that one old lady will be there. She'll be always behind Brahmanandam. You remember that? Yeah, I actually get the same feeling. The moment I try to search something, then you open Insta, you open anything, then there'll be Babu, please buy. Babu, please buy. Babu, please buy, like that. You will be bombarded with ads, isn't it? Yes, so what? All right, obviously. Right, then brand strategy. I think I gave you example for this brand strategy as well. For example, the moment we think about orange, immediately what comes to our mind? KTM bikes. The moment we think about green, what comes to our mind? Kawasaki, isn't it? We have seen all those examples, right? So use of logo or specific color or any other means to make the product distinctively visible. Just goes with Apple as well. Their logo, isn't it? And I told you the example of Apple stickers. How once upon a time, what was the intention behind Apple stickers? How they were taking on IBM once upon a time and all those things, isn't it? Yes? Right. After that, what did we see, Nana? Customer relationship management. This is very, very, very important. What is this customer relationship management? Knowing the needs of the customer and providing best possible solution based on the personal information. Very core thing here. You will understand the personal information of the customer, his purchase history, as well as his buying preferences. Because we know that a satisfied customer will bring in more customers and a dissatisfied customer will take away a lot of customers from you. That we know, correct? Okay, in that we have divided them into so many subparts. First part is analyzing a customer and their behavior. Second part is customer account profitability, which can also be called as customer profitability analysis, which we'll see in SAOA chapter, correct? Third one is customer lifetime value. Fourth one is what? Selecting a customer, acquiring him, retaining him, and then extending him, correct? All right. Now, what is the first one? Analysis of customer and their behavior. Means what? You got to understand the customer and his buying characteristics based on a lot of things. One is his geographical location. I gave you the example of Uttarakhand versus us, correct? Then purchasing characteristics. What is purchasing characteristics? What is his nature? Will he wait if there is a waiting time, or would he like to enjoy the car or bike immediately? What's his purchasing characteristics? How many years once he will change the car, he will change the bike? Everything will be studied. You understand the point? Then expectation of benefits, which is quality, discount. It depends. That's the reason people buy in December. I told you that example as well, isn't it? Especially when it comes to cars. And safety need. I gave you the perfect example of what? Tata and Mahindra. That too nowadays. And that too all the other cars also, they are improving their safety because the perception of what is that? Yeah, people have got changed, isn't it? And of course, social need. I gave you the example of Toyota Innova and one of my friend, real estate friend, why he specifically bought what? Toyota Innova, because there is a social purpose in the society, the way they look at Innova, isn't it? Did I tell you that example? Exactly. All right. Next, moving on to the next one, customer account profitability. So I told you that when you open your internet banking of your banks, you'll find a area called offers where you'll have pre-approved loans and all that. I told you the reason behind that, how these things will work, isn't it? For that, what did I tell you? Exactly. They will try to analyze each and every customer. They'll try to analyze what is the revenue they earn from that particular customer minus what is the cost that they've incurred to give that sort of a service to that particular customer. And finally, they'll divide the customers into 4 categories, which we call it as what? Platinum, gold, iron and lead, correct? And platinum customers are the most profitable customers. Gold are profitable. Iron is not profitable but desirable. But the last one is not profitable, not desirable, correct? Yes or what? And of course, to calculate this customer account profitability, you need the information based on activity based costing. That also we have seen. And of course, we'll be solving problems based on this concept in which chapter? SAOA chapter. Another concept name called customer profitability analysis. Right now, we'll not be doing all those things. We just try to understand. So, as I told you, think from bank's perspective, because bank is the example that we have taken. Okay. So what will happen, Anna? Bank will analyze the customer, all the customers, and it will split the customers into segments. And then it will calculate the annual revenue that you earn from every customer. Then it will calculate the annual cost of serving the customer. Then revenue minus cost will give it an idea of who is the most profitable customer and who is the least profitable customer. And eventually it will eliminate the unprofitable segments of customers. Correct? And then we have seen an example over here, how if a bank wants to give credit cards, okay, how they will try to divide the customers into these categories. And mostly for platinum and gold customers only, you will receive calls from banks saying that the credit card is for lifetime free, that, this, and all those things. You understand the point? Hello, everybody. And this is also a kind of a strategy only. That is the reason only offers will be there on credit cards more than debit cards. Have you ever observed? Because you want to make people buy with the money they don't own actually. Even today, I don't have any credit cards because I don't like buying things which is not my money, you know. You understand the point? And also I'm very bad at remembering the due dates. So in credit card, you'll know what will happen if you don't remember your due dates, isn't it? You'll be like fined like anything, isn't it? Chala. Anyways, now moving on to next one. What is the next one? You've got customer lifetime value. For this also I gave an example. Engineering college, and in that surrounding engineering college, if you have a multiplex, and I know that this guy will be studying in this engineering college for 4 years, and he'll be regularly coming to my multiplex for theater, he'll be buying snacks and all that, then I will calculate the customer lifetime value, correct? Which is nothing but present value of future cash flows of from this particular customer for a period of how many years? In this example, 4 years. So customer lifetime value is nothing but net present value that a company desires from a customer over an entire lifetime. So here you have to take a judgment with regard to the duration of the relationship. In our example, what was the duration? 4 years. By considering customer loyalty, estimated frequency of purchase, which means how many times he'll come, and is there any comp data that we are going to get? Say for example, another mall can come, correct, in the nearby place. Exactly, right. Moving on to the last one. What is the last one, Anna? Selecting a customer. How to select a customer? I told you. BMW selects their customer in a different way. Maruti selects their customer in a different way, isn't it? Similarly, if you want to have a veterinary clinic set up, then you select your customer in a different way. You generally open the clinic in a rich area. I told you all those examples, correct? You remember that? And then you want to acquire the customer. We'll go for search engine optimization as well as what? Advertising. That also I've told you, right? And then you have to retain your customers, correct? How will you retain your customers? Give them quality product, give them quality service. Automatically they'll be retained. And of course, finally, once you have retained your customer, you have to what? Resell him, cross-sell him, upsell him. What do you mean by reselling? Say for example, it's a mobile phone. After 1 year, he's going to change the mobile phone. What he will do? He'll give you the old phone and then he'll take the new phone. That is reselling. Suppose he wants to upgrade the mobile phone, then I'll take the old phone and then I'll sell him a costlier one. That is upselling. Or if I take the mobile phone and then I'll try to give him what? Accessories along with the mobile phone. You understand the point? Sir, this Bluetooth speaker is good, or this earphones is good, or AirPods or something like that along with the mobile. We call it as cross-selling. Got the point? Chala, fantastic. And finally, we have the last concept. What is the last concept, Nana? Gain sharing arrangement. I told you, I gave you that movie example. You remember that? So gain sharing arrangement means, let's say there is a hospital, and hospital gets lots of patients, and they need to do a lot of diagnostic work, like CT scans, a lot of scans, and blood tests, that test, this test, and all that. They don't have the equipment with them, nor they have the machines. So they have two choices. Either they can buy all this and they can recruit the doctors for this and then everything do it themselves. Or there is another guy, like say for example Vijaya Diagnostics, who can do all the job for you. He is the supplier. Okay. So in this case, what will happen? That diagnostics guy, the Vijaya Diagnostics, he will take the first step. He will come to the hospital. He will say that, say, instead of you buying everything on your own, which is going to cost you so much, and then you have to recruit the doctors, which will cost you so much, and then you have to pay them salaries, and they will do only this level of service when compared to us who are already what? Experts. Instead of that, if you can, refer all your patients to us, where we will be doing their diagnostics, scans, etc., then this much is the profit that we can earn based on the difference between the fee that you collect and the cost that we incur. Okay. And this profit we can, share in this ratio, like 60-40 or 50-50, whatever it is. Are you able to understand? And also, the supplier here in this case, Vijay Diagnostics, says that in case we are not going to get any profit, then you need not pay me any single rupee. So without any guarantee of payment, I'll start providing my service. Correct? That we call it as what, Nana? Gain sharing arrangement. Because in this example, they're sharing the gain. Correct? Yes or what? Right. So supplier performs his side of the contract with no guarantee of receiving what, Nana? Payment, and payment will be based on the benefit to the customers. So basically, who is the customer here in my example? Hospital. Hospital is the customer. You understand the point? Hello? Yes. So basically from this arrangement, either the supplier can be rewarded with large return or can walk away with nothing. So GSA seems to be win-win situation for both supplier as well as customer, since interest of both the parties are aligned. In my example, that was the case. Correct? Another angle of GSA arrangement is that you need to take a lot of precautions when you are entering into GSA agreement. What are the precautions? First one, you be specific and both the parties need to transfer the data honestly. Are you able to understand? Only then both the parties will know exactly how much profit or is it getting earned, so that they will be distributing that in a good way. Correct? If you are not honest with the other guy, if you are not transparent, then what will happen? Maybe the other guy feels that you are showing a wrong data, then the whole agreement will not work. Correct? Next, predefined formula for sharing of benefits. That is also very important, so that tomorrow there is no confusion after the GSA has been implemented. Efforts from both entities are required, not just the supplier. Supplier will only agree for no guarantee of payment. That's all. That's the good thing that he's doing from his side. That doesn't mean that only supplier has to work. Even the hospital also has to work in this case. Correct? Yes. And finally, poor drafting of clauses or inaccurate GSA formula can lead to failure of GSA, because it will lead to conflict. Once there is a conflict, naturally GST agreement will be what? It will collapse. As simple as that. Got it? Chalo, that's it. So with this, we are done with the revision of what? Very quick revision of what? Modern business environment. Now you guys can take a break. Okay? Chalo. After that, we'll start solving sums.
Right, and hello friends. So welcome back to PKSR classes. Okay, this is your CA Prasanna Kumar, and we will go with another revision lecture. Now this time the chapter is going to be strategic analysis of operating income, a very important chapter, especially for the upcoming attempt. Okay, so try to concentrate. And as usual, I have been telling this in the previous decision making, transfer pricing, all these revision chapters as well, that if you want to buy this power notes, you can buy the hard copy from PKSR classes app. I'll put the link for the app in the description. You can download it directly from Google Play Store. Okay, and I'll put the link with respect to iOS. Okay, for those Apple users, that link also I'll put it in the description, so you can directly download and you can order and you can get it, so that you'll be able to follow these revision lectures in a much better way. Anyways, having said that, so this is a rapid revision marathon. Okay, so therefore we don't have sufficient time. We need to cover as much content as possible within a time period of 1.5 hours for this particular chapter. Okay, so we'll try to do that. So therefore I want you guys to follow this entire session with utmost concentration, and don't try to fast forward it, because already the session will be in what? Fast forward, because it's a rapid revision marathon. Right, anyways. So the chapter is strategic analysis of operating income. So if you look at the bird's eye view of this particular chapter, we have, these are all the contents that we have got. Strategic profitability analysis, under which you have got growth component, price recovery component, and productivity component. Apart from that, we have activity based costing, ABC, activity based management, cost management, ABM. Under that we have value added and non-value added activities. Then we have got activity based budgeting. Apart from that, we have got profitability analysis through activity-based costing, DPP, direct product profitability, and CPA, customer profitability analysis. Customer profitability analysis, CPA, is nothing but customer account profitability, okay, which we have seen as part and parcel of SCM, that is supply chain management. Okay, so both are nothing but the same. Anyways, now this particular area we are not going to cover in this particular chapter. It will be covered as a part and parcel of what? Standard costing, and that is the right thing to do. Are able to understand? I've seen many students by hearting this particular area out of your study material. I think some 3 pages full of formulae is present in your ICA study material. So I've seen students, what they're trying to do is they're trying to by heart this. Don't do that. Without by hearting, with just mere common sense and logic, you can easily cover this particular concept. In fact, this particular concept is very easy, trust me. But you should be covering that as part and parcel of standard costing, not as part and parcel of this particular chapter. That is the right thing to do. So keep this in mind. You have our standard costing revision marathon. I think 4.5 hours. I've already uploaded, I think 2 months back. It's a very comprehensive revision. You can just follow that particular revision session to have an idea. Okay. Chalo. Anyways. Right. Let's move on. So now we'll start with the first one, profitability analysis through activity based costing. This particular concept is already covered by me even in revision lectures as well. Okay, as part and parcel of decision making chapter under activity based CVP analysis. Already decision making revision lectures has been done, and activity based CVP analysis already has been covered. So you can check out that particular lecture. Okay, right. Now let's move on. So let's look into the introduction part. in modern manufacturing environment and service sector right now, whatever the new manufacturing environment that is happening, direct costs are relatively low and overhead costs are relatively high. And not only overhead costs are high, but also they tend to be not volume related. This is not a new concept for us. We have already seen this in decision making revision. Okay, in decision making revision, we have already seen this. This is not new. I've already explained you what was the, once upon a time, what was the situation. It was seller's market. Now it is buyer's market. And when I was trying to explain you activity based CVP analysis and activity based costing concept also, we have already seen as part and parcel of decision making chapter. There I've clearly explained this. So once upon a time, direct cost used to be 90%, indirect cost or overheads used to be less than or equals to 10%, but now direct cost is somewhere around 60% on an average, indirect cost is somewhere around 40%. Are you able to understand? So this is what we are trying to say here. Not only that, they also tend to be not volume related, means we have seen non-unit based fixed cost. I hope you guys remember that, which means those fixed costs which does not vary with respect to change in volume, but they vary with respect to change in something other than volume, like number of setups, number of requisitions, okay, number of inspections, something like that, cost drivers. Okay, so this whole thing is something that we know. So it is nothing new. We have already seen as part and parcel of decision making. Even in revision, we have covered. So in this kind of situation, activity-based costing with its emphasis on activities and their cost drivers helps cost to identify more easily and manage more efficiently. That's obvious. We already know the concept of activity-based costing. So that is also not something that is new. We have seen it as part and parcel of decision-making revision. Let's move on to the next one. Let's have an example. Let's say there are two products, A and B. Units produced are 10,000 and 10,000. Okay, Mishnas is 20,000 for A, 80,000 for B. Variable cost per unit is 3 and 4. Now, if you look at the fixed overhead cost, setup cost is 1 lakh, depreciation is 2 lakhs, and delivery cost is 1 lakh. Total fixed cost will be how much? 4 lakhs. Okay. So what you have to do is that allocate this total fixed overhead cost, which is 4 lakhs, to product A and B using traditional method, that is Mishna's method, as well as traditional method or absorption costing method, and then determine the total cost. Right? And here one assumption that we have taken is budgeted units and cost are same as actual units and cost. That's the only assumption that we have taken because we are trying to understand the concept over here. So let's try to keep it simple. Okay. So it's pretty simple right now. So first we need to calculate Mishna rate, or you can also call it as overhead absorption rate, or you can also call it as cost driver rate, which is nothing but total overhead cost. Okay. This one, which is 4 lakhs, that is budgeted overheads right now, divided by total Mishnas. Are you able to understand? Because right now we feel that Mishnas is the predominant influencing factor. This is nothing new. I've already covered this as part and parcel of decision making revision. There we have seen concept of absorption. I don't know whether you guys remember or not. If you have seen that lecture, you will be able to, remember. Concept of absorption we have seen already. In that, we have already covered this particular concept. Anyway, I'm just trying to brush it up one more time. Okay. So Mishna rate is nothing but total budgeted fixed overheads divided by total budgeted Mishnas. So which is 4 lakhs over here. Total Mishnas is 20 plus 80. So which is going to be how much? 1 lakh. So you got the Mishna rate as 4 rupees per Mishnar. Okay. Now let's calculate total cost of product A, which is nothing but direct cost plus indirect cost, DC plus IC. Or in other words, variable cost plus overhead cost. Now direct cost is how much? 3. That is directly given. So put it over here. What about overhead cost? So you guys need to look into overhead cost over here. How many Mishnas they have taken? So you've got 10,000 units produced. Mishnas total is 20,000, which means 20,000 divided by 10,000. Per unit it will be 2 hours. Each unit will take 2 Mishnas. Per hour the rate is 4 rupees. So 4 into 2 Mishnas, you get the overhead cost as 8. The total cost of product A will be 11. What about total cost of product B? Already you have got the direct cost, which is 4. Put it over here. Then indirect cost, 80,000 divided by 10,000 units. 80,000 Mishnas divided by 10,000 units means 8 hours per unit, right? So 8 hours into 4 rupees per Mishnar, which we have calculated. So you've got the total cost of product B as 36. Okay, right? So this is what we do as per traditional system, traditional method. You can also call it as absorption costing method. You can also call it as Mishnas method, whatever it is, right? This is traditional method. In traditional method, I told you there are 6 different types of overhead absorption rates. It can be material cost, it can be labor cost, it can be prime cost, it can be Mishna's method, it can be labor's method, it can be units method. Out of these 6, we are using this particular method in this particular problem. I mean, in this particular example, which is Mishnah's method. Are you able to understand? So which means you need to understand that Mishnah's is the predominant influencing factor. Mishnah's is the one which is dominating that particular production department, and therefore we have taken Mishnah's. Suppose if laborers is dominating that particular department, we would have taken laborers instead of Mishnah's. Okay, and the entire process remains the same. Total budgeted fixed overheads divided by total budgeted laborers, and then it goes on, right? Now, let's look into some additional data. Cost driver, I hope you already have an idea. Okay, the one that drives the cost, or a factor that causes the activity to be performed. For example, for setup cost, number of setups is the cost driver. Okay, for requisition cost, number of requisitions, number of material requisitions is the cost driver. For inspection cost, number of inspections is the cost driver. So I hope you guys are aware of it, right? Now we take two examples over here, number of deliveries and number of setups, and I gave you the numbers of number of deliveries for product A and B. That's what we are seeing right now. Okay, product A and B. Anyways, so let's solve the same problem as per activity-based costing. Now, you know the concept of activity-based costing. Why? Because we have covered that as part and parcel of decision making. I'm repeating this again and again because you need to understand that you need to watch that particular revision lecture first, and after that you should be coming over here. You should not be watching this directly. So if you are watching it right now, just stop the video over here, go back to the revision lectures that you have done, which is decision making and transfer pricing, and then come back to this one and then listen. Okay, right? Anyways. So how to solve this as per activity-based costing? Very simple. The first column will be different types of activity. In this case, it is setup, depreciation, and delivery. Here, setup, depreciation, and delivery. 3 activities. This is what we have taken over here. Right? Okay, next. Cost pool is nothing but amount. Cost pool is nothing but amount. Copy paste from the example. If there is a question in question, this information will be available. You just need to copy paste. Next, cost driver name. For setup, the cost driver will be number of setups. You just need to match that. So it's very simple. For depreciation, obviously Mishnah's, presuming that, the depreciation is happening because of usage of machine. Delivery, number of deliveries, very simple. So now you need to take cost driver quantity. Now please be careful here that when you are taking cost driver quantity, you should take the total. Sir, what do you mean by total, sir? For example, if you look at setup, only 2 products information is given. Number of setups is how much? 900, 100. So total should be taken. Total means how much? 1000. 1000 should be taken over here. Keep this in mind. Always, when we are trying to take cost driver quantity, you should always take the total. Okay, you should always take the total. Now depreciation, same logic. Mishnah's is the cost driver quantity. You should take total Mishnah's. Means, 20,000 and 80,000. So which means total will be how much? 1 lakh. Take that over here. Delivery, number of deliveries 9,200 and 800, 10,000 total, right? Now divide cost pool with cost driver quantity, you will get your cost driver rate. Okay, 100 rupees per setup, 2 rupees per Mishnah, and 10 rupees per delivery. You got it? So this is what we have done. Okay. So this is setup cost, which is 1 lakh divided by number of setups. Depreciation cost divided by Mishnahs, and delivery divided by number of deliveries. Now, once we are done with this cost driver rate calculation, which is nothing but multiple cost driver rate or multiple absorption rates. I hope you guys know this concept already. We have seen this in decision making chapter. As per traditional system, you will have only one Mishnah rate or one cost driver rate, only one, which can be the predominant influencing factor. But as per activity-based costing, you'll have multiple cost driver rates or multiple absorption rates. We have calculated that over here, 100 per setup, 2 per Mishnah, and 10 per delivery. Now let's calculate total cost as per ABC. First one, setup cost. What is the number of setups for product A? The number of setups for product A, here it is, 900. Per setup, what is the cost? 100. So 900 into 100. Got the point? That will be your answer over here. Same here, 100 into 100, right? Very simple. Next, depreciation, same logic. Okay. So Mishnah's is how much here? 20,000, 80,000. So 20,000 into per Mishnah rate, 2 rupees. 20,000 into 2. That's 80,000 into 2. Pretty simple. Same logic applies for delivery as well. 9,200 into 10 per delivery, 800 into 10 per delivery. So 9,200 into 10, 800 into 10. So once you are done with all this, you'll be getting your total overhead cost. Once you have got total overhead cost divided with number of units, you'll be getting overhead cost per unit. Then you add it to the direct cost, you'll be getting total cost per unit. Pretty simple, done. So finally, the summary is When it comes to traditional system, your overheads will be allocated to the departments, which I think you would have done in your CA Inter or CMA Inter, whatever it is, where we have primary distribution and secondary distribution, and directly from there it will go to product. So try to understand how it happens from overheads to departments, from there to products. Whereas as for activity-based costing, from overheads, it will directly go to activities, and from activities, it will go to product. So this is the difference. Keep this in mind. Okay. This is the difference between traditional system and activity-based costing system. Right. Now let's move on to the next one. The next concept is direct product profitability. So what is this direct product profitability? Let's try to understand. See, if there is any firm with a portfolio of profitable products, when I say portfolio, it means that you'll have like 10 products or 20 products or 30 different products. Okay. They enjoy very high profitability. Okay. In that kind of situation, it is very important to know profitability of each and every product. We can say profitability of individual product. So that as a management who is doing business, you can concentrate on the most profitable products and you can eliminate the least profitable products. So this is a common sense way of doing business, right? DPP is generally used in retail business to determine profitability of individual product. Because in retail business, calculating profitability is not as easy or as simple as you think. You guys might be thinking, sir, when it comes to retail business, what is this, sir? Let's say you take a biscuit packet, okay, for example. Let's say it's a Mary biscuit. You buy it at 10 rupees from your vendor and you sell it at 12 rupees to the retail customer. You get a profit of 2 rupees. It's that simple, isn't it, sir? No, sir, that's absolutely wrong, sir. You'll try to understand. So therefore, when you have a portfolio of products, especially retail sector, you just imagine how much of portfolio of profitable products they have got, hundreds and thousands, isn't it? So in that kind of situation, trying to manage, trying to keep those products which are profitable and trying to eliminate those products which are not profitable is not that easy. It's very difficult, very complicated as well. So therefore, we use something called direct product profitability in retail business to understand the profitability of individual product. Okay, right? So let's go further so that you'll be able to understand this with much more clarity. Traditionally, what happens? Retail stores will reduce purchase prices of goods from selling price to get a gross margin. That's what I've told you right now. So you will reduce the purchase price from the selling price. Selling price of Mary biscuit is 12. Purchase price is 10. You'll get your gross margin, which is 2. This is what traditionally we used to do. That's what I've put over here. This can lead to wrong decision with respect to what? Profitability. How, sir? I'll give you an example. Let's take tissue paper. Tissue paper, when you try to calculate gross margin, which is nothing but the price with which you have purchased from the vendor and the price at which you have sold to the retailer. Your gross margin is 15%. Looks all good. Ice cream also. The price with which you have purchased, say for example, is 80 or something like that, whatever, I mean the cost, and you have sold it at 100, for example. Whatever it is, okay, just imagine. The difference between your purchase price and the selling price is nothing but gross margin. So for tissue paper and ice cream, the gross margin looks solid. It's very good, right? 15% and 20%. But if you look into direct product profitability, it's 0 and 4%. Sir, why, sir? Why? Because tissue paper takes a lot of space. And your proportionate rental apportionment, rent cost apportionment is very high. Ice cream is a refrigerated product. So there is, in addition to your cost of buying the ice cream from the vendor, you're incurring a lot of refrigeration expenses, right? The power bill or whatever it is. So therefore, as per DPP, while calculating individual product profitability, DPP uses variety of measures like space used for storage, space used for transportation, okay, which can be non-refrigerated transportation, refrigerated transportation, and all these things will influence your product cost. Are you able to understand? Therefore, you'll be able to ultimately find out which product gives you exactly good amount of profit and which product gives you really not so good profit. For example, here you were actually on a wrong opinion that tissue paper and ice cream is giving you good amount of profit when you have calculated your gross margin, but in reality, it's giving you nothing. So this is where DPP makes a whole world of difference. That is direct product profitability. Got the point? So here you can see certain expenses which are not impacted or influenced by the products are not allocated to individual products. This is also very important. For example, head office expenses. Are you able to understand? These are all head office expenses are not influenced by tissue paper as a product. Head office expenses are not influenced by ice cream as a product. Therefore, don't allocate those head office expenses to these individual products to calculate direct product profitability is what we are trying to say. So certain expenses which are not impacted or influenced by products that are not, which are not influenced by products or not allocated to individual products. Anyways, now, so which means you guys need to remember that head office expenses should not be allocated to individual products to calculate DPP. There ends the matter. That's it. Now let's move on to the next one. So DPP basically what it does is that it analyzes the indirect cost into four major categories. What are they? One is the overhead cost, where you will try to allocate them based on activity-based costing, which we already know, to the products. Apart from overhead costs, you'll have volume-related cost. Okay. So which means more the volume that you occupy, more will be the cost. That is storage and transportation cost. Apart from that, you'll be having product batch cost. Okay. Which means when a batch of the product is kept on shelf or a warehouse, you're storing it. Just try to imagine a godown, you're storing it. Okay. So then you'll incur cost. More the time that you store, more will be the cost, right? And inventory financing cost as well. How much money is getting blocked? Okay. Whatever the cost of the product with which you are purchased, into the interest rate, or able to understand. For example, 1 lakh worth of inventory is there in your godown. So which means 1 lakh worth of your money is blocked. Are you able to understand? Otherwise, you would say, for example, you would have invested that 1 lakh in a bank, you would have earned an interest of 10%, which means into 10%, which means 10,000 you're losing right now. That will be your inventory financing cost. Are you able to understand? The simplest way of understanding. Or the other way of understanding is this 1 lakh which has got blocked, you have got it as a loan. Say, for example, working capital loan, and you are paying some 15% interest on that. Then that will be your inventory financing cost. Either way, whichever angle you want to understand this logic, you can understand. Okay. So these are all the cost according to DPP. Okay, so the entire indirect cost related to your products has been divided into four: overhead cost, volume related cost, product batch cost, and inventory financing cost. So keep this in mind. You got it? Now, overhead cost means directly you will allocate that to the products based on activity based costing. Volume related cost, I told you, more the volume they occupy, more will be the cost, like storage and transportation cost. Product batch cost means, I told you, it is generally based on time. You will understand once we start solving some examples. Inventory financing cost, just now I have explained, so it's clear. Next, what are the benefits of this so-called DPP? Let's try to understand that. Now, when it comes to this particular benefits of DPP, I hope you guys can just read it and you can understand. Pretty simple. Okay, it will help you to analyze the cost better. It will help you to take better pricing decisions. Okay, it will help you to rationalize your product range. Rationalize means you taking decision with respect to product range in such a way that it will benefit you in the maximum way. Benefit you in the sense, I'm the one who is doing business, which means it will benefit you, the guy who is doing business, in the best way possible, right? And better management of store as well as warehouse. You'll be able to manage the space and all the other things better because of DPP. You know which product to be put in which place and all that, right? So it's general points. Okay, you can just look into that once. Now let's move on to the next example to understand DPP. Now, where are we right now? We are trying to understand the concept of direct product profitability. Are you able to get me? Right? Chalo, let's move on. Now listen carefully. With respect to this particular example, we'll be able to understand the concept. Fatafat, we'll finish it off. Now, a firm is selling three products A, B, C through retail stores. Other data is as under. You have got A, B, C. Quantity per cubic meter is given, which means number of units in 1 cubic meter of space. Okay, right. So 12,600, 4,032 and 2,880. Time in the retail store. A is there for 1 month, B for 2 months, C for 1 month. Product A and C requires refrigeration facility also. Keep that in mind. Which one? Products A as well as C, not B. Okay. Monthly fixed expense is given. Total is 1,89,000. In that, 1,09,000 is for refrigerated. Okay. This point also keep it in mind. Head office expenses is 1 lakh. I already told you. Head office expense, what you have to do with it. We have already seen the concept. You guys remember that? Here I've already discussed it, right? Now, let's move on to the next one. Total space of retail store is 40,000 cubic meters. Out of this, 25,000 cubic meters is for refrigerated goods, which means probably for A as well as C. Or in the question, it can be given like this also. It can be given as total volume of all goods sold per month is 40,000 cubic meters, which is 25,000 cubic meters for refrigerated goods. Like this also, he can give you information in the question. So which means he can say total space is so much, in that refrigerated goods space is so much, or you can say total volume of goods sold per month is 40,000 cubic meters. In that refrigerated goods volume is like this. Either data can be given like this in the question or data can be given like this. Okay, just keep that in mind. Anyways, so now how to calculate DPP? Let's try to understand with the help of this simple example. First, what we'll do, we'll take total cost per month, which is given in the question. 1,89,000, but 1,09,000 is for refrigerated goods, 80,000 is for general cost. General cost means this 80,000 will be incurred for all the three. Please try to understand. This is where I've seen many students getting confused. That is why I've taken this example. So listen carefully. 1,09,000 is refrigeration cost, which means it will be incurred only for A and C, because only A and C requires refrigeration facility. Whereas the other expenditure, if you remove this 1,09,000 from 1,89,000, the remaining 80,000 which you have got is general expense. Means what? It is incurred for A, B and C. Keep that in mind. That is incurred for A, B and C. And 1,09,000 is incurred only for A and C. Keep that in mind, right? Clear? So what I'm going to do right now is that I'm going to calculate refrigeration cost per cubic meter per month, general cost per cubic meter per month. So total cubic meters is already given. For refrigerated goods, it is how much? 25,000. Total is 40,000. This 80,000 general expense is incurred for the entire space, total space of 40,000 cubic meters. Therefore, the total general cost per cubic meter is 2 rupees, which will be incurred for all the three products. Whereas when it comes to refrigeration cost, 1,09,000 is incurred only for 25,000 cubic meters of refrigerated goods space, right? So therefore, divide both of them, you will be getting 4 rupee 36 paise per cubic meter per month. So this 4 rupee 36 paise should be given only for A and C. This 2 rupees should be given for A, B and C. So which means from this A cost will be how much? 4.36 plus 2, correct? What? Of course, presuming that they are there for 1 month. If it is 1.5 month, again it will change. 2 months, again it will change. Now, so A cost will be, suppose if A stays for 1 single month, 4.36 plus 2. B cost will be only 2. B cost will be only 2. Why? Because there is no refrigeration for B. C cost will be again 4.36 plus 2, presuming that C also stays for 1 month. Again, if it is 1.5 month, if it 2 months, again it will change. Now, let's have a look into that. Now, see here. Calculation of product cost per unit to calculate DPP. Cost per cubic meters per month. 4.36 plus 2 for A. For B it is 2. For C it is 4.36 plus 2. As I told you. Quantity per cubic meter, that is given in the question. In 1 cubic meter, 12,600 units, 4,032 units, 2,880 units. Put that over here. Cost per cubic meter, so much. In 1 cubic meter, these many units, which means per unit per cubic meter is how much? Which means per cubic meter, this is the cost. And in 1 cubic meter, this many units are there, which means per unit it is how much? Divide these two. Okay. So cost per unit per month will be 6.36 divided by 12,600. 2 divided by 4,032. 6.36 divided by 2,880. You will get this much as answer. 0.0005, 0.0005 and 0.002. And as I told you, now let's take how many months are they staying. Now A stays for 1 month, B stays for 2 months and C stays for 1 month. That is given in the question. So multiply with that, you'll be getting total cost per unit or total cost per quantity. So that's it. Once you got total cost per quantity, already you'll be having that gross margin. Reduce it from this, from gross margin, you just reduce this particular cost, you'll be able to get your DPP. Very simple. And you have to note here that head office expenses are not allocated to products because products are not influencing them, which we have already seen over here. Certain expenses which are not influenced by the products are not allocated to individual products. For example, head office expenses. Therefore, here head office expenses are not allocated to products. Is that clear? So it's very simple. I hope this is clear, right? So refrigeration expenses will be incurred for A and C. General expenses will be incurred for all the three. So therefore, if you can see 2 is common in all the three areas, 4.36 is there only for A and C. Pretty simple logic, right? And you just divide them with number of units per cubic meter, you will get cost per unit. And then you divide it with time. 1 month means you can just leave it like that if all the three products are staying for 1 month. But that's not the case over here. A stays for 1 month, B stays for 2 months and C stays for 1 month. Therefore, you just multiply, you will get your cost per unit, right? Chalo, let's move on to the next one. What is the next one you have got? Customer profitability analysis. Next concept. So coming on to this customer profitability analysis, okay. So let's have a look into that, how the concept looks like. Let's take an example to understand the concept, okay, so that it will be easy for you to appreciate. Let's say there are 3 customers, X, Y, as well as Z. Selling price, you are selling the same product to all the 3 customers, and the selling price is also same. Now, obviously, because you are selling the same product to all these customers, variable cost will also be same. So you feel that the gross profit that you get from these customers are exactly the same. So according to you, customer X or customer Y or customer Z are one and the same. Why? Because all the 3, they'll give you the same profit per unit, isn't it? So you might feel that all these 3 customers are one and the same for you, and you might give them equal amount of importance. But in reality, that's not the same. Why, sir? Let's try to understand. Customer X orders 1000 units from you. Customer Y orders 2000 units from you, and Z orders 500 units from you. Sir, what is there because of change in number of units? Ultimately 1000 into 30, 2000 into 30, and 500 into 30. Okay, we can say from units perspective, customer Y is important, then customer X is important, then Z is important. No, not like that. It's not that simple. So let's try to understand that. To understand that, you need to know certain other specifications as well. You need to know what is the order quantity. Every time customer X orders, how many units he orders per order, right? Customer Y, what is the order quantity? 50 units per order, 100 units per order, 200 units per order. Same, what is the order quantity of Z? So that you'll be knowing number of orders. Once you know number of orders, then you will calculate ordering cost. Are you able to understand? And that also you need to reduce from this gross margin which you are having over here. Then, how many returns are being made? Customer X has written how many units? Y has written how many units? Z has written how many units? This will also influence your ultimate profits, right? Transportation cost. All of them, are they incurring transportation cost or on their own, or as a company we are incurring for them? Are we delivering the goods to the customers destination or the place or whatever it is, or customer comes to our place and then takes the goods and go away, and gets away, whatever it is. So transportation cost, own, we own, means what? X incurs on his own, but for Y we are incurring the transportation cost. For Z, he incurs on his own, and you are giving some special discount. As you can see, 10% you are giving for customer X. For customer Y, you are giving nothing. For Z, you are giving 5%. Are you able to understand? So which means till here equation looked very simple. All of them are buying the same product, same selling price, same variable cost, so same profit per unit. But after that, once we have got these additional information, additional data, things have got completely changed. That is why customer profitability analysis is important. That is why, to know, similar to DPP, here we are trying to understand which customer gives you maximum profit, which customer gives you least profit, so that you'll be able to manage your entire customer profile in a better way, right? You got the point? Yeah. Now let's move on. Of course, you can apply Pareto analysis also here. So like this, you can just interconnect your concepts. Pareto analysis also you can apply. In fact, in Pareto analysis concept, one of the applications of Pareto analysis is customer profitability only, correct? Anyways, now let's go with an example. Let's say there is a hotel. Okay, you've got 2 types of customers in that particular hotel. One is a family, the other one is a business guest. Okay, family, what will happen generally? You'll have more of swimming pool facility, right? They will use more of swimming pool, and they will use bar facility relatively less. So families will be spending most of their time in the swimming pool and less time in the bar. Whereas when it comes to business guests, more time they'll be spending in bar and less time they'll be spending under what? In the swimming pool. So obviously, in this kind of situations, it's very important for you to calculate customer profitability analysis. I hope you are able to get the logic, get the picture right now. So by applying customer profitability analysis in the above situations, we can find which customer is more profitable and which customer is less profitable. Then strategies may be adopted to encourage more profitable customers. Are you able to understand? Very, very, very important. Got this? Now, there is something called fundamentals of customer relationship management. Are you able to understand? So from administration point of view, there are 3: operating CRM, analytical CRM, and collaborative CRM. Okay. So what is this? We'll see later. Right now, for this particular discussion, it is not relevant. So let's skip that. You can just try to look at it once on your own, right? So right now, let's continue with customer profitability analysis. So industries using CPA, hospitals, banks, insurance companies, professional firms, logistics companies, hotels, tour operators, all these guys. Okay. What are the benefits of CPA? It identifies which customer is contributing actually to the profitability and which customer is eating away your profits. Okay. Then company shall have a constructive dialogue. Okay. Which means you can negotiate with the customer to improve the margin. And this so-called DPP, which we have seen so far, direct product profitability and customer profitability analysis, can also help the companies in Pareto analysis. That's what I've already told you. Pareto analysis can be applied here as well. Anyways, this is what is important right now. Sir, what do you mean by this, sir? What do you mean by company having a constructive dialogue with the customer to improve margin? For example, let's come to this information over here. Let's say the order quantity of X is very less. Let's say 10 units per order, which means for 1000 units, he'll go with 100 orders, which means ordering cost will be very heavy. And that's eating away the profits that you get from customer X. Then you can have a constructive dialogue with customer X and you can ask him to, sir, please improve your order quantity, right? Which means let's say 30 units per order. As a result, your ordering cost gets reduced. That's what we call it as constructive dialogue. So you can negotiate with the customer, with those customers who are giving you relatively less net profits, not the gross profit, but the net profit. And then accordingly, you can improve your profitability levels, right? So that's one of the major application of customer profitability analysis, which is really good, isn't it? Right? So identify which customers are actually contributing to profitability and which customers are actually eroding your profitability. And then you can have a negotiation with them and you can improve your margin, as simple as that. Now here I have given you some applications. So this will be very useful for you to solve sums, problems. So I have divided them into 3 columns. What is a problem that you can have from a customer? What is the reason for that particular problem from the customer? And what will be the solution that you have to write, in that particular problem which you're trying to solve. Anyways, suppose you're giving high discount to a particular customer. Why are you giving high discount? You want to promote your sales, initial sales. What is the solution for this particular problem? Because you're giving high discount, if your profitability is getting eroded, you can negotiate with the customer for lower discount, taking care of not losing him at the same time. See, just because you are trying to improve your profitability doesn't mean that you have to lose your existing profitability as well. See, for example, let's say customer A gives you already a profit of 1000 rupees. In order to improve this from 1000 to 1200, you should not lose 1000 itself, isn't it? It makes sense. So when I try to negotiate or when I try to have a constructive dialogue with my customer, I should always try to improve my existing profitability, not at the cost of profitability itself. So that is why negotiate with the customer for lower discount, taking care of not losing him at the same time. I hope you guys are able to understand this. Next, coming on to the next problem, high ordering and delivering cost. Are able to understand, which means most probably why you will have high ordering cost? Because the customer is ordering more number of times. So ordering cost will vary per order. So more number of orders, more the ordering cost. Probably the reason is customer is using JIT. I hope you know the logic. If he is using JIT, he will order whenever he needs. So therefore, he will order more number of times, which means more will be the ordering cost and delivery cost. So in this kind of situation, what can be the solution? Increase your selling price. That's why generally under JIT, your selling price will be more when compared to your traditional ordering, correct? You would have seen this in JIT chapter as well. Fixed cost per delivery you can put. You order how many number of times you want, you order. But for each order, this much will be the cost. Or you need not charge anything per delivery, but have a threshold limit for number of orders. For example, 10 orders will be free. This is the threshold limit. Threshold limit. Beyond that, I'll charge you. Beyond that, per order, I'll charge you 100. Per order, I'll charge you 1000. Per order, I'll charge you 15,000. Whatever it is. Whatever the number it can be. So these 3 can be the probable solution for this particular problem. What is that problem? High ordering cost and delivery cost. Next. High site visit cost. So people from your company are visiting the customer site very frequently. As a result, you're incurring high site visit cost. So the probable reason for this can be the customer requires customized products. Therefore, he is asking you to visit his site. What you can do to solve this particular problem so that you can improve the profitability? You can charge fixed amount per visit from the customer. or improve your business process in such a way that customer himself will stop asking you to visit his premises. Are you able to understand? That can also be the solution. Next, high rush orders can be another problem. Customer requires immediate delivery. Rush order means immediate delivery, right? So what you can do, simply charge per rush order. Or even for this also, you can keep some threshold limit. 1 or 2 rush orders will be free. Beyond that, we'll charge you. Something like that. That can help you to improvise your profitability. High sales returns can be a problem. Probably it's because of communication gap between seller and the buyer. Seller asks something, buyer understands something, and then sends something, and then eventually the buyer says that, sorry, here seller and buyer, in the sense buyer is the customer, right? So he tells you something, we understand something, and we send something, and then he says that this is not the one that we have wanted, and he will return it back, and that will incur a lot of cost for us, right? So you take corrective action by finding out the reason, where the communication gap is happening, why it is happening, what is that customer is trying to communicate, what is that we have misunderstood, or did the customer communicate in the right way, did he communicate something wrong, and therefore then the problem will be on the customer side. So like that, you just need to analyze what is the reason and take the corrective action. Pretty simple. Another important point that you have to note here is high rush orders and high site visits, they require more employees. So therefore, company may decide to discontinue such service and reassign these employees to other value-added activities as well. So this is universal point. This also you can do. So any kind of situation where you have to use more number of employees, you can try to reduce those services by, with the help of that, you not only reduce your cost, and you can use those employees in some other area where there is value addition. Value addition means up from that you'll be getting some sort of profit, you know. Anyways, so this is one point that you have to keep in your mind. Okay. When you have high rush orders and high site visits, that requires more employees, right? And what the company can do is that it may decide to discontinue such service, and once it discontinues, all these employees will be what? Free, right? And you can use these employees in some other areas. Are you able to understand where the real value addition happens? So I've written it as UP. UP means this is a universal point. Reassigning these employees to other value-added activities, you can use this in so many other areas as well when you're trying to especially answer a case study. Are you able to understand? For example, business process reengineering. There also you can use this particular point. Because of BPR, you can discontinue the services of a lot of employees, but you can use them, you can reassign them to some other area. So if you feel that there is a problem of employee retrenchment compensation, if you feel that there will be a lot of, say for example, strikes from employees when you ask them to get out, of employment. In these kind of situations, this can be a solution, right? So like that, there are so many areas where you try to reduce the number of employees. In that kind of situation, you can write this particular point as a part and parcel of your answer when you're answering a case study or a case scenario. That's why I've written this as a universal point. Universal point means you can use this in many areas. So like this, I do in each and every chapter and in so many topics, so that these are all the kind of tricks that you have to learn so that it will be easy for you to answer what? Case studies and case scenarios. I hope this is clear. Right? Yeah. Right, fellas. We'll wind up the session over here. Okay. In the next session, we'll finish off the rest of this particular chapter. That is activity-based cost management and so on. Okay. So let's wind up the session over here. In the next session, we'll finish off the remaining. Thank you. Right, friends. So welcome to PKSR classes. Let's continue with where we have left in the last session. I think we have done our revision till here, right? So let's continue with that. Now, in this session, we'll finish off the concepts of the rest of the chapter of SAOI, Strategic Analysis of Operating Income. So now we're gonna go for ABM. So ABM means Activity-Based Cost Management. Okay. So what do you mean by this activity-based cost management? See, you already know the concept of activity-based costing because we are done with decision-making division. So the activity-based costing concept was so successful. It was so successful that after that, it got varied applications, and from that, they have developed so many more concepts. So one of such concept is ABM. So ABM means it is activity-based cost management means you're gonna use the concept of activity-based costing, develop it a bit further, and with the help of it, you're gonna manage the cost. So what do you mean by manage the cost? Trying to reduce the overhead cost, or able to understand, trying to limit the overhead cost, trying to have more control over the overhead cost with the help of activities. See, the logic is very simple. Say for example, you have something called setup activity, and you have a cost called setup cost. Now, if you have to manage setup cost, what you have to do, simply you need to manage the setup activity, right? The number of setups. If the number of setups can be reduced, automatically the setup cost can be reduced, isn't it? So trying to reduce your setup cost by reducing the number of setups, by managing those activities, is nothing but activity based cost management. To put it very simple, in a very layman terms, this is the actual meaning of this particular concept. Are you able to understand? This is just a, what can I say, a rough idea, of what this concept is all about. Now, let's dig further and then we'll try to understand this particular concept. Now, see here. Activity based cost management means cost management at activity level, which means you're going to manage the activities, their cost drivers, and through that, you're going to manage your cost. So ABC supplies the information. That's what I've told you. This is the improvement of activity based costing. So all the info that you need to do activity based cost management comes from activity based costing. So ABC supplies the info and ABM uses the information for various ways of cost control and cost reduction. Got it? Right, pretty simple. Now, activity based cost management focuses on cost management at activity level in two ways. What are they? One is strategic activity based cost management. The other one is operational activity based cost management. Now, what do you mean by strategic ABM? Strategic ABM means focuses on the effectiveness, means doing the right things. That's nothing but strategic ABM. Operational ABM means it focuses on efficiency, which means doing things right. Whatever you do, doing it right is all about efficiency. Doing right things is all about effectiveness. Means what, sir? For example, which product to be produced? Okay, you need to produce the right product. Which activities to be used for producing the product? That comes under effectiveness, which comes under strategic ABM. Now, what do you mean by efficiency then, which comes under operational ABM? Better resource utilization to reduce cost and improve profit. Every resource that you utilize, whether it is raw material or it is machineries or it is laborers or employee management, whatever it is, you have to use it in the best way possible. That comes under efficiency. That is doing things right. That comes under operational ABM. So you got to remember this. The activity based cost management, that is ABM, focuses on cost management at activity level in two ways. One is strategic, the other one is operational. Under strategic, you have this. Under operational, you have this. We have seen strategic means effectiveness, operational means efficiency. That is doing right things over here and doing the things right over here. Pretty simple. So, we're done with this. Let's move on. Now, let's try to understand the concept activity based cost management. First of all, we'll start with the definition. Activity based cost management is a discipline that focuses on the efficient and effective management of activities as a route to continuously improve the value received by customers. This is the keyword. Now the question is, how do we improve the value received by the customers? Very simple. By reducing the cost, by adding features without reducing the cost. Which means you will add features at the same cost, thereby you improve the value to the customer, or you will keep the same features but you will reduce the cost. That way also you can improve the value to the customers. Pretty simple. Right. So this is the definition, and a definition in the exam you have to write as it is. You cannot change that. So what is ABM? It is a discipline that focuses on the efficient and effective management of activities. That activities information is supplied by ABC. That is what we have seen here. ABC supplies the information and ABM uses the information. So this activities information comes from ABC, and then ABM focuses on such information, that is activities, in an efficient and an effective way. That we have seen already over here. Effective way in the sense it is nothing but strategic ABM. Efficient means it is nothing but operational ABM. That we have seen. Okay. As a root, what is the purpose of this efficient and effective management of activities? Ultimately, what are you going to achieve by managing these activities in efficiently and effective way? Very simple. You're going to improve the value that you're going to provide to the customers. That is what we have written in the definition over here. As a root to continuously improve the value received by the customers. Pretty simple. Now, how do we implement this ABM? Pretty simple. There are three steps. Step 1, step 2 and step 3. First step, cost driver analysis. Second step, activity analysis. Third step, performance analysis. Now let's try to understand each and every step. Through this, we're going to design and implement ABM. Now step 1, cost driver analysis. What are we going to do in this particular step? A cost driver is any factor that causes a change in the cost of an activity. We are already aware of the cost driver. So many times we have seen. Okay. For setup activity, number of setups. For material requisition activity, number of requisitions. For machining activity, machine hours. Okay. For inspection activity, number of inspections is the cost driver. So we have seen all those things. Let's take an example over here. Invoice processing activity. For that, number of invoice processed will be a cost driver. Setup activity, number of setups will be a cost driver. Done. So that's your first step, cost driver analysis. Very simple. Just find out the cost driver and then keep that information with you. Right. Coming on to second step. What is that? Activity analysis. Your goal is to reduce the cost and enhance the value. That is there in the definition as well. Okay, you want to improve the value received by the customers. How do you do that? By reducing the cost or increasing the features. Now, how are we going to reduce the cost and enhance the value that we're going to provide to the customers? Very simple. All the activities, here we are doing activity analysis only, right? All the activities will be divided into two, value added, non-value added, and non-value added activities will be eliminated. Very simple as that, right? Now coming on to third step. I hope you know what is value added and non-value added, right? Just remember, any activity for which customer is willing to pay or any activity that adds functionality to the final product is a value added. Anything other than that is non-value added activity. Very simple. Right. Moving on to third step. Performance analysis. Out of hundreds of activities inside an organization, you'll have so many activities, right? Setup activity, inspection activity, material requisition activity, machining activity, or you're able to understand so many activities will be there, right? Out of that, some significant activities must be identified for performance analysis. Are able to understand? You identify, it depends upon the company. We cannot really say what is significant. It depends upon the way a business is being done by a particular company. It is customized, okay? Which is significant activity for that particular company is totally, depends upon the business circumstances of that particular company. Whatever the business that company is doing and whatever the kind of, business environment that the company is in, okay? Anyway, but what you have to do as part and parcel of third step, that is performance analysis, is you got to compare your actual activity rates versus benchmark rates. What do you mean by actual activity rates? For example, you got cost per setup. This is an actual activity rate for you. Let's say it is 1000. You compare that with the benchmark in the industry, which means what your peers are doing, what your competitors are doing. Their cost per setup who are manufacturing similar product like you is, say for example, 1500. In that case, you are a lot better. So in that case, you will make these activities, which means you will do it in-house. Suppose if your activity rate is very bad when compared to the benchmark rate, then you'll better buy it from outside because it comes cheaper rather than you yourself doing it. So this is advanced way of cost management. That is why it is called as ABM. Okay. Anyways, let's try to take an example to understand how ABM helps us to manage the cost. So how ABM helps to manage cost. For that, we'll take an example, that is, we're gonna take invoice order processing activity. Okay. So cost driver will be what? Number of invoice processed. Very simple. So if you further analyze this activity, it has revealed that the slow processing of order is going on, which means the invoice are being processed very slow. Okay. So for that, we need to find solution as per ABM, which means we need to increase the pace of invoice processing activity. Are you able to understand? So what is the solution they have found? They have found that we can give a training program to the employees to improve the speed of processing the invoice. Thereby, this slow processing of the invoice order will be solved. That problem will be solved. Also, you can introduce some computer systems in case if they are working manually to speed up the process. Either way, what will happen? Your so-called problem of slow processing of the invoices will be solved and fast processing of invoice will happen eventually, right? But because of these two solutions, what will happen? Your employees' necessity will get reduced, especially in the second solution. When you try to introduce the computer systems to speed up the process, definitely whatever the number of employees that you have got right now will not be required anymore, right? Let's say, for example, if you've got some 20 employees right now who is processing the invoice, right? After introducing the computer systems to speed up the process, maybe you need only 5. Then what will you do with the remaining 15? Either you have to ask them to get out, right? Or you can reassign these excess employees to other value-added activities. I told you this sentence will be repeated so many times. It is getting repeated again. See, here also we have done the same thing. Can you see that over here? Company may decide to discontinue such service and reassign these employees to other value-added activities. Same sentence, we are seeing it here again. That's why this particular sentence is very important. In so many situations, you'll try to reduce your number of employees to reduce the cost. In that case, either you can ask them to go out, we call it as you can pay them retrenchment compensation and you ask them to go out, or what you can do is that you can reassign these employees to other value added activities. Either way. Right? Done. Okay, chalo. Moving on to another example. Now see here. Let's say your total production is 10,000 units and your units per production run is 1,000. Okay, which means one time if you start the machine, it will start working and then it will manufacture 1,000 units and then it will stop. That is one production run. So it will manufacture 1,000 units per run. Total production is 10,000, which means how many runs you need? 10 runs. Okay, 10 runs means machine will start, run for 1,000 units and then it will stop. Now I have to again make the machine ready for another production run. Making the machine ready for another production run is nothing but setup. So if you have 10 runs, then 10 times you need to make the machine ready for another production run, which means you will have a number of setups. How many setups? 10 setups only. So how many production runs will be there? That many setups will be there, right? And cost per setup is 5,000. So current total setup cost will be how much? 10 setups into 5,000 per setup. Total cost will be 50,000. Which one? Setup cost right now. So if you apply activity based cost management here to manage the above cost, what you will do? Increase the number of units per production run. This is nothing but we call it as long production run. Long production run means earlier in each production run you were manufacturing 1,000 units. Now in the same production run you are manufacturing 2,000 units. Therefore what will happen? The time taken to manufacture 2,000 units instead of 1,000 units will be more. Therefore it will take lot of time, long time. That's why it is referred as long production run. Okay, you will see this word in LSI chapter as well, Lean System and Innovation. So now what has happened? You have increased the number of units per production run. Therefore, the revised production runs will get reduced. Earlier it was 10,000 units is the production and 1,000 units is the units per production run. Therefore, you need 10 production runs, but now it's only 5, right? Why? Because you have increased the number of units per production run, which is 2,000 right now. Earlier it used to be 1,000. So therefore 2,000 means total production remains the same, which is 10,000, right? But now how many production runs you will run? 5, which means number of setups also will be 5. Cost per setup will be 5,000, which means now the total setup cost has got reduced to 25,000 from 50,000. This is how ABM will help you to manage the cost. Here we are managing activities only now. So what setup activity? We have reduced the cost driver eventually, right? From 10, we have reduced the cost driver to 5. Therefore, the cost also has got reduced. Like this, managing this cost drivers of the activities, thereby reducing the cost or managing the cost. That is cost control or cost reduction is nothing but activity-based cost management. That is what we have seen in the definition as well. Okay. So this is another example. I hope you can understand better. Right. Let's move on to the next one. Now we're going to look into the concept of value added and non-value added activities. Now moving on to the next concept now, value added as well as non-value added activities. Okay. So what do you mean by value added activities? These are the activities that add value to the customer or which is indispensable to complete the process, or any activity which provides essential support to the value added activity. So an activity which adds value to the customer is value added activity. An activity which supports an activity which adds a value to the customer is also a value added activity. That is the importance of this particular sentence. Okay. Any activity which provides essential support to the value added activity is also value added activity. Got the point, right? And here there is another sentence which is indispensable to complete the process. So which means without that particular activity, you cannot complete the process of either manufacturing a particular product or providing a service. Then that will also be referred as value added activity. So to remember this in a very simple way, you guys just remember one thing. Any activity for which customer is willing to pay, that is very important. You see whether customer is willing to pay or not. When something adds value to the customer, then obviously customer will be willing to pay. That is the logic. So if customer is willing to pay, then that is value added. Or in other words, if that particular activity adds some sort of functionality to the final product. For example, if you are manufacturing car, okay, now in the car, as per government regulation, you need to have compulsory ABS right now, anti-brake lock system. Okay. Now, even though customer feels that I don't want this ABS system, or able to understand where you'll have sensors on all the wheels, thereby the braking will be better. Even though customer is not willing to pay for it, but because of the government norm, you have to put it as a manufacturer, and that adds functionality to the final product, which is a car, because it betters the braking system, right? So therefore, that is a value added activity. That's the way it works. So there are two rules. One is whether customer is willing to pay or whether it adds functionality to that particular product or not, right? Now, coming on to non-value added activity, very simple. Work or activity that is not valued by the internal or the external customer. When I say internal customer, it means it does not add any functionality to the final product. External customer means obviously the customer is not willing to pay or it is not adding any value to the external customer. For example, unnecessary movement of goods is a NVA, non-value added activity. Unnecessary movement of equipment, unnecessary movement of people, any type of waste, all these are NVAs. Okay, right. Sir, what is the logic behind this particular concept? Why you have to classify something as VA as well as NVA, right? The idea behind the above concept is that not only the final product, okay, the car which you utilize or any other product for that matter, not only the final product or utility of the product, but the entire production process also should be customer focused. Normally what we do is that the final product that we eventually manufacture, that should be useful to the customer. That will be the intention. But the concept of value added or non-value added activities is that not only the final product should be useful to the customer, but also every single step through which we eventually manufacture that final product should also be useful to the customer. Because of this, eventually what happens is that all the inefficiency will be eliminated and thereby the product will be available to the customer in the best possible manner, in the best cost possible, with the help of best features. Are you able to understand? All the inefficiency will be what? Eliminated. That's the whole logic. So this is possible only by segregating each activity as value added and non-value added from the customer's point of view. Why customer's point of view? Because customer is the one who is going to buy your product. So you see the customer's point of view, which means whether customer will be willing to pay for this particular feature, for this particular thing, whatever the activity that you are putting to manufacture that particular product. If customer is willing to pay, then it automatically is value added. Of course, there are few exceptions. One exception I told you here as well, that ABS. Are you able to understand? Like that, see, there will be certain exemptions where it's a rule that has been kept by the government, and for that, even if customer is not willing to pay, but still it is a value added activity for you because of government norms. Anyways, let's move on to the next one. One of the approaches to identify non-value added activity is to classify the activities based on the way in which time is spent. Sir, what do you mean by that, sir? Mostly time is spent in the following ways. Let's have a look into that. Process time, the time during which a product is undergoing conversion activity. Conversion means from raw material to finished goods, the product is getting converted. That whole conversion activity, whatever the time that you take in order to convert your raw material into finished good, we call it as process time, and that's absolutely value added. Otherwise, without this particular process, process time or conversion activity, your finished goods will not be ready, isn't it? Obviously. So if you want your finished goods to be ready, obviously this is a compulsory step. So therefore, it is value added for sure, right? Waiting time, the amount of time that raw material or WAP spend waiting for the next operation, that is a non-value added activity. Storage time, the time during which raw material, WAP and finished goods are held in the stock before further processing or shipment, and that is also a non-value added time. Inspection time, the amount of time spent confirming that the product is of high quality or not. You try to inspect each and every unit that got manufactured. That is also non-value added activity, right? Because whether you do inspection or you do not do inspection, the way you are manufacturing a particular product is not going to change. Inspection is only going to identify whether there are any defects in quality or not. It is not going to eliminate the quality. It is not going to avoid the quality issues, isn't it? So if you think logically, inspection is just going to identify your quality issues. It is not going to eliminate your quality issues. It is not going to eliminate your defects. Are you able to understand? Therefore, it's a non-value activity. That is a logic basically, right? Next, move time. The time spent by moving raw material, WAP finished goods between operations, one machine to another machine, one process to another process. Are you able to understand? That is also non-value added activity. Next, manufacturing cycle time. Total time required to produce one unit, that is value added plus non-value added, which is nothing but first one is value added, which is process time, plus 2, 3, 4, 5 is non-value added. Everything put together, we call it as manufacturing cycle time. Generally, we call it as MCE. Okay, that is manufacturing cycle efficiency. This is called as manufacturing cycle time. Now see here. So manufacturing cycle time is nothing but process time plus waiting time plus storage time plus inspection time plus move time. In other words, VA plus NVA. VA is process, remaining all is NVA, right? Now from this, we can calculate something called manufacturing cycle efficiency. It is also called as process cycle efficiency, which is value added time divided by total time, which is nothing but value added plus non-value added. What is the value added time here? Process time divided by total time means process time plus waiting time, storage time, inspection time, move time. 1 divided by 1 plus 2 plus 3 plus 4 plus 5. There ends the matter. And what is the logic here? Companies should always try to increase the manufacturing cycle efficiency, which means obviously your proportion of value added time out of the total time should be more. The more this proportion is, the better it is for the companies, which means your value added activity proportion is high, right? Therefore, always companies should try to increase their manufacturing cycle efficiency. It's common sense, right? Chalo. Example, whether to move to JAT or not. Because if you move to JAT, what will happen? Your storage time will get reduced because most of the times you will not have raw material stock, WAP stock, finished good stock when it comes to JAT. There is no waiting time. Why? Because in JAT you will start manufacturing your finished good only after getting the order from the customer. Therefore, your finished goods will not wait. Once it gets manufactured, straight away it will be sent to the customer. Are you able to understand? So therefore, if you move to JAT, what will happen? Your value added time gets increased, or in other words, your non-value added time gets reduced. Therefore, your manufacturing cycle efficiency may improve if you move on to JAT from traditional manufacturing. Are you able to connect the dots, right? If it increases MCE, then the company should go for JAT implementation. That's what I've told you. Knowing some important terms, this will help you in solving problems, okay? Velocity time, number of units produced in a given time. Say for example, 5 minutes is given. Within 5 minutes, how many units are you manufacturing? That talks about the velocity. Okay, next. Delivery cycle time or customer response time. It is the average time between the receipt of the customer order and delivery of goods. That is nothing but delivery cycle time. So you will get an order from the customer. From there it starts, and till the time you deliver the goods to the customer, the gap between that, receiving the order and then delivering the goods, we call it as what? Delivery cycle time or customer response time. Okay. So here there is a simple diagram for you to understand all the concepts. Now see here. We have written 5 things over here. Let's try to see one by one. Customer places order for the product. This is the first one that will happen. Customer places order for the product. Order received by the manufacturer. Okay. Machine setup begins for the order, which means you are manufacturing. Order is done, finished goods is ready. Then order delivered to the customer. So stepwise, 1, 2, 3, 4, 5. Very easy to understand, right? Now, the difference between order received by the manufacturer and the manufacturing setup time is nothing but waiting time. So which means the company has received the order, but still the manufacturing did not start. That is waiting time, the time difference between those two. Once the manufacturing setup starts, till the finished goods is ready, this is nothing but manufacturing time, where the actual manufacturing is happening. Fine. Once you receive the order as a company from the customer, till your finished good is ready, this whole thing we call it as manufacturing cycle time. Right? This is what we have seen here. Manufacturing cycle time. VA plus NVA. Process time plus waiting time plus storage time plus inspection time plus move time. This one. Manufacturing cycle time. VA plus NVA. Okay, try to connect the dots. The time between the customer placing the order and company receiving the order is nothing but receipt time. And the time between once the finished good is ready within the company till the time it is actually delivered to the customer, we call it as delivery time. And the time from the moment customer places the order and ultimately when the customer receives the order, this is nothing but customer response time. That is what I have written over here. Delivery cycle time or customer response time is nothing but average time between the receipt of customer order and delivery of goods. So this is where the customer places the order and this is where the order is actually delivered to the customer. So the difference between these two is nothing but customer response time, or you can also call it as delivery cycle time. So this diagram will give you complete picture of all the concepts with respect to this particular manufacturing cycle efficiency. Are you able to get me? Right. Next, what do you mean by receipt time? Here we have already seen the receipt time is nothing but customer placing the order for the product and order received by the manufacturer. The difference between these two. So time taken by the marketing department to specify to the manufacturing department the exact requirement in the customer order is nothing but recipient time, right? Or sorry, receipt time. So once the customer places the order, what actually the customer has asked you to manufacture will be communicated to the manufacturer by the marketing team. So that time gap is nothing but we call it as receipt time. Okay. So receipt time is done. What else? So I gave you some notes for clarification on solving problems. Very important. What are they? Now see here. Sometimes same activity can be value added as well as non-value added. For example, storage is generally non-value added, but if you are storing for liquor, then it is value added. You know the reason, right? Inspection is non-value added, but if it is inspection for ISO certification, then it will be value added. Keep this in mind, okay? Don't get confused. Always storage is not non-value added, okay? It depends upon the situation. Therefore, sometimes same activity can be VA as well as NVA. Normal storage is NVA, but storage of liquor is VA. Keep that in mind. Normal inspection is NVA, but inspection for ISO certification is a VA. Keep that in mind. Very important. In exams, if in a question he gave you waiting time, then there are two possibilities of what that waiting time means. Waiting time between order received by the manufacturing department and the actual production starts. Order received by the manufacturing department and the actual production starts. This is nothing but waiting time, which we already know. Or waiting time from placing the order by the customer to receipt of order by the manufacturing department. This can also be referred as waiting time. From placing the order by the customer to receipt of order by the manufacturing department, this can also be called as waiting time. So it depends upon the question. You have to be careful, okay? And of course, this waiting time in that, if it will be value added, if it is customized product which you are providing to the customer according to the customer requirements, whereas the same waiting time from the moment the customer has placed the order till the manufacturing department receives the order will be a non-value added time, provided if what you are manufacturing is a standard product, which means you are manufacturing the same product for thousands of customers. But if you are manufacturing customized product for that particular customer, then even this waiting time will be value added time. Very important, keep that in mind. And finally, benefits of activity based cost management. It provides causes of the business process cost, why a particular cost you are incurring. It will explain you the reason. It will provide basis for effective decision making, obviously, by analyzing the activities, by managing the cost, by controlling the cost, by reducing the cost. It provides basis for cost reduction, obviously. It helps to implement ABB. ABB means activity based budgeting. So first you have activity based costing. From that you have developed activity based cost management. From that you have got one more utility, that is activity based budgeting. I hope that's clear. Right, buddies? Chalo. Now next one, business applications of activity based management. This is important for questions and case scenarios. So what are the business applications of activity based cost management? It is useful in ABB, obviously, activity based budgeting. It is useful in benchmarking as well. Okay, you will benchmark your activity rate with the other company's activity rates. It is helpful in cost reduction. We know that. It is helpful in performance measurement as well. It is helpful in BPR as well, business process re-engineering. Okay, just keep this in mind. It will be helpful for you in case scenarios and some questions. Chalo, let's move on. Now we'll be moving on to something called activity based budgeting. What is that? Budgetary system at activity level. Activity based cost management means, what did we say? Cost management at activity level. So ABB means what? Budgeting at activity level means what? Let's look into the definition. It is the process of financial planning and budgeting, and it is a reverse of ABC process. Means first we will make the budget of products to be produced, then decide activities required to be performed, then decide resources required to perform the activities. If you have understood this, it's okay. Otherwise, I'll explain. Don't worry. It increases accuracy of financial forecasts through three elements of activity based budgeting. What are they? Type of work to be done, quantity of work to be done, cost of work to be done. So understanding the above concept with the help of an example. Now see here. Normally what happens is that first always when it comes to budgeting, every company in all situations, you will always start with sales budget. Once sales budget is done, you will add closing stock of finished goods, you reduce opening stock of finished goods, you get production budget. Once you get production budget, you will see each unit of your finished good consumes how many kgs of raw metal, single raw metal or multiple raw metal, whatever it is. You multiply with raw metal consumption per unit, you get raw metal consumption budget. Once you get raw metal consumption budget, you add closing stock of raw metal, you reduce opening stock of raw metal, you get raw metal purchase budget in quantity. You multiply with purchase price per unit, you get raw metal purchase cost budget. You add direct labor budget to that, you add overhead cost budget to that, you will get total cost budget. This is the way you prepare your budget normally. But when it comes to ABB, you're going to do reverse. What is that? See here. First, make budget of products to be produced, then decide activities required to be performed, and then decide resources required to perform the activities. What is that? See here. You'll start with sales budget as usual, but you will stop here. That's why I've written here, stop here. Right? Production budget. Once you know, for example, let's say there are 40,000 units you need to produce. Here I have written, okay, 40,000 units you need to produce. So production budget is ready. You started with sales budget, you have added closing stock of finished goods, you have reduced opening stock of finished goods, your production budget is ready. Now let's say that so-called production budget is 40,000 units, okay. Production run is 1000 units, which means in one run you can manufacture 1000 units, which means you need 40 runs. So 40 runs means you need number of setups, 40 setups. Cost per setup is 5,000 per setup. So therefore, from this you will calculate setup cost budget. Are you able to understand? Like that, this is only one example. Like setup cost, you'll have so many other things: inspection, material requisition, machining, so many other things are there. Like that, all the overhead cost budget will be calculated. Then you will add direct cost budget, which is nothing but direct material, direct labor, direct expense. Then you will get total cost budget as per ABB. Are you able to understand? See, one example I've given. Like that, I've gave you setup example over here. It can be machining, it can be inspection, it can be material requisition. Are you able to understand? It can be anything. So this is the way you will fix your budget as per ABB. I gave you one example. Same logic will be applied for all other overhead cost as well, right? Sure. So what else you have got? ABC and advanced manufacturing environment. This we have already discussed. Okay, you can just read it yourself. Nothing special over here. You can just pause the video and then you can read this. Okay, just slow it down. Right? You just pause the video and then you can read it. Nothing important over here. Or if you have got the hard copy of the power notes, you can just read it directly from that. Right? Chalo. Now let's come on to the last topic of this particular chapter, Kaizen budgeting. Already, I hope you guys know the idea of Kaizen costing. Kaizen costing means you will try to reduce your cost bit by bit. A very small portion, like for example, a very small percentage, like 0.0001% over a long period of time, so that in reality, after a long period of time, suddenly you will see that you have saved a very good amount of cost. That's what we call it as Kaizen costing. Anyways, now what is Kaizen budgeting? It indicates management's commitment to small, continuous and organized cost reduction. That's what Kaizen costing is also. But here in budgeting, you will implement that particular logic. Say for example, cost per delivery is 1000. January month, you have prepared the budget. Now for February month, how will you prepare the budget? 99.6% of January month's cost. Of January month's cost. Then the cost per delivery budget for Feb will be 996. Are you able to understand? This is not actual cost. You see here, I've put the arrow mark, budgeted activity cost. So February month, you have reduced it by 0.4%. Again, next month, you reduce it by 0.4%. Again, next month, you reduce it by 0.4%. All these are budgeted costs, not the actual cost. So that's why it is called as Kaizen budgeting, because same Kaizen costing concept you are implementing in budgeting. This motivates the managers to seek out cost reduction. That's why it is called as Kaizen budgeting. Very simple. There is a problem also on this. Very simple. This logic, if you follow, the problem also will be done. You got the point? And finally, ABC as a decision making tool. That is activity based costing. It helps you to measure your cost, to find out accurate cost per unit. We know this already, because it helps you to eventually find accurate overhead cost per unit, precise overhead cost per unit. Automatically total cost per unit also will be accurate. So if you are a price setter, your selling price will be accurate. We have seen this already. ABC also helps you in product line profitability, which means which product really gives you exactly true profit. You will be able to identify only because of ABC. That also we have discussed. In decision making chapter revision itself, we have seen this indirectly. I don't know whether you remember this or not. It also helps you in expanding decisions where you want to expand your factory, you want to expand a new distribution center, you want to take that make or buy decision, or you want to take a decision whether to expand or not. ABC will help you. So this is a general dry theory sentence. That's it. So ABC as a decision making tool. Okay, that's it. So we're done with this particular chapter. Okay. I hope you guys have enjoyed this particular revision. This is a rapid revision, Nana. So 1.5 hour only we'll spend on each chapter. That way only we'll be able to complete as many chapters as possible. I hope you guys are getting good amount of utility from these revision lectures. Thank you so much, guys. That's it from my side. The speakers are classes. Let's wind up the session. Bye bye.
Chalo guys, ready? All of you. So now what we're gonna do is that we're gonna revise lean system and innovation, and after that we'll go for problems. Are you able to get me? Yes, all of you. If you're ready, we'll start. I'm doing this for you only. Okay. Right. So you have participate, and then we're gonna revise it together. Got it? It's gonna take some time because we have a lot of concepts to cover, right? We'll go slowly, we'll revise everything, and then we'll move on. I hope you guys remember whatever you have studied. Okay. If you revise, you'll remember. Okay. Chalo. So first of all, before we get to the chapter, important chapter or unimportant chapter? Important, right? Why? Because 10 marks on an average every attempt you'll get from this chapter. Okay. After that, we have seen the bird's eye view. Now, can you please tell me what is the bird's eye view of this chapter? JIT. JIT, Kaizen costing, 5S, TPM, total productive maintenance, cellular manufacturing, Six Sigma, BPR, business process reengineering. So it's always good to remember what are all the topics we have in a particular chapter. Okay. After that, first we started with introduction to lean system. Okay. First, don't look into the notes. Just let's discuss. Lean system means what? It's all about waste minimization without sacrificing two things: productivity, quality, right? And so first of all, we need to understand what is a waste. We need to understand that. What is a waste? Any step or an action or process which is not at all required to complete the production of a particular product. Are you able to understand? Successfully. Yes, complete the production of a particular product successfully. We call it as what? Waste. After that, we have seen that there are so from that definition we have understood that the definition of waste is a little bit broader. Okay, so as you can see, it is any step or process or action that is not required to complete a product successfully. After that, we have seen 7 different types of waste. We categorize them into 2. One is 4 into one category, 3 into another category. Correct? 4 is during the production process and 3 is after the production process. So during the production process, what are the ways that we're gonna face? First one is over processing. Are you able to get me? Which means processing more than what is required. In other words, we can call it as non-value added activity, and you want to eliminate them, right? Generally, everybody wants to eliminate them. Okay. Next, motion. When I say motion, see, both of these are motions only. Motion waste. But this motion belongs to equipment and people. This motion belongs to product. Ultimately, whether it is equipment or it is people or it is product, when you are moving unnecessarily than what is required for the completion of successful product is a waste. So here under this motion, equipment and people have come. Under this transportation means unnecessary transportation of that product has come. So ultimately anything can move. Anything that moves unnecessarily is a waste. You got the point? Next, finally, waiting. So whenever there is difference in speeds of different machines, eventually what happens? One particular process can be faster, the other particular process can be slower. So therefore you will always find WAP stock before the slowest machine, which will be waiting, and that waiting is also what, Nana? Waste. WAP products waiting for next production step is a waste. So all these 4 happens during the production process, and there are 3 which happens after the production process. What are they? Overproduction. Overproduction means what? Producing more than what is required. Are you able to understand? Next, inventory. Having more inventory than what is required. So having a stock is not a problem, but having more stock than what is required is the problem. Are you able to understand? Here also, overproduction means it doesn't mean that probably maybe it exactly should tally with the sales. That's not the concept over here. According to the calculations that a particular company makes, how much should be the production? Beyond that, if you are producing, everybody has planned that we should produce 400 units. You produce 430. Then that 30 is overproduction. That is the logic. Got it? Finally, defects. Not getting things right the first time. Therefore, you have to rework on it. And that itself is a waste. Are you able to get me? Bol re, right. Now one more time tell me, what are the 7 different types of waste we have got? 4 during the production process, 3 after the production process. What are the 4 during the production process? Overprocessing, motion, transportation, waiting. Correct? And after that we have got 3 after the production process. What are they? Overproduction, inventory, defects. Got the point? Very easy. Chalo. After that, we have seen characteristics of lean manufacturing. That is this whole chapter in itself, right? First, it is pull processing. Are you able to understand? I already told you what is pull processing, right? We have seen a diagram as well. There are 2 ways of producing goods or product. One is push, the other one is pull. So in push model, what happens? You start with the vendor. First of all, you will do your research and then you will try to figure out that you have ultimately came out with a particular product which you think that society will need. Are you able to understand? And after that, you will start, having forecast, that, okay, this much of advertisement, if I do, then these many units I can sell. If these many units I can sell, then this is what I have to manufacture, which means this is what the raw materials I have to buy from the vendor. And then you will start buying from the vendor based on your forecasting, right? Your forecast. And then the raw material comes, process 1 will work on that raw material, convert that into WIP. From there, it will send to what? It will be sent to process 2. Then it will work on it. It will be converted into another WIP. And then finally, it will be sent to process 3. Then eventually, you'll get the finished good. Once you get the finished good, this finished good will be pushed into the market by some advertising or marketing by the company. That we call it as what, Nana? Push model. Because this guy pushes to this guy pushes to this guy pushes to the market, the finished good. That's why it is called push model. Got it? So pull model means basically you don't do anything right at the beginning. Instead, the customer comes and places the order. Say for example, in a showroom. From there, immediately once the order is placed, the last process or the division will assemble the small WIP stock that it has got, and immediately it will be delivered to the customer. And after that, what it will do, immediately it will remove the Kanban card over here. Once upon a time, this is what used to happen before the computerization, right? And that is a signal for this particular department, which is process 2 or machine 2, to assemble its output, which becomes the input for process 3 to immediately deliver. And then immediately it will remove this card, and that becomes a signal for P1, and P1 will immediately assemble its output and it will be delivered to P2. And then P1 will quote the order from what? Raw material, or P1 will order the raw material from the vendor. Are you able to get me? So this guy is actually pulling this guy. P3 is pulling P2, P2 is pulling P1, P1 is pulling from the vendor. That's why it is called as pull model. That's why it is called as pull model. Are you able to get me? Bol re? Earlier these are physical cards, but now they are replaced by computerized systems. But still it is called with the same name. Now they call it as Kanban authorization. So this whole lean manufacturing is dependent on what, Nana? Pull processing. After that we have seen what? Yeah. Because when it comes to JAT, there are no stock. There is no raw material stock. There is no finished good stock. Little bit of WIP stock will be there. Then continuous flow of production. Yeah, it's not going to stop. Because even though it's pull system, you feel that somebody is pulling from the outside, but they will keep on ordering continuously. These guys will keep on manufacturing. So if you see it in your plain sight, it feels that it is a push model only. Are you able to understand? Because in both the cases, ultimately from here only, it has to travel. Are you able to understand? So in general, when you imagine that they are happening continuously, both of them seem to be same, but the underlying structure is different. Are you able to get me? Right? Next, zero waste time. Because the entire chapter, The entire intention behind this chapter itself is to what? Exactly. Reduce the waste without sacrificing productivity as well as quality. That's the whole intention of lean system and innovation. And finally, continuous efforts to find ways to reduce what? Process time. That is what we do it under Kaizen costing. Isn't it? Under Kaizen costing, we continuously try to find out ways where we can reduce what? Time, or reduce cost, or look out for improving some sort of process or efficiency, whatever it is. We always strive to do that continuously, isn't it? Is there a ceiling limit when it comes to Kaizen costing? No. You just keep on improving for lifetime. Are you able to get me? So all these are characteristics of lean manufacturing. Okay, then we have seen push model and pull model also. After that, we started with what, Nana? JIT. So what is JIT basically? We have seen the definition already. It is a collection of idea that streamlines a company production process to such an extent that all types of waste, including everything, is eliminated. That's the whole purpose of this chapter also. You want to eliminate all types of waste. That's why we started with waste. We tried to understand that there are 7 different types of waste. We tried to understand what is waste, and then only we started coming to JIT. Got the point? Because the whole intention of this chapter is to eliminate the waste. That's what JIT also says. But when it comes to JIT, we know that there are 2 types of JIT. JIT production, JIT purchasing. JIT production we have already seen just now. That is nothing but this diagram, correct? Where a component will be produced only when it is required by the, exactly, each component of a production line is produced only needed for the next stage. For example, here this guy will produce only when it is needed by P3, when he will know that it is needed by P3 when this card was removed. And similarly, this guy will produce only when it is needed by P2, when he will know that it is needed by P2 when this card is removed. That's Kanban authorization. Now everything is, yeah, through computer system, they'll get the signal and all that in the form of mail or whatever it is, whatever the kind of ERP systems they've got. Got the point? So that is nothing but this one. Okay, each component of a production line is produced only when it is needed for the next stage. What about JIT purchasing? You will purchase the raw material in such a way that the timing of receipt of raw material exactly matches with usage of raw material. Are you able to get me? Bold and Anna, right? Till here it's clear. My throat is paining actually. Okay. Chalo, ready? Yeah. Now let's move on to the next one. Okay, so now we have seen what is JIT production and JIT purchasing. So there are 2 aspects of JIT, correct? After that, now let's try to understand JIT process clearly. So we can explain JIT through the following 2 processes. Okay, what is the first one? Impact 1 of the JIT will be on the supplier. Impact 2 of the JIT will be on the production facility, that is within our company, within our factory. First, let's try to understand this. What is the first impact on the supplier? In what way it's gonna impact? So let's start with impact 1 due to JIT. So in that, step 1 is our purchasing department staff, they will go to the supplier, they will investigate whether the supplier can supply the requisite materials on the requisite date at the requisite time. Are you able to understand? Without any failure. Can he provide us some sort of assurance? Does he have any sort of previous work experience in this area? Did he join with some other company in the area of JIT where he has to supply more number of times raw material in a single day? Are you able to understand? And was he able to deliver high quality raw materials, which is the most important prerequisites? You remember that one of the prerequisite of JIT is what? Defective free raw materials. Are you able to understand? So whether he can do all these things, that will be verified by our purchasing department staff. Are you able to get me? Yes. Once that is done, then our engineering staff will visit the supplier factory and then they will evaluate how is his production process, what is the quality of his output. If it is of desired quality, it's fine. If it is not of desired quality, then what they will do? They will assist them to enhance their quality better, because our quality of, our output quality depends upon the raw material input quality which we get from the supplier. Therefore, our engineering staff will go there and they will also provide some assistance. What assistance? Engineering assistance to increase the standard of raw material, because quality of raw material is better, then the quality of the finished goods also will be better. Once you get this certification and this certification, one is the certification or approval from our purchasing department, that yes, this supplier can be trusted. He can deliver any number of times at a given place and a given time with the requisite quantity. Are you able to understand? And then the quality is also certified by the engineering staff. Then what will do, company now will go with the agreement with the supplier, and then they will install a system that automatically notifies supplier the time, date and place on which the raw material is needed, which is nothing but EDI. Where in our company, in our factory, whichever machine, whichever production floor it is in, what components does it need, on what time, what date, how many, single component, multiple components, everything will be updated to the supplier on real time basis. Are you able to understand? Through EDI. EDI is nothing but electronic data interchange. After that, the final step is supplier directly sends the material to the production facility. Suppose 4th floor, 3rd mission, straight away it will go and land over there. There will be no inspection. Without inspection, how all these things are possible? Because already our engineering staff has certified the quality of the raw material. Therefore, no need for us to do inspection. Then if you don't do the inspection, how would you know how many raw materials you have purchased when the raw material comes from the supplier directly to the production floor? For that, we know the solution, that is backflushing. We have already learned that. We will see that again. Okay, next. For this to happen, most important thing is the location of the supplier must be nearer to the production facility, because he has to supply many number of times in a single day. So this is the first impact. Are you able to get me? And the second impact is on production facility. So let's have a look into that. Now, in that we have seen that generally manufacturing companies will have this worry of setup cost. Setup cost will generally be heavy. So they want to reduce the setup cost. For that, generally what they'll do, they'll go for long production run. So long production runs means what, Nana? For example, suppose your output is 1000 units and your production run is 100 units, which means once you start the machine, it will manufacture 100 units. After that, it will stop. And then again, you need to set it up for another run. And that is called, we call it as what? Setup time. And then it will run for another 100 units. Then it will stop. And then you need to set it up. Then it will run for another 100 units. It will stop. So that continuous run, we call it as production run. In one production run, it can manufacture 100 units. What is the total output? 1000, which means how many runs you need? 10. How many runs will be needed? That many setups will be needed. And per setup, let's say the cost is 5000, which means the total setup cost right now is how much? 50,000. Now the company is really worrying about this particular setup cost. So they want to reduce it. Are you able to get me? They want to reduce it. So now how do they reduce it? They reduce the setup cost by going for long production run. So what do you mean by long production run? More units per production run. Instead of 100 units per run, they go for 200 units per run. In that case, instead of 10 runs, they need only 5 runs. Anyway, per setup, the cost will remain constant. So it's going to be 5,000. So instead of 50,000, it's going to be what? 25,000. This way we reduce the setup cost, but this has got a problem. How many problems? 3 problems. Very good. So problems due to long production run. First problem is too many products are made too frequently, therefore it might lead to product obsolescence, and that will be a waste, right? Too much inventory means too much carrying cost. Earlier I was having 100, now I'm having 200. Obviously more inventory carrying cost, then more defective products. Are you able to understand why? Because if the downstream machine operator, that is the next machine, downstream machine operator, unless he comes and works on the output of the upstream machine operator, how will you know how many defects you have made? Are you able to get me? Yeah, that is one thing. Here the problem is, instead of 100, because of the long production run, now you are manufacturing 200. So when you are manufacturing 200, automatically the defects will be more. Proportionately it will increase, obviously, isn't it? And then before you get communication from the downstream machine downstream machine operator after working through the pile of WIP stock and then communicating you that there has been a defect, you would have again manufactured another 200, correct? Instead of 100. So therefore defects also will be more, since problem is not identified until more units are manufactured. Earlier it used to be 100 by the time you identify the problem. Now it's going to be 200 by the time you identify the problem. So now all these problems has to be solved, but at the same time our target of reducing the setup cost also should happen. Therefore we found the solution as per JIT. What is the solution, Anna? Videotape setup. As per videotape, basically what happens, a recorded videotape of setup work by workers will be examined by industrial engineers and machine users, spotting errors and gradually eliminating unnecessary steps. Optimum setup time can be achieved after good number of iterations. So what they do basically, they ask you to work and they sit, they record each and every aspect of the work. And after that, what they will do? They will analyze each and every steps through repeated iterations, which means doing the same thing again and again. And all the unnecessary steps will be what? Eliminated. So in real life, setup time as high as 90 minutes has been brought down to 15 minutes also. In real life, that has happened. Now it's surprising to hear, but that's how it has happened. Okay. So if you can do this videotape setup, then eventually what happens? Your setup time reduces. Say for example, because your setup cost is proportionate with the setup time, right? So greater the time you take to set it up, greater will be the setup cost. Are you able to get me? Yes. Earlier, let's say you are taking 1 hour and your setup cost is 5,000 per setup. Now, because of the videotape, suppose if you are able to do the same in 30 minutes, then for 30 minutes only the setup cost will be there, which can be what? Exactly. Are you able to understand? Which can be half. For 1 hour, it is 5,000. So 30 minutes, it can be 2,500, which means now, even though there are 10 production runs and 10 setups, but the cost will be 10 into 2,500. It's going to be how much? 25,000 only. So you did not compromise on anything else. You kept the production run small. Still, it is 100 units, but your cost has got reduced. So these 3 problems are solved right now. Correct? Because of videotape. But videotape creates another problem. So what is that particular problem? Yeah, because of the videotape, you have reduced your setup time. So therefore, that particular machine whose setup time has got reduced, it will become faster and the other machines will eventually become slower. So therefore, ultimately, because of the difference in operating speeds of these machines, what will happen? The WIP inventory will get piled up before the slowest machine. And once WIP inventory or stock gets piled up, it creates 2 problems. One is, first of all, having a stock itself is a problem because you need to have carrying cost. You need to incur carrying cost, right? Other thing is what, Nana? Too many WIP stock will be manufactured. And in that, if there are defects, as I told you already, unless the downstream operator comes and works upon the pile of stock that we upstream operator has got created, I will not know that there has been a defect. Unless I know, I'll not be rectifying it. Are you able to understand? So by the time he works through this, I would have created even more number of units, because still now I don't know that I've created what? Defects. And that's a big loss for the company. Defects is a loss, isn't it? Yeah. Now again, this problem can be solved in 2 ways. 1, Kanban authorization. 2, cellular manufacturing. Kanban authorization, I already told you how to do that. Very simple. Yeah. Suppose machine 1, machine 2 and machine 3. Machine 1 is upstream. Machine 2 is downstream for machine 1. Machine 2 is upstream for machine 3. But machine 2 is, yeah, that's what, upstream for machine 3. But machine 2 is downstream for machine 1. Are you able to understand? Kya? So totally I've got 3 machines, M1, M2, M3. Are you able to understand? So this is upstream, this is downstream, correct? For machine 3, this is upstream, and machine 3 for machine 2 is what? Downstream. Are you able to understand? Yes? All right. So now what happens in Kanban authorization? Unless the downstream machine operator authorizes you to manufacture, you will not manufacture. So which means if I manufacture only after getting authorization from the next machine. Therefore, if I manufacture, immediately he'll take from me. Therefore, there is no question of WIP getting piled up between me and him, between upstream machine and the downstream machine. Got the point? This is one solution. What was the second solution? Cellular manufacturing. So here what happens? You break down the entire traditional manufacturing and you convert that into cells. Normally, reverse U-shaped cells, that is preferred. Cell means what? A single operator will operate multiple machines right from raw material stage till finished goods stage. Are you able to get me? Because one single operator in a single cell operates multiple machines right from raw material till finished goods, there is no question of WIP getting piled up. Are you able to get me? So that way we solve the problem of WIP, which has got created because of difference in speeds of machines, which got created because of reduction in setup time, which is because of videotape. correct? So Kanban code is done. Cellular manufacturing means I already told you. So this is the way we took this example. What example? Bread jam example, and with that example I clearly explained you. Like for example, this is the cell, and you have the bread over here, you have the toaster, you have the cutting, and you have the jam. So ultimately our product is bread jam. So what happens? He takes the raw material, he puts it into the toaster, already toasted bread will be cut and it will be jammed, and the finished goods is ready. And then again he'll take the toasted bread and then he'll cut it, he'll jam it. So this guy is taking care of 3 parts over here, correct? Is there any chance of WAP here getting piled up between 2 machine operations, right? No. Why? Because single guy is taking care of it. This we call it as what? Cellular manufacturing. Are you able to understand? And of course, one thing that your ICA study metal has missed is the most important guy in cellular manufacturing setup. Who is he? Water spider or Mizusumashi. Okay. So what he does, he has a trolley. He goes to a particular cell, and if you don't have raw metal, he puts the raw metal. If you have finished goods, he takes the finished good. If there is any spare parts that is required, he gives those spare parts components. He basically keeps the machine alive. He is like blood of this whole setup that makes the setup alive. So what are the advantages of cellular manufacturing? No need of big machines. Like in the case of traditional manufacturing, you just need what? Small machines. So there is no need of investment. Also, small machines can easily be ready for customization. So you can customize and do some different products, and it's easy to maintain. It is not costly. Even a small machine operator with a little bit of training can happily what? Maintain those small machines. Are you able to understand? Not only that, like this, you'll have multiple cells, like 100 cells or 200 cells or 500 cells. So if you have seasons or unseasons, you can easily switch off some 500 cells. You need not keep them operational. You can only operate 50% of the cells and still you can work. There's a lot of flexibility involved. That's why cellular manufacturing is the next big thing in manufacturing in the world. Got the point? Bol rahe? All right. So we are done with that as well. Then after that, we have seen some important points for cellular manufacturing. Benefits due to cellular manufacturing. There is no inventory buildup, obviously, because only one guy takes care of everything. Where is the question of WAP getting piled up? Next, since one operator is responsible for all the machines, responsibility towards quality increases because he is more excited, he is more committed now, right? Defective output can be identified easily because he can easily see, right? Because he is the one who is taking care of everything. And because the machines are very small, it's easy to maintain. Since machines are small, it is easy to customize them as well. That's what we are talking about, reconfiguration over here, so that you can make a little bit of different products. But with the big machines, that's not possible for us as per traditional manufacturing, because the machine itself would have costed 10 crores, 5 crores and something like that. Got it? But if you want this to happen, in traditional manufacturing, what was your labor doing? He was just part and parcel of a big machine, and he was doing a small job of operating the machine repeatedly every single day, correct? But then once the cellular manufacturing has come into picture, he has to operate multitude of machines, which means multiple machines, and not only operate, he also needs to maintain it, clean it, lubricate it, tight the nuts and bolts, identify the crabs, that, this and all those things. For that, definitely he needs training. Are you able to understand? And you as a company should take the responsibility and teach them to perform limited maintenance, and without the need of what? A maintenance department frequently. There will be need, but only for complex repairs, and how to spot and fix the errors then and there itself. Are you able to get me? Yeah, all right. Also, one important point that we have seen after that was these two solutions for WAP problem, which is Kanban authorization and cellular manufacturing, can be implemented together, which will be even more stronger. And I explained you with the help of a diagram, correct? So Kanban and cellular manufacturing should be worked together to achieve extremely low WAP inventory and defects. As you can see, first series of cells, correct? Where engine is there, and then they are manufacturing engines over here in this series of cells, and then next department where they are manufacturing interiors or suspension. Just for understanding, I just try to keep it simple, okay? Where here you are manufacturing those things, right? And then next series of cells where you will be manufacturing body and chassis of the car. Are you able to understand? When this guy orders, then this guy will give the interiors and suspension as the input for him, and when this guy orders, then this guy will give engine and suspension as input for him. But that was made based on what? cellular manufacturing. And this entire process works with Kanban authorization. Thereby, on one side cellular manufacturing is happening, on other side Kanban authorization is also happening simultaneously. Are you able to get me? Yes. Kanban authorization means you already know. What is Kanban authorization? Upstream machine will not manufacture until you get authorization from the downstream machine. So here this is upstream, this is downstream for the first one, and this is downstream for this one. And for this one, for series of cells 3, this becomes upstream. So unless you get the authorization from this machine will not manufacture. Unless you get authorization from this machine will not manufacture. Are you able to get me? That's Kanban authorization. And the way they are manufacturing is by following cellular manufacturing. So both of them has been integrated beautifully together. Got the point? Yes. After that, we try to learn a very interesting topic. What is that? Vendor managed inventory technique. What is this concept? Very simple. You allow your supplier to get full information about your number of units sold, number of units in the warehouse, or able to understand on real-time basis. So he will have the access of our information. Who? Supplier. Why are you giving him access? Because this will help supplier to manage the inventory by anticipating demand and refilling accordingly, which means he's going to take care of your inventory completely. That's why you're giving him access. So hereafter, you're not going to manage the inventory. For that, I told you the logic. What is the logic? Probably he's expert in that particular area. Just like how there is something called factoring, where you try to sell your debtors to somebody because he's got expertise in that area, where he will start what? Collecting from the debtors. Same logic applies here also. Probably he is expert in that area when with respect to what? Inventory management when compared to us. So this is called as the vendor managed inventory technique. It also helps you in achieving target cost. Why? Because of that, your cost is going to get reduced. Probably if you do something on your own, it will cost you 70. He can do it within 50 because he has got expertise, and he takes some 10 rupees profit and charges you 60. Still it is beneficial for you, correct? Otherwise it would have costed you 70. I'm just trying to tell you in a simple number language. Got the point? Right. But if you go for the so-called vendor managed inventory technique, there are some challenges that a firm may face in implementing this. What are those challenges that should be kept in mind? First one, entire production process should be detailed to your vendor and integrated how to know material requirement at each assembly stage. Only if you detail him very clearly, then only he'll be able to manage your inventory perfectly. Are you able to understand? Otherwise, once he doesn't know how your manufacturing process happens, how much time it's going to take to convert the raw material into finished goods, if he doesn't have a clear-cut idea of how your manufacturing process happens, then he will not be able to manage your inventory. Are you able to understand? That's why you have to give him clear information. Second, since there is heavy dependence to put on the vendor, agreement with the vendor with penalty is very important, because in case if he does some sort of a mistake and if you go out of stock, which means he is not able to manage your stock, or he does some sort of a mistake, then you will be the one who will be paying the penalty, correct? Because you will be dissatisfying your customer and things will go sideways, isn't it? And that loss, what we're going to face there, either directly or indirectly, we'll try to recover from the vendor, and that's why we need to have a penal clause. Are you able to get me? Yes. And finally, even after implementation, there should be continuous improvement and leadership support from what? Top management. They should keep on talking with the vendor and see everything is in place. You should keep that relationship moving. Got it? Fantastic. Next. After that, another interesting concept that we have seen. What is that? Due to change from push system of manufacturing to what? Pull system of manufacturing, because it's exactly opposite. Your entire accounting system also needs change. The first change is due to large number of shipments. Earlier in push system, hardly used to get 10 shipments in a year, but now you're getting everything, a shipment a day, which means in a month 30 shipments, 40 shipments. Are you able to understand? Therefore, it's very difficult for the account staff to go through the large pile of accounts payable paperwork. Are you able to get me? So therefore, what they can do, a simple solution could be just ask them to wait till the end of the month and prepare a consolidated report and make the payment accordingly. You got the point? Or even to make the case worse, sometimes there is even worse thing that could happen, that is there is no receiving payable, which means you are not at all recording how many raw materials are coming inside your company. Directly the order is going through EDI from your requisite machine, from your requisite production floor where the manufacturing is happening, directly to the supplier on real-time basis, and he directly comes and delivers onto the production floor in front of the machine and goes away. So nobody is taking note of anything that's happening. How many raw materials have come in, how many has been consumed, blah, 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 nothing. Are you able to understand? So therefore, it means supplier deliver parts directly to the production floor to the particular machine on specific date and time. So in that case, how would you know how many units of raw material you have consumed, you have got from the supplier? Maybe some of you might say that, okay, get that information from the supplier. That's not something that is reliable, right? Because we also need to get confirmation from our side. So therefore, what we do something called back flushing. We do something called. Now the next question is, what do you mean by back flushing? Well, the answer is very simple. In a particular day, suppose our company works till 5 o'clock in the evening. We wait till 5 o'clock. After 5, the working of the company is done. Okay, so what we do is that we send our person, we ask him to count the finished goods physically, or he will count it and he'll put the information into the system, which will get it eventually. Once we know how many finished goods has been actually manufactured, you take that information, you put inside the system and you multiply that with bill of materials, which will tell you how many components or raw materials should have been consumed for the requisite amount of finished goods that has got manufactured. Now you will get theoretical amount of raw materials that should have got consumed. For that, you will do some normal scrap adjustment. Eventually, based on that, you will make the payment to the supplier. Are you able to get me? That we call it as what? Back flushing. So that also we have seen. Got the point, Nana? So this approach implies that there is no need for suppliers to send invoices also. And I gave you a small example. This fair and fair whole square cream, and this is how a bill of materials look like on a lighter note. You got the point? So we try to make it a little bit fun. Funny, yeah. Okay, got it? But it's not all good when it comes to back flushing, right? First of all, there are 4 different types of risk when you go for back flushing in order to find out how many raw materials you should have got consumed. It's theoretical only, na? It's not real raw materials that you have actually consumed. The first problem is your production can be inaccurate. Then automatically everything will be inaccurate. Second problem is scrap sometimes can be abnormal. You would have made adjustment for normal scrap, but not for abnormal scrap. Then inventory accuracy can be a problem as well. So you may not count properly, right? Lot tracing also can be a problem. Suppose your finished good has got some sort of a problem, then you don't know from which raw material lot it has led to the problem, presuming that your manufacturing process is correct. So that only problem is with the raw material received from the supplier, and tracing back that raw material where something wrong has happened will become impossible because of this setup. Are you able to understand? Yes. That's it. After that, we have seen what? Features of JAT. Features of JAT means, we know material handling cost is reduced. Why? All the materials are handled by the supplier, right? Labor idle time gets reduced. Why? Because now your employees are trained to even operate and maintain the machine. Thereby, they are doing maintenance, operations, everything. As a result, probability of machine breakdowns have got reduced, which means machines are not frequently breaking down. When there is no breakdown, there is no idle time for the labor, because they will not sit idle. They will always keep working, correct? Therefore, labor idle time also gets reduced. Eliminate defects ASAP. That I told you. Because of the pull system, definitely we need to eliminate defects as soon as possible. And you also know that one of the prerequisite of JAT is what, Nana? TQM. So automatically defects will go away. And of course, because of JAT, you will be able to respond to customer demands faster, because you have reduced your setup time with the help of videotape. Exactly, right? And there are still small production runs. Therefore, you will be able to manufacture faster and respond faster at the same time by reducing setup time. So it's like best of both the worlds. You got the point? These 4 are the features of JAT that we have seen. Then we have got something called prerequisites of JAT. Means what? These points are compulsory if at all you want to implement JAT successfully. First one is low variety of goods. Why? Only if the variety of goods is low, only then we'll be able to maintain that WIP inventory limited, and then we'll be able to what? Maintain the quality and consistency. We'll be able to assemble them and then deliver. Just like KFC and McD, unlike our restaurants where they have a big menu card, it's very difficult for you to maintain quality. Are you able to understand? Right. Next, vendor reliability. Of course, he is the core. Is the core, right, of the entire JAT setup. Good communication. The communication between departments as well as from the lower level management and the top level management, where these guys can get some ideas which has to be communicated to the top level management, and that is important in this sort of a setup. Which setup? Pull setup, especially JAT, right? Demand stability, JIT can be successfully implemented only if your demand is stable. If you have a fluctuating kind of demand, because we are running on no inventory model, it's impossible for us to, match with those high fluctuations. You got the point? EQM, I told you already, because in JIT, in pull system of manufacturing, after getting the order only we start manufacturing. Therefore, we don't have the buffer or freedom to manage defects. So we should be defect free. Therefore, before we implement JIT, TQM should have got implemented successfully. Then defect free materials, obviously we need that. That's why we select the supplier by sending our engineers to ensure that his raw material is of requisite quality and they are defect free. We have already seen that. And preventive maintenance, that we have completed total productive maintenance, where we have seen that if you do preventive maintenance for your machines will not have unexpected breakdowns, plus your machine's output quality also will be better. Are you able to get me? So these are all your prerequisites of JIT. Impact of JIT, we know. Because of JIT, waste cost gets reduced. We know that, obviously, isn't it? Defects are getting reduced. Rework is not happening with respect to many of the products, isn't it? Lot of waste, unnecessary transportation of employees are not there, equipments are not there, products are not there. All different types of waste is getting reduced. There is no overproduction, there is no overprocessing. Bol re. Overhead also gets reduced. We have seen it in the example in case of setup cost. Even material handling cost is getting reduced because you are not at all handling any material. Everything is handled by the supplier. That is also overhead. Product prices gets increased. How? Your quality has got increased. Therefore, you deserve a better price. Obviously, because your defects has got reduced. Okay, then we have seen some performance measurements in JIT. Not in JIT. Some famous performance measurements as per traditional manufacturing, which will not work in JIT. You got the point? And then we have seen machine utilization rate, because in traditional manufacturing we used to buy big machines like 10 crores, 5 crores. Therefore, when you have invested 10 crores in a machine, your human psychology will be what? We need to ensure that the machine is being used to the fullest. Therefore, machine utilization rate used to be a means of performance measurement system. But in JIT, that doesn't work, because here we are talking about small machines. Next, piece rate tracking. How many output you will manufacture more than the target, that much of bonus for you. Once upon a time, as per traditional manufacturing. But now, first of all, when it comes to JIT, we will not manufacture unless there is an order. So here, if you do overproduction, more pieces, you are not what? Rewarded. In fact, you will be punished actually. So this also doesn't work in JIT. Next, direct labor efficiency tracking. Efficiency tracking itself is considered as non-value added activity. By default, he should be efficient. Create such a kind of system. Give him some incentives such that even if you don't track him, still he'll work efficiently. You keep some incentives, automatically he'll work. There will be motivation. Yes. After that, we have seen performance measurement in a JIT. How to measure whether JIT has been implemented successfully or not. The performance measurement is good. First one is turnover should have got increased. Setup time should have got reduced. Customer service should have got better, because now we are responding faster. Customer complaint should have got reduced because there are no defects, there are no problems, quality has got improved. Ideas generated should be more from the lower level of the management. Scrap should have got reduced because we know waste will get reduced. Cost of quality would have got increased, because obviously you're improving the quality, right? Obviously cost of quality will increase because quality is not free. Yes, all of you, right? Finally, we have seen some advantages and disadvantages due to JIT. So the plus points are savings in insurance, because now you'll take insurance of what? No stock, no insurance. No stock, no need of warehouse. No stock, no need of inspection. And your working capital gets reduced. Minus points. No stock, there is a chance of stock out. So because of that, you lose some contribution because you have lost an opportunity to sell. And sometimes what happens, because in JIT, depending upon the demand, you'll start manufacturing. Sometimes your demand can be greater than your production capacity. In that case, you need to work overtime and then satisfy the demand, where you have to pay 50% extra at least. And that's a negative point. That's a cost. And of course, increased procurement cost, because in JIT, you're going to order more number of times. Earlier, let's say it's going to be 10 orders. Now you're ordering hundreds of times. Yes. So more ordering cost. Not only that, you have to pay some premium on per unit raw material cost because of JIT. Why? Supplier has to supply better quality raw material, he has to supply more amount of times, and all this, sacrificing is he's doing, right, on our behalf. We are not maintaining inventory, he has to maintain, because he has to deliver whenever we ask. Then he will be incurring more working capital cost. So that he will get from us only. Na? Therefore, eventually what happens? Raw material cost will be little bit more premium once you implement JIT with your supplier. Got it? Especially this concept, what we have seen, the plus points and minus points is very important for solving problems. Got it? So with this, we are done with revision of JIT. Ho gaya.
Hello friends, welcome to PK Sir classes. I hope you guys are preparing well for your exams. Earlier I have posted the important questions video. I would like to clarify again that I have posted the questions from my workbook, okay? And all these questions are from ICA study material. So if you are my student, you already have the answers with you. If you're not my student, it's very simple. Just open your study material, you will find all the questions. Maybe the order will not be the same, but all the questions you will find eventually, okay? So that should not be a problem. That way you can get the help out of those important questions and prepare your examination accordingly, right? Anyways, the moment I've posted that video, in that I've announced that, I've told that this particular question is very important. The first question, which is about strategic profitability analysis of this particular chapter. That is a strategic SAO, strategic analysis of operating income. And many students have messaged me saying that, sir, this is a very complicated topic for us. We were not able to remember all these formulas. It is pretty cumbersome. So that is the reason I'm posting this video immediately. So I'll tell you one thing. No need to study any of this. Okay, whatever that has been given here in your ICA study material, all this formula, this one, okay, this one, this one, this one, this one, and even this. Okay, that's okay. It's just a pro forma of reconciliation. Okay, you need not study any of this. Are you able to understand? I'll tell you why. Okay, we'll try to finish it off in a pretty simple way. Okay, right. Chalo, now see here. See, the concept is pretty simple. Listen carefully. Any variance, okay, you take any variance, whether it is material variance or labor or sales or whatever it is, any item, any expenditure item or any income item, maximum it will have three angles. Maximum. The word that I've used is maximum, which means it can be two, it can be one as well. So there are only three possibilities. Either it will have one angle or two angles or max three. Okay, they are, one is growth perspective, or we can say three perspectives as well. Other one is price perspective, growth perspective, price perspective, and productivity perspective. You should remember all the different names for this. Productivity can also be called as efficiency. Productivity perspective can also be called as efficiency perspective. Price can also be called as price recovery. Are you able to understand? Growth can also be called as volume. Growth can also be called as volume perspective. Okay. Anyways, now having said that, now let's try to recollect all the variances that we know. Definitely it should fall under any of these three categories. That's the logic which I've told you, correct? So which means you take any variance, max it should have three, or it can have one or two or three, correct? Now let's go with all the variances that we know already. For example, let's start with material variance. Okay, now tell me. So first, material price variance, it falls under what? Price recovery. Let me call it as PR. This one, price recovery as PR, volume as V, productivity or efficiency as PD. Okay, anyway, so material price variance is nothing but price recovery. So this is not a new variance. It's the same variance that we're going to call it with a different name. Are you able to understand? I'm just trying to make it very simple for you. What about material usage variance? It is productivity, or we can also call it as efficiency, correct? How efficiently you use your raw materials, isn't it? Next, come to labor variance. Labor rate variance is nothing but price recovery, right? Labor efficiency variance is nothing but productivity or efficiency, correct? Come to variable overheads. Variable overhead expenditure variance is nothing but price recovery. Variable overhead efficiency variance is nothing but productivity or efficiency. Got the point? Next, fixed overhead variance. Fixed overhead expenditure variance is nothing but price recovery again. And you know, fixed overhead volume variance, name itself tells you that it is volume. Then come to sales variance. Sales price variance is nothing but price recovery, and sales volume variance is nothing but volume, or you can also call it as growth. Are you able to understand? Okay, so it's pretty simple. So it means What I've done here is that I've put all the variances which we already know and I called it with a different name. That's all. The whole concept is that simple. So we are just gonna see it from a different angle, different perspective. That's all. They are not altogether new. But yes, there are certain new things that you have to remember. What is that? When it comes to material, what we have seen in our general variances, in our normal variances, or material price variance and material usage variance, correct? Whereas, if you are solving any question from the perspective of these three variances, what are these three variances? Growth, volume, price or price recovery, or productivity and efficiency. Then, even for material, there will be something called material growth variance. The moment you see this, you should not get terrified. Sir, what is this material growth variance? Sir, we haven't seen it so far. It's new for us. It's not new. Little bit of common sense. Growth is nothing but volume. So when I say material volume variance, change in volume is nothing but material volume variance. What is change in volume? Very simple. You take budgeted material cost and you reduce standard material cost. What is the difference between budgeted material cost and standard material cost? Volume. Are you able to understand? What is the difference between budgeted material cost and standard material cost? Volume. Budgeted material cost is nothing but budgeted material cost per unit into budgeted output. Standard material cost is nothing but budgeted material cost per unit into actual output. If you take the budgeted raw material cost per unit, you multiply that with budgeted output, it will give you budgeted material cost. You take the same budgeted material cost per unit, you multiply that with actual output, it becomes standard. So to put it very simple, the difference is volume, which is nothing but growth variance. Same logic applies to labor also. Suddenly you see, and you need to calculate something called labor growth variance. Okay, don't get terrified. Same logic. It is the difference between budgeted labor cost and standard labor cost, isn't it? Again, the logic remains the same. Budgeted labor cost means what? Budgeted labor cost per unit into budgeted output. Standard labor cost means what? Budgeted labor cost per unit into actual output. So the labor cost per unit remains the same, which is budget in both the cases. You multiply that with budgeted output, it becomes total budgeted labor cost. You multiply with actual output, it becomes standard labor cost. Same logic applies to variable overheads as well, which is nothing but we can call it as variable overheads growth variance or variable overheads volume variance. That's it. The entire concept is done. Whatever that has been given in your ICA in those initial pages, the entire concept is done. We have covered everything now. So which means except these three variances, all the other variances are something that we already know, something that we have already learned in our standard costing chapter. Are you able to understand? So material price variance is nothing but price recovery. Material usage variance is nothing but productivity and efficiency. Labor rate variance is nothing but price recovery. Labor efficiency variance is nothing but productivity or efficiency. Variable overhead expenditure variance is nothing but price recovery. Variable overhead efficiency is nothing but productivity or efficiency. Fixed overhead expenditure variance is nothing but price recovery. Sales price variance is nothing but price recovery, and sales volume variance is nothing but volume or growth. And of course, in addition to the existing variances which we already know, there are three new variances, that is material growth, labor growth, and variable overheads growth variance. How to calculate that I told you, which is nothing but difference between budgeted cost and standard cost. There ends the matter. If it is material, budgeted material cost and standard material cost. If it is labor, budgeted labor cost and standard labor cost. If it is variable overheads, budgeted variable overhead cost and standard variable overhead cost. That's it. So if you know this, your entire strategic profitability analysis concept is done. That's all. That's it. Are you able to understand? So here in all these formula, you already know the existing formulas, right? Use the same formula, that's it. And only new things that you're going to learn is only these three. For that also I just told you the concept. No need to remember any formula. It is a difference between budgeted cost and standard cost. There ends the matter, that's all. For this you already remember the formula, so you need not learn anything new once you know the standard costing, isn't it? Whichever the methodology you would have followed. Are you able to understand? Right? It doesn't matter, because you know the answers for all these variances. That's it. We are done with it. So we can solve this particular sum. Now see here. What is this question? Y Limited is a manufacturer of cardboard boxes. An analysis of its operating income between 2020 and 2021 shows the following. You got the income statement, then growth component, price recovery component, and productivity component, and you have got income statement. So this is the pro forma of how reconciliation statement looks like if you are calculating variances from these three perspectives, that is growth, price recovery, and productivity. So you got revenue, you got cost, and you got operating income, and they've got reconciled. I told you here itself that any variance, okay, maximum they'll have these three angles if you see them from these three perspectives: growth angle, price angle, productivity angle. Are you able to get me? That's what he has given in this particular question as well. So what is that he's trying to ask? Already he has done the reconciliation. He's again asking you that Y Limited has sold 4 lakh boxes and 4,20,000 boxes in 2020 and 2021. During 2021, the market for cardboard boxes grew 3% in terms of number of units, and all other changes are due to company's differentiation strategy and productivity. Fine. What is that he's asking you? Compute how much of a change in operating income from 2021, from 2020 to 2021 is due to industry market size, productivity, and product differentiation. Right. Already he has done reconciliation of but 2020 income with 2021 income with the help of three things: growth component, price recovery component, and productivity component. Now he is asking you to do the same reconciliation of income of 2020, which is 10,80,000, with income of 2021, which is 14,42,000, not with the help of these three, which is growth, price recovery, and productivity, because that has been given in the question, but with the help of these three: market size, productivity, and product differentiation, which means this should be replaced with market size, right? Productivity will remain productivity only. In the place of price recovery, we'll be getting what? Product differentiation. So one is market size, other one is product differentiation. Productivity remains the same. So which means basically we'll copy paste the same number, isn't it? So how to start the answer? Very simple. You just put this pro forma, operating income of 2020, copy paste from the question, leave some 3 lines. Operating income of 2021, copy paste from the question. Then here in the 3 lines, what you have to put? Market size factor will be 1 line, productivity will be another line, product differentiation will be another line. Productivity you already know because that is there in the question, 58,000. You put that 58,000 here, copy paste that, there ends the matter. Now we need to fill it up only two, the rest two. One is market size, the other one is product differentiation. Now that is also very easy once you know the logic. If you can see here, he said market size has grown by 3% in 2021 when compared to 2020, correct? So 2020 is how much? 4 lakhs, right? 4 lakhs into, it has got increased by how much? 3%, which means 12,000 units has got increased because of market size, correct? Here, if you can see, there is growth component that is given in the question. Growth means what? Volume. Growth means what? Volume. Total volume variance is how much? 1,40,000. How much is the change in volume? 4 lakhs to 4,20,000, which means totally 20,000 units has got increased, and for that the variance is how much? 1,40,000. That is a volume change. In that 20,000, 12,000 is due to whom? Market size. So therefore, market size variance will be how much? Take proportionate. 1,40,000 is for 20,000 units. Then for 12,000 units, it is how much? 1,40,000 into 12,000 divided by 20,000, correct? So 1,40,000 into 12,000 divided by 20,000. 84,000 will be your market size. Done. Now this can be put as balancing figure also. Your answer will be fine, but you will not get marks because we have to show the working, right? So market size is done. So now tell me one thing, use your common sense. Sir, totally the volume has got increased by 20,000, sir, from 4 lakhs to 4,20,000. In the 20,000 increase in volume, 12,000 is due to market size. What about balance 8,000? That has got increased because of what? Very simple. What should be the only factor? What should be the only factor? Market size is done. Productivity is done. What should be the only reason? Product differentiation. Like that also you can analyze, or when you read the question itself, if you are smart enough, you should observe this number carefully. What is that? Revenue has got increased, favorable, which means you have sold at a higher price. Cost also has got increased. Ultimately, the net effect is favorable, which means you have invested in cost to make the product different, and because you have made the product different, you are able to sell it at a higher price. And because you have made the product different, not only you were able to sell it at a higher price, but also you were able to sell more number of units. Are you able to understand? So when you have seen this, you should be able to get that logic, which means your total sales has got increased by 20,000. In this, 12,000 you were able to sell extra because of increase in market size, which is uncontrollable reason, which is not anything special. We haven't done anything special as a company. It's a natural thing outside our control which has happened. Market size has got increased. Our sales also has got increased. How much? To the extent of 12,000. But the balance 8,000 is due to making your product different. Therefore, people has bought your product. So which means what will be your calculation? Same 1,40,000 into now 8,000 units divided by 20,000 units. So 1,40,000 into 8,000 divided by 20,000. 56,000. This will come under which one? Already we are done with 2. Market size is done, which is 84,000. Productivity is done, copy paste, which is 58,000. So what is left over? Product differentiation. Under that, this 56,000 will come. In addition to that, this price recovery component is there, right? Which is 1,64,000. You were able to sell at a higher price. Why? Because of product differentiation. You made the product different. That's why you were able to sell at a higher price, which means 1,64,000 also will come under product differentiation only. Totally 1,64,000 plus 56. 1,64,000 plus 56,000, 2,20,000. Answer is done. That's it. You see, it's very simple. So only thing that you guys need to remember is that just remember this particular concept. Any variance will have maximum 3 angles. So when you try to think about any expenditure, you try to think this expenditure, will it change because of change in growth? Will it change because of change in price recovery? Will it change because of change in efficiency? Like that you keep on thinking, then you'll understand, okay, with respect to that particular expenditure item or income item, whether we'll have all the 3 variances or we'll have any 2, okay? Any 2 it can be, or we'll have only one, either this or this or this. Are you able to understand? So once you know that, you know what are all the variances you need to calculate, because all these are the normal variances which we already know, except that now we are calling it with a different name. And these 3 are the only new variances that you have to take care of it. And then for that particular problem, the reconciliation has to be prepared in this particular proforma in case if that particular problem comes in the examination. Are you able to get me? So that's it from my side. I hope this particular video has helped you guys and saved at least half an hour to 45 minutes such that you don't study all this formula and by heart all those things. Not necessary. Okay, just follow what I've told you in this video. You should be good to go. Thank you so much, guys. If you really love this video and the efforts, please like, share so that many students will get benefited. And all the best for your exams, guys. Thank you.